David, it's my great pleasure, actually, just to introduce Claire Lombardelli. So we have an hour. Claire will do a speech for about half an hour, and then we'll take questions from the floor, and I'll have a little bit of a Q&A. Deputy Governor, of course, of the Bank of England, with the first speech since she was appointed in July of this year. So Claire, the floor is yours.
Okay. Hello, everyone. Good morning. Thank you for inviting me. It's an absolute pleasure to speak at the Bank of England Watchers Conference in front of many of our key stakeholders. This, as Francine said, is my first speech as Deputy Governor for Monetary Policy. So I'm going to start by setting out my view on the economy and the outlook, how I'm managing the present, and then I'll move on to talk about the Monetary Policy Transformation Programme we're now undertaking in response to the Bernanke review, how we are shaping the future. So this is a big reform programme. We're going to handle uncertainty differently, putting different scenarios, that's different stories about the economy, closer to the heart of policymaking and communications. And to do that, we're making a major investment in our tools, our processes, and our people. We've made some progress since the review was published in April, but we've got a long way to go, and we want to engage with you all on this journey. I'll come back to the details of that shortly. So. Okay. Hopefully have some slides now. Anything we can do. There we go. All right, thank you. Okay, so inflation has fallen steeply over the last 2 years, from its peak of 11.1% in October 2022 to 2.3% in October of this year. Thank you. This mainly reflects the ongoing unwind of the very large external cost shocks that hit the UK in 2021 and 2022, and that made UK inflation rise steeply in the first place. As you can see in this chart, the key drivers of the increase in inflation were the rise in goods prices. These were a result of the global supply constraints that arose during the pandemic and the large rise in energy and then food prices associated with the Russian invasion of Ukraine. In turn, higher energy prices pushed up goods prices further. The MPC monitors closely a range of measures of underlying inflation. We take a forward-looking approach given the lags in monetary policy. A simple and observable proxy measure is services inflation, as service prices are mainly affected by domestic and slower-moving factors. Even though headline inflation fell steeply from its peak and has been around target for half a year, services inflation is still above its pre-pandemic average. It was 5% in October, and we expect it to stay around that rate for another few months. As a result, as the tailwind from lower energy prices dissipates, we expect headline inflation to rise back to 2.8% in the third quarter of 2025. Okay. Wages are a material driver of services prices, and the slow-moving nature of services inflation reflects in part the relatively high stickiness of wages compared to other prices. This is clear in this chart, which shows a model-based decomposition of a core measure of services inflation. This model specifies core services inflation in terms of pay growth and manufacturing producer output inflation. The latter captures the costs of goods used to produce services, including energy. The model suggests that most of the services inflation is driven by what's happening to pay growth. In principle, higher than usual profit margins could also be driving the current elevated services inflation. But we regularly monitor developments in companies' margins, and there is little evidence that we are seeing that. ONS data shows that the profit share of aggregate income has fallen slightly in recent years. And the bank's agents and company surveys suggest that profit margins, including in the service sector, fell or were flat in 2022 and 2023, and are likely to remain compressed in coming quarters. So we're paying close attention to wage developments. This chart shows a decomposition of wage growth used by the bank staff to inform the MPC projections. Wage growth is decomposed into short-term inflation expectations, a measure of labour market tightness, and productivity growth. This model suggests that wage growth since 2021 can be explained mainly by changes in short-term inflation expectations and labour market tightness. The chart shows that wage growth has already fallen materially from its peak of 8.1% in mid-2023 to 4.8% in the 3 months to September. but this is still above its pre-pandemic rate. I take two other points from this chart. First, it suggests that the labour market is still a little tight and continues to exert upward pressure on wages, although this effect has been easing gradually. That's consistent with the signal from a range of labour market indicators. For example, the vacancies to unemployment ratio has fallen back to its 2019 level, but that was somewhat higher than in the past. The information we are receiving from our agents is also consistent with the picture of an easing, but still relatively tight labour market. Second, this model cannot fully explain the current strength of wage growth, as shown by the residual. This excess persistence in wage growth is probably associated with continuing second-round effects of the past inflationary shocks. The way the persistence in wage and price inflation evolves from here is uncertain, and to help consider this, the MPC set out 3 cases for the economy in November, and I'll come back to these later. There are some signs that the process of wage disinflation may be slowing. This chart shows companies' expectations of wage growth 1 year ahead from the bank's decision maker panel. Firms expect wage growth to decline further, but their 1 year ahead expectations seem to have stabilised in the recent months. Last month, our agents reported that Contact's expected pay awards in 2025 to moderate to around 2 to 4%. We'll need further intelligence to assess where in that range we're likely to land. If we use the decomposition from the previous chart, assuming productivity growth of around 1% and a labour market broadly imbalanced, wage growth would need to be around 3% to be consistent with target. More broadly, there is large uncertainty around the labour market and wage developments. The labour market is subject to both structural and cyclical changes, and we are hampered by the challenges of the quality of data, in particular the labour force survey. There have also been recent changes to the costs of employment from the combination of the national living wage, the rise in employer national insurance contributions, and potentially the changes to workers' rights, although the size, timing, and interaction of these effects remains uncertain. So in September, the MPC set out 3 cases for how the economy could evolve from here. In case 1, disinflation is driven by the unwind of external shocks, and that will continue to feed through to pay and price setting. Just as inflation rose on the back of external shocks, even its more persistent components will revert to target as those shocks recede. If the economy evolves in this way, monetary policy restriction will need to be reduced more quickly. A large part of the disinflation process we have seen so far can be characterised in this way. There's been a lower cost in terms of output loss than many expected a couple of years ago. And disinflation has progressed faster than expected. 1 year ago, the MPC expected CPI inflation to be 3.3% in the third quarter of 2024, more than 1 percentage point higher than the outturn. In case 2, disinflation is driven by the unwind of external shocks, but the second round effects on inflation are more persistent than case 1, and so a restrictive monetary policy stance is needed for longer for inflation to return to target on a sustainable basis. Our published projection in the November NPR is based on this case for the economy. In this world, a continuing restrictive monetary policy stance and tighter fiscal policy are expected to open up a margin of excess supply, which will support further moderation in wages and prices. In case 3, deeper structural changes in the UK economy threaten to impart a more lasting inflationary dynamic, if not met with a longer-lasting restrictive monetary policy response. Case 3 is articulated on the basis of real income catch-up effects in the November NPR. If this dynamic persists into next year and perhaps beyond, there is a risk that, absent a policy response, workers and firms might start to adjust to a new normal of wage increases of perhaps 3.5% or 4% and price inflation closer to 3% than to target. That would be more costly to change if it became entrenched. Each of these cases is broadly consistent with the evidence to date, and the economy could evolve in line with any of them from here. I'll use this framework to talk about how I see the key uncertainties to the economic outlook, alongside considering broader risks to demand. Inflation may fall faster than expected, consistent with case 1, and there is a risk that the UK economy proves less resilient than expected to the ongoing monetary restriction and fiscal consolidation, and/or that there is a possibly weakening of the global economy. We've seen some slowing in other countries in Europe and need to be vigilant to it, as the UK shares some similarities with other European economies. And last week's flash PMIs for November may suggest some slowing in the UK too, although I don't take too strong a signal from a single release. Given the lags in policy, it would be important not to act late if the economy were to move in this direction. Alternatively, there's a risk that inflation is more persistent than expected, as is set out in case 3, and there's a risk that demand remains strong relative to supply so that inflationary pressures remain. A tight labour market would give workers more power in wage setting, and resilient demand would enable firms to raise prices by more than would be consistent with inflation sustainably at target. I view the probabilities of downside and upside risks to inflation as broadly balanced. But at this point, I am more worried about the possible consequences if the upside materialised, as this could require a more costly monetary policy response. The outlook for wages and services prices is unclear from here. We need to see more evidence that wage growth and services inflation will continue their journey down to target consistent rates. But there are some signs that the process of wage disinflation may be slowing, as I showed earlier, so it's too early to declare victory on inflation. It's often been said that the last mile may be the hardest, and this is where we are now. This is why I support a gradual removal of monetary policy restriction, and we'll be monitoring the flow of data over coming months so that we can calibrate our policy path as needed. So as part of developing our response to the Bernanke review and to help the MPC think more about uncertainty, we started doing things a bit differently over the past few policy rounds, and we made some notable changes in the December round. The aim was to help us think about economic channels underpinning the different views across the committee and consider the policy consequences and risks if the economy were to evolve in different ways. There were two main elements to what we did. First, bank staff simulated two alternative paths for how the economy may evolve relative to the baseline under different assumptions about the structure of the economy. The two simulations captured features of cases 1 and case 3, respectively, while the published forecast was based on case 2. Using the paths for a range of variables implied by these simulations, we looked at what the evidence from the current data suggested about how likely they were. We also simulated the monetary policy response that each of them implied using optimal policy projections, and we considered the consequence of following the policy path appropriate for one case if in fact it turned out where a different case applied. Second, we reconfigured how the committee spent its time and what the discussions were focused on. We considered the published forecast alongside the simulations. More committee time was dedicated to discussion about the ways in which the outlook for the economy could be different, how we interpreted the available data, and the implications of that for the path monetary policy should take. This was a small step in the broader direction of our response to Dr. Bernanke's review, which I'm going to talk about in more detail shortly. The trialling of some new approaches in November illustrated areas we want to develop our tools. The macroeconomic simulations were constructed using our standard forecasting framework, which isn't designed for the production of the central forecast and fully fledged scenarios at the same time. This meant that the simulations were stylized, and that's why they were set out in a qualitative way in the NPR. But despite these limitations, the analysis provided a helpful starting place for a richer discussion across the committee about how the economy may evolve and how to think about different possibilities and risks in policy decisions. I'll now move on to talk about the comprehensive and substantial reforms we are making in response to Dr. Bernanke's review. We are extremely grateful to Dr. Bernanke for his thought and his time. His review provides a thorough assessment of the monetary policy making processes at the bank. It is hard-hitting. In parts, it makes for uncomfortable reading, but we welcome it in its entirety. It makes 12 specific recommendations for reform, and we've accepted them all. Let me start by saying what's out of scope before turning to what is in. So the key elements of our institutional framework for monetary policy, set by government, will be unchanged. The current framework was set up in the 1990s, the inflation target and the formation of the Independent Monetary Policy Committee based around a diversity of views, expertise and experience, supported by expert analysis from Bank of England staff. This has been fundamental in anchoring inflation expectations and has served us well. But within this framework, we are reforming the whole nose-to-tail process of monetary policy making and communication. This will be the largest reform since the bank was granted operational independence for monetary policy in 1997. We will cover all, but not be limited to, the areas considered in Dr. Bernanke's review, and this chart captures the main elements of our transformation programme. So we will change our capabilities, including our data infrastructure and our modelling framework, the inputs into policy making, including the role of the forecast and scenarios and their underlying assumptions, the way the MPC discussions are structured, how we use these inputs to inform the MPC's policy decision, and how we communicate the policy decision, the outlook and risks to both financial markets and the general public. We will reform how we organise ourselves, our staffing levels, skills and incentives, and how we seek and use external input from academics, market participants and other experts, including those in this room. So, in the years following the introduction of inflation targeting in the UK, the economy was largely subject to shocks that our processes were well set up to manage. But in recent years, the UK has faced a sequence of supply shocks that led to a sharp rise in inflation. The scale and nature of those shocks has posed substantial challenges to forecasting, not just at the Bank of England, but for other central banks and the economics profession more broadly. The experience of more frequent and larger supply shocks has also underscored the importance of communicating uncertainty clearly and being able to do that in a range of circumstances. Dr. Bernanke's review pointed to the need to think again about how the MPC considers uncertainty and how it communicates the impact of that uncertainty for monetary policy. The interactions between the elements of the reforms are complex. For example, the recommendation to use scenarios to better understand and articulate the balance of risks around the outlook has implications for the design of the forecasting infrastructure, the internal processes of MPC discussions, as well as for our external communications. The 9-person MPC is made up of a mix of internal bank executives and independent external appointees, each with a vote. This builds a welcome and valuable diversity of experience into policymaking and is a strength of the UK's monetary policymaking system. However, it does make it difficult to apply an off-the-shelf approach from elsewhere. We need to think carefully to ensure that these reforms that we make the most of our unique institutional structure. I understand that you'll have lots of questions about precisely what the end state of this process will look like. These changes will need careful consideration, and we're going to take our time. And we want your help and the help of others to get it right. Let me start with how we will consider uncertainty. We will widen and rebalance our approach, placing less focus on a central projection. We will put more systematic analysis around how we consider risks to and uncertainty about the way the forecast may evolve, the way the economy may evolve, and around how to set policy considering those risks and uncertainties. We will build the use of scenarios into our processes, and we will loosen the link between the forecast and the policy decision and its communication. This was one of the overarching recommendations from Ben Bernanke. This is not entirely new. The MPC has always considered risks and uncertainties, and on some occasions, the MPC has turned to scenario analysis to improve its understanding of the inflation outlook. A wider and more systematic use of scenarios will allow us to better consider alternative conditioning assumptions and also different relationships between economic variables. Combined with data analysis, it will help us judge the likelihood of different views of the economy and to update our judgments of risks and uncertainties over time as the evidence evolves. It can help us to understand better the consequences of setting policy as if we are in one state of the world when in fact we are in another. We will consider and publish different scenarios for the economy on an ongoing basis, and we will look at how monetary policy might need to be different in those alternative outlooks by looking at policy paths which are endogenous to those scenarios. Of course, the devil is in the detail of how we design and practically apply these changes, and there are important questions we will need to work through. These include, first, what scenarios to choose. We will prioritise policy relevance in the selection of our scenarios and development, and we expect to be discussing a small number of scenarios at any given time. Second, who owns what? We'll need to consider the respective roles of the Monetary Policy Committee and bank staff in the forecast and scenario development. There will be more staff input into the baseline forecast, and this will free up MPC time for discussions of the economy, policy, and policy strategy. We will retain an important role for the committee in shaping the forecast and in scenario selection, cementing the link between analysis and policymaking. Third, how to use a broader range of inputs to inform the policy outlook. we'll need to develop our framework for how we combine these different inputs to best support the MPC's policy deliberations, how to bring together insights from conjunctural analysis, the baseline projections, scenarios, and policy analysis. And fourth, how to combine these approaches into clear, informative communication. Scenario analysis will help communicate the risk and uncertainty around the economic outlook. And it will provide an opportunity to increase transparency around our reaction function in different circumstances. But with many potential paths for key variables, there will be a premium on clearly articulating the outlook and the reasons behind the policy decisions. One important question is what interest rate path or paths we publish. We will consider whether to publish the forecast with a modelled endogenous path for policy, either instead of or alongside a forecast conditioned on the market path for interest rates. There are some calls for the MPC to publish a collective expected interest rate path or to provide a dot plot. As the Bernanke review explains, this is a highly consequential issue, and it's not as simple as it sounds. Publishing a form of expected path risks suggesting greater certainty about future rates than it is possible to give, which in turn undermines policy credibility. Given the scale of the potential changes, and that we are doing this alongside setting monetary policy in the coming months and years, we will test and trial our new thinking. The consideration of cases in the November round I've described was just an initial step, and I expect our approach will be and will look very different in the longer term. So we'll develop and draw on a wide range of models that capture the different uncertainties that we want to explore. We use models both to assess the current state of the economy as well as forecast its future and to simulate alternative paths and policy responses. No single model can possibly capture all the relevant features to perform even just one of those roles adequately. In particular, where there is large uncertainty about the structure of the economy, we need approaches that can identify the possibility of structural changes and their consequences. When there are uncertainties about economic relationships in the economy, we need tools and techniques that can focus on those variables. So we're investing in our modelling toolkit, reviewing, updating, and expanding our existing suite of models. This is a multi-year project and we are still designing our modelling strategy, but we've already made some progress updating our current core DSGE model Compass, as well as some of the semi-structural and more statistical models that currently support the forecast process. We're also developing a large-scale semi-structural model to complement that approach and help with modelling certain scenarios. We know we also need to invest in developing a set of more specialist models to allow us to explore the economics of particular mechanisms in greater detail, as well as the toolkit that enables us to do a variety of monetary policy simulations in different scenarios for the economy. One important question will be how best to synthesize this information from a range of differing models and approaches for monetary policymakers, and whether we can and should do that in a more systematic way. This is complex. Some other central banks are, like us, undertaking major investment in their modelling toolkit, and we will be able to learn from them. We know that the answers to all these issues won't be found solely in the bank, and that external engagement is part of an environment where monetary policy making is supported by a culture of continuous learning. We will consult with experts, academics, watchers, and market participants, and our international counterparts, and we are going to further consider the best way to do that effectively. In the meantime, I want to highlight two initial changes. There's a lot of expertise outside the bank on macroeconomic modelling. We want to draw on that. To start the conversation, we're introducing a new technical paper series and intend to begin a series of seminars on those papers next year. This will be our primary vehicle for documenting new models developed in response to the Bernanke review. And we'll also host a conference in the summer of 2025 to explore some of the interconnected issues I talked about around scenarios, modelling, and communication for effective monetary policy making. Another aspect we will build into the core of our approach is forecast evaluation. This will help us continue to adapt and update our understanding of the economy and to continually improve our modelling, analysis, and use of data. It will help us assess whether the scenarios we have considered were capturing some of the key risks missed by the baseline forecast, helping to inform future analysis. The bank already does forecast evaluation, for example, the discussion of forecast performance that appears annually in the MPR. And bank staff continue to produce relevant research in this area. Building on this, we can benefit from more formal and systematic quantification of the sources of past forecast errors. So we will introduce a new regular forecast evaluation report, building on the work that we have been publishing in the MPR. The lessons from this work will then be used to update our analysis and modelling. A core part of Dr. Bernanke's recommendations was around changing our external communication to better communicate uncertainty around how the economy may evolve and what that means for monetary policy. Dr. Bernanke recommends that we move cautiously in adopting changes to communications, and he is right, not least because of the importance of clear communication for monetary policy. A landscape with a baseline forecast and scenarios brings huge opportunities for communicating uncertainty, but also challenges on clarity. Clear communication is a key part of ensuring trust in what we do. By increasing understanding of our reaction function, it can improve the effectiveness of monetary policy. And we know that the simpler the communication, the better. Substantive changes to our external communication will take time. One challenge is how to communicate uncertainty in the best possible way. The fan charts were a major innovation when introduced in the 1990s, but I agree with Dr. Bernanke that there are better ways to convey uncertainty. Scenarios will help us here. They will enable us to provide narratives about how the economy may differ from the baseline projection and how it will differ from the baseline projection, why, and what that might mean. We will need to draw on the advice of others to communicate the degree of uncertainty and the balance of risks effectively, and that may include learning from disciplines beyond economics. So these changes will require a substantial improvement in our technology. This was Dr. Bernanke's first recommendation, and one to which he assigned a high priority. With technology changing rapidly and the challenges of recent years, we have slipped behind the frontier. Dated technology impedes the ability of bank staff to support the MPC because even some quite routine analytical tasks involve a great degree of manual processing. It also impedes our ability to draw on new and different types of data. Of course, data are the lifeblood of policy analysis, and we're all data obsessives. The evolving data helps us gauge the forces that are acting on the economy and are key to our assessment of the medium-term outlook and risks. This is an exciting area of innovation. For example, the digitization of transactions means high-frequency and granular data are increasingly available, and the technology to process such data is evolving rapidly. We have an extensive work program well underway. This is the largest modernization of our time series data capability in 25 years, and is part of a more general transformation program to modernize the bank's data infrastructure, including moving to the cloud and exploring how AI can make us more effective and efficient. We're taking a root and branch approach. One imperative is that staff and policymakers can quickly access the right data and understand its lineage and quality. And to this end, we are upgrading our metadata and data management tools. This is painstaking work. We have around 3 million data series to migrate, but it is essential to lay the foundations for the analytical technology that sits on top of it. We are developing a new platform that will provide a modern environment in which bank staff can develop and maintain models. We will be able to automate the running of models, the dissemination of their outputs, and the production of diagnostics on their performance. This will both save staff time and provide analytical flexibility needed to support our ambitions for forecasting and scenario analysis. As well as investing in our technology, we're also investing in people. I've been enormously impressed with the expertise, judgment, skills, and the dedication of bank staff since I joined the institution this summer, and I've seen a huge amount of high-quality analysis. In the near term, as we ramp up our technical capabilities, we are planning a sizable expansion in these areas, providing new opportunities for existing staff and through external recruitment. So come and be part of it and work with us. We will begin advertising shortly for senior positions, and we'll have more job openings to come. If you're interested, do get in touch. So let me conclude. The UK economy has made good progress on disinflation. The shocks that drove inflation up have dissipated, and inflation has returned to around target. But the more persistent components of inflation and uncertainties around how the labour market will evolve are cause for concern. So we need careful observation of all the relevant economic news and intelligence as we seek to gradually reduce policy restriction. We are making progress in responding to the Bernanke review, modernising our technology and time series data capabilities, and we tested developing some of the narratives for the economy and their underlying structures in the November policy round. But we have a long way to go. We are undertaking an ambitious and necessary transformation in our approach to monetary policy. It's big, and we're excited by the opportunity, and we're committed to seeing it through. We will put different stories about the economy or scenarios closer to the heart of policymaking and communications. These reforms will make monetary policy more robust to a wider range of circumstances. We are building the infrastructure to enable us to do that in a systematic way. We're testing as we go. Where things don't work, we will drop them or adapt them. I expect you'll see us experimenting with some things over the next year. It will be a program of continuous learning. This program is going to take some time to work through, years, not months. Some parts will move quicker than others, and as Dr. Bernanke recommended, some of the most visible aspects of the change program will probably come towards the end of the process. And with that, I'm happy to take some questions.
Thank you. Thank you so much, Deputy Governor.
Thank you.
Great, thank you so much. There was a lot in that speech. So we have 25 minutes. We'll talk for about 10, 15 minutes, and then it's the audience's time to ask questions. Deputy Governor, let me just start with the Bernanke review. So you say it will take years. I mean, is it a couple of years? Could it be longer, or are we talking like a year and a half?
Yeah, I mean, we don't know the exact time it's going to take. I would expect it to still be underway in sort of a year, 2 years' time. I mean, my point was 5 years. I'd be quite disappointed if we haven't finished it by then. But as I say, a lot of the aspects of the review, the interconnected nature of them, and doing them alongside monetary policy making at the same time is complicated, and it needs some serious thought. I think it would be a real mistake, to be honest, if we kind of rushed it to get everything sort of published by a certain deadline. I mean, the other thing I would just draw out is, although we're making this big reform program, a key part of that is building in the processes around continuous learning, around improving our toolkit continuously. So in a sense, while the program, I think, will be time limited, the approach of continuous learning and building that in will continue.
And what's your main priority or objective? Is it articulating almost the reaction function, or is it really giving a forecast about where the economy is headed?
I mean, it's really being able to make policy and communicate that policy with a greater exploration of the issues that uncertainty brings around how you are making policy and why. So I think there is an element to which this will be about just making it clearer what the MPC's thinking is, what are the things it's thinking about, what are the risks, the uncertainties as we see them, why that is affecting our decision as it is. And part of that is about a clearer communication of our reaction function, not just in what we see as a central case, but in other scenarios for the economy.
So if there are various scenarios, how do you know which one to prioritize?
Well,
we know what to prioritize.
As I said, what we're proposing to do is use sort of relevance, the sort of current economic environment, to help us decide what scenarios we look at, and sort of policy relevance. And we will clear, and this is why we will be clear, and this is why the communication is going to take some careful consideration, because the aim here is to provide more clarity about what we are doing and why. So we will provide guidance on, how are we thinking about these scenarios? Do we put probabilities on them? Do we think about how do we think about the consequences of them? I would say for me, it's not just about, what probability do you assign that you're in a different scenario, but really importantly, this toolkit will allow us to think through what is the consequence of that scenario, and what is the consequence of acting in a certain way if you might be in a different way. And so not just thinking about the probabilities of something happening, but also the impact.
Do you think the BOE will always use a market path for rates, or is there another path that you could, use?
We haven't taken the decision yet about how we will, what path we will use. I'd be surprised. We look very carefully at the market path. It's currently the sort of core to our forecast. I can't imagine a world in which we don't very carefully consider the market path. It's hugely valuable, contains an awful lot of information. Whether or not we always use that, for example, we will in certain scenarios consider endogenous paths, because of course, if the economy evolves very differently, the market path wouldn't be the right thing to look at. In terms of our outlook, we haven't yet taken that decision, and as Dr. Bernanke said, it's a very consequential decision. But we will be considering, all of the options in this space.
Can I ask about those PMIs, those ugly PMIs that you say, look, one figure doesn't make a trend? How do you explain them?
Look, I mean, I do think it's important that you don't spend too much time focusing on one particular figure. We are doing thinking forward looking about actually what are the pressures in the economy, the pressures on inflation. I mean, look, it was one set of data. I wouldn't put too much weight on it. As I say, you look around what we're seeing overall on prices, particularly service prices, wages particularly, at the moment. Those are the things that we are focusing much more on because they explain the underlying drivers, if you like, of inflation.
I think the bank took the view that the autumn budget was a little bit inflationary, but there was no clear view on the national insurance contributions. Now that you have had time to digest it, is that even more inflationary?
No, so we did, in our forecast, we set out actually what we expect in terms of the impact on inflation. I would say we did it the week after the budget, so we'll want to think about it a bit more. The national insurance contributions, I mean, look, this is a big policy change and it will have a large impact. Exactly what that impact will be is uncertain. We sort of took a view very similar to the one the Office of Budget Responsibility did, that actually you'll see the impact across a range of margins. Initially, profits, wages, prices, and over time that will change. I think what we will be looking to understand better is actually how are firms responding to that? How are they intending to respond? And later how they do actually respond. We are very lucky that we have this fantastic network of agents around the country talking to businesses. And one of the things they are doing at the moment is putting particular effort into talking to them about how they are thinking about the national insurance contributions, the consequences of that, as well as the other changes that we've seen in labour market policy, and also how that sits on this backdrop of what is happening in the labour market anyway. So what we'll be looking for is actually the intelligence we get from firms about what they're planning to, and then of course what they actually do, and reading that really, really carefully.
So is it difficult at the moment to model whether this goes into wages or prices or shareholder profit?
It is difficult. I mean, look, there's lots of this sort of standard economic approach to how you consider that. That's the approach that the OBR took. It's the approach we took. But of course, what's happening in the labour market now is very specific, and so you have to sort of see how will firms respond to the fact that we do still have a relatively tight labour market. It is looser than it was, but it is still relatively tight. There's a question about actually what firms' pricing power will be, and so the extent to which those different margins will adjust. So the economic sort of theory tells you a lot, the sort of modelling tells you a lot, but you also have to think about, well, what's happening currently, and it's putting all that together. So it is quite uncertain, but we hope we will get more information about that quite soon, particularly, like I say, from talking to firms about what they plan to do and what they expect to do. The early conversations we've had from that basically show quite a range of proposed responses, as firms themselves are clearly thinking about how they will respond. And of course, it will differ hugely, firm size, sector, all of those sorts of things.
And add to that potential tariffs from the US. And how often do you get asked about this? Like what, we're looking, I mean, we don't know what the policy will be from President Trump when he comes into power, but we're looking at possible 10 to 20% tariffs across many economies, including this one.
Yeah, I mean, well, we get asked about tariffs a lot at the moment, certainly in the last couple of weeks. It's, I mean, look, the specifics of what actually the policy will be, we're going to have to wait and see. You're right, there've been some discussions, some indications, but let's see what the actual policy is. I think there's a couple of things I would say in terms of how we think about this. So, this is a room full of economists. Everyone, there's a lot of agreement about the impact of tariffs and all barriers to trade actually on growth, and productivity. I think that's well known, well established, the sort of direction of travel, and that is what you would expect if you were to see big changes in tariffs and fragmentation of other forms. On inflation, actually, it's a bit less clear. So obviously, growth and productivity give you a direction in the long term, but in the short and medium term, actually, it depends a lot more on how other countries react. In particular, in this case, it would be really important to the UK and how the UK thinks about inflation, how other countries react if there were to be tariffs, and of course how exchange rates change as well. So quite a lot of uncertainty about how it would feed through into our sort of shorter and medium term thinking. But again, something we'll be looking at.
So if they get put in place, it doesn't automatically mean higher for longer, given also that extra mile in fighting inflation.
Yeah, it doesn't automatically mean anything. We'd need to think through quite carefully and have a look at the specifics of what both the US does and other key trading partners for the UK do.
R-star, is that is it still between 2 and 3%? Is it movable?
It definitely moves, and is likely, given all of the shocks and the changes in the economy, is likely to have moved. We haven't done an up to date analysis, and don't have a kind of estimate that I can give you today. It's clearly an important factor in our thinking, but at the moment, we cut rates in August. We cut them again last month. We're comfortably in restrictive territory at the moment, and we have some way to go. But of course, as you keep, as the circumstances evolve, we will look at R-star more and consider it more. It's clearly a big debate and discussion, but we haven't updated our previous estimates. I mean, as you say, the sorts of numbers that you are talking about are more in the thinking of where you would anticipate it to be. We don't think you'll go back to the world that we had of very, very low R-star.
Is it useful for markets and economists to put a number on it?
It's a good question, actually. It's definitely a very useful sort of concept. Right? It's certainly a very useful concept. I mean, the risk, I think, with putting a number or very specific, I mean, there's a point estimate will get you nowhere, but even ranges and stuff, I think the risk is twofold. One is it gives a sort of false sense of certainty, I think. I think it's always hard. And one of the things, a big sort of underlying theme of the reforms we are making is around uncertainty. And R-star is just another one of these things that you're ultimately incredibly uncertain about all the time. And so if you start putting a number out there, then there will be some people that will interpret that as, oh, well, that is actually, where you're heading for, or it's where you think, and actually you just don't know. Right. And all the time you're having to update your view and try and think about the uncertainty in the economy. So, I think there is a risk if you inevitably and understandably people want to latch onto numbers or tight ranges. And I think that just gives a bit of a sense of, I think the uncertainty is greater.
Great, thank you. So we have about 13 minutes actually for questions. Yes, we have 2 there. We have a lot of hands, which is great. So let's start by, could you say where you're from and who you are? Sure. And just keep everyone the questions short so we get through as many as we can.
Yes, David Marsh from OMFIF. You mentioned the PMIs. Of course, there have been some very dire PMIs from Europe in the last few days, and the German economy really has fallen off a cliff since June. And so this is really quite up to date. Do you think that Britain's become less dependent on all these European economies because of leaving the EU? And so is it a good thing from that point of view that Britain may be less hit by all that's going on in the rest of Europe?
Thank you.
We're very interested to have your views on that. Thanks.
We're actually going to take 2 questions at the time, if that's all right. So that, because I saw a lot of hands. Yep.
Theo Morris-Clark, I'm an economist at Rockos Capital. Thanks very much for the speech, and you very helpfully set out some of the things that we can look for to tell if we're in the different cases. So you mentioned that if wage growth is coming in at 3%, that looks inflation target consistent. If it's 3.5 to 4%, I think you said that looks more like case 3. How does the MPC think about that next year when you have an employer NICs increase that is maybe affecting your signal abstraction problem? And does the employer NICs increase mean that 3% is no longer target consistent, and how will you think about that?
Sure, thank you.
I'll take them in order. So you're right. Look, it's clearly a very challenging economic environment in Germany and actually other parts of the Eurozone. The UK economy remains incredibly tightly connected to the European economies. They are by far and away our largest trading partner, and so actually we're not. That has an impact on us, and will continue to do so. And of course, it's not a good thing for the UK if European economies are struggling. Will feed directly through to us. And you haven't seen massive changes, as you know, in the data in terms of those. relationships. The other way I think it's also important to think about it that I mentioned in my speech is actually the British economy is in many ways quite similar to a lot of European economies. And so, it is useful for us to look, it's always useful to look at other economies to try and understand what's happening in your own economy. And so we are also watching very, very carefully what's going on in Europe to see where actually we may be having similar trends, whether they are structural or cyclical, going on in the UK. But it's certainly the case that a weaker and slower Europe is obviously a challenge for the UK economy and will slow growth here. On the question about wage inflation and NICs, I mean, look, what's target consistent on wages basically depends on productivity, effectively, and that's what you're looking at. Now, it is possible that the NICs changes might affect productivity. It's one of the margins of adjustment. I mean, it's probably not the main one, but it's possible that you would see some changes there. It is definitely the case that policy change in the labour market on top of what is a very uncertain labour market position as it is, and I would draw out both structural changes to the labour market and cyclical ones at the moment, make it quite difficult to judge what is happening in the labour market. It is why it is, if you ask me what is the one area you would like more information about, and if you'd like to really know what's going on, it is the labour market. We still don't know what the long-term impacts of COVID will have been and how that will have changed, and other factors changed the structure. There's a lot of uncertainty about the economic cycle at the moment. And then we do have policy change, NICs, living wage, others, on top of that. So it is quite uncertain, and that will make the kind of signal extraction problem very challenging going forward, but we have a lot of data, a lot of information that we use to extract that as best we can.
Thank you so much. I have two questions at the front here, and then it's like Barry's boot camp for the microphone holders. We're gonna go around the room.
Yeah, thanks, Jumana Salihin from Vanguard. So thanks a lot, Claire, for your outlook, and also very excited about the changes ahead. I guess one question that I had was, is there a risk that when we focus on uncertainty, that we could actually muddy the water? And grateful for your thoughts, because sometimes, people do look to the central bank to provide clarity and give guidance, and as such, reduce noise and uncertainty. Thank you.
Thank you so much. And then a second question here.
Hi, thanks. It's Catherine Nice from Pigeon Fixed Income. So I had two questions, one on the conjuncture and one on the Bernanke review. So on the conjuncture, there was a recent paper came out in the Resolution Foundation that showed that employment could actually be higher, inactivity looking a little bit less bad. So maybe if we think that the inactive could move into the labour market, it could be that the UK labour market's even tighter than we think. So just interested in your views. How does the Bank of England think about this report? And on the Bernanke review, you talked a lot about the importance of communication. Do you think that the bank is going to follow what the ECB do, what the Fed do, and have a press conference after every meeting? Or could we see a shift to a CPI measure with owner-occupied housing, which is something many years ago the Bank of England did talk about shifting to? Thank you.
Okay, a lot in that. Let me see if I'm trying to remember. Let me start with Jumana's question. So, look, you're absolutely right, and we are very, very conscious of the fact that clarity in our communications is absolutely critical. We are heavily watched. This conference is a good example of that. But actually, more importantly, setting policy for millions of people, millions of businesses up and down the country, and it's very important that we can be clear. Now, you're right in talking about uncertainty. How do you square off talking about uncertainty with that clarity? I mean, the reality is things are uncertain. So there is no point in us giving a false sense of clarity about what is going on. We have to be clear about the uncertainties as we see them and what that means for policy. This will be a question of actually, how do you do that with a small number of scenarios? How do you do that with a central the central outlook as well, and the way in which we explain that. Hopefully what this gives us the opportunity to do is give a sense of, look, we think the economy is like this, but if this were to happen, or it might evolve in this way, and this is how we would think about that, and this is what we would be looking at, and this is what we might do. And hopefully that gives people a clearer sense of actually what our reaction function is, but also the risks as we see them, and can sort of, alongside us, track how that data is evolving and how that looks. Does it look like those stories are right? Does it look like they need to be adapted? So hopefully you'll just be able to give a bit more of a sense of uncertainty as we see it. But we are very conscious that you have to be very clear about what it is you're saying and why and how that is linking to your policy. And that is one of the reasons why I think we will come. The communications changes will come later in the process, and also why I am keen that it's a bit, is this risky, is this not, test some ideas, see how it goes, get feedback, because really, we have to think very carefully about how this is being received by the people we are communicating to. We are communicating to a lot of different audiences at any one time, and that also needs quite careful thought. Now, let me see if I can remember your questions, Catherine. So on the conjunctural question about the Resolution Foundation report, we read that report with a lot of interest. We have done some similar analysis using the same sorts of data. We've spent the issues and challenges around the labour force survey are particularly well known, and they are particularly challenging around the quantities. It's the quantities issues, and particularly around participation, right? Because all the other bits of the quantities, actually, we can get other data and we can try and sort of square off against that. You've got unemployment data, you've got admin data on who's actually in employment, those sorts of things. Participation is a lot harder. What the Resolution Foundation did, like I say, we've done similar things. So we weren't sort of surprised by their sort of results. It is possible that actually it turns out participation is higher, economic inactivity is higher. Of course, that the flip side of that is not necessarily great, because if you've got more people in the labour market, productivity issues go the other direction. But look, it is possible that is the case, and that there's more people in the labour market. And look, that would be a good thing in terms of having more people participating in the economy. And it's one of the many things we have to look at when we think about how tight is the labour market really, and what are we seeing that doing, and how that is feeding through into wage pressures. And that is, like I say, just remains very uncertain. I think you had a question about the measure of inflation. I'm afraid I'll give you the standard answer to that, which is not for us to set the inflation target. The government does that.
Okay, 2 more questions. Yeah, we're there in the middle. 2 gentlemen. Yeah.
Hi, Callum Pickering, Peel Hunt. Suppose the recommendations of the Bernanke review had been in place ahead of the 2022 gas shock. How would you expect bank rate, inflation output, and inflation to have developed differently? And specifically, is the bank implying that it would have preferred a situation where inflation rose by less, even at the cost of higher output and employment losses?
Yeah, second question.
Thank you. Krishna Guha with Evercore Partners and formerly the New York Fed. Very interested in obviously how you're developing this practical implementation of scenario analysis to policymaking. It strikes me there are many challenges here. 3 obvious ones spring to mind. First, how do you bring discipline to the process of learning which scenario you're on? Secondly, how do you articulate a coherent reaction function across the different scenarios, which, by the way, has to include some kind of embedded assumption about R star, among other things, whether you're doing optimal control or some other appropriate policy setting? And thirdly, how do you actually set policy relative to a range of different scenarios? Is this a question of robustness? Is it loss minimization? Or is it just a way of trying to structure risk management? So I'd love you to drill down, if you can, with a little bit more granularity on each of those 3 points. Thank you.
Thank you. I have a lot of questions to go through, so maybe just a quick granular analysis.
Okay. Look, your questions, let me start with that, are absolutely the sorts of areas that we are thinking about and looking at now, right? And this, I think, is the space in which the Bernanke review provides huge opportunities for us to think about, right? Actually, how do you think about risk? How do you think about, what is your loss function, if you like? What are you sort of optimizing for? And different people have different approaches there. And there's a lot in the literature. There's also, a lot for us to think about in how you do that in our particular framework. But the questions you ask are exactly the right ones. And they are, because they are complicated, is precisely why I didn't come here today and say, here's precisely what we're doing. We're going to do a lot of work on those. As I say, come and be part of it. People want to come and work on that. Come and work with us on it. This is exactly the sort of stuff we'll be doing, talking about in our conference next time. We've thought about it quite, we are beginning to think about it in an interesting way. We tested some ideas this time, which is, if you were in this world and you did this, what would be the consequence, and vice versa. We need a wider toolkit to do it with much sort of systematic and a systematic approach, but it's exactly the right sort of questions. We don't have, I can't give you answers on them now. On the sort of hypothetical question, what if? I mean, the communication probably would have looked a bit differently, because, it will look quite differently. I'm not going to speculate about policy. The bank, like all central banks, responded to the situation at the time and followed the policy that was necessary at the time with the information that they had. I'm not going to speculate about what if. It is clearly the case that had monetary policy been tight enough to have held, inflate, to not see those massive, huge rises in inflation, the output cost of that would have been huge. And I think that's been well covered elsewhere. So I'm certainly not, speculating on that.
Okay, 2 more questions, maybe. Yeah, gentleman there. Let's take 3, 1, 2, and 3.
Brilliant. Thanks, Claire. Jack Meenan from Barclays. I guess just 2 related ones on the forecast. First, in terms of ownership, you kind of touched on it slightly, but when we get to February, what is the ownership of the forecast going to be? Is it going to be a staff-owned one with MPC input, which is kind of what it sounded like you were describing? Is it going to be an MPC best collective judgment or somewhere in between? And then with the point you made about decoupling the central forecast from the policy decision, I wonder, how do we think about value added of that central forecast now? Is it kind of a best empirical kind of guess at where the future is going to be? Is it just another scenario that happens to be the one that gets most probabilistic weight? How should we think about that central forecast now as BOE watchers? Thank you.
Sure.
Thank you. And then, gentleman there.
Thank you for the presentation. Should we think about the skew at the quantitative summary of the 3 scenarios? You mentioned that your probability of the scenario 1, scenario 2 are the same, but you're more worried on scenario 3. So should I think about skew? Should we think about the skew as probability times impact? So the view of 0 skew means on average, the MPC thinks everything is balanced around the scenario number 2. Thank you.
Thank you. Let's take 2 at a time.
Yeah, take 2.
The last one was going to be really good, but we'll take it afterwards.
Because my memory's not good enough to this. Right. So whose forecast is it? I think it's just a really sort of fundamental question. One of the first things Ben Bernanke said to me when I went to see him after being appointed was, don't lose the committee's involvement in the forecast. It is hugely valuable that you've got these really expert people owning and being involved in the forecast, right? So there's an interesting, at one extreme, you could go to either extreme here. His advice was, don't lose the committee, so don't have a solely staff forecast. And I see what you're saying there, and I can see a lot of value to it. The committee, if you sit in these discussions, they have huge value in the way in which the forecast is put together, and you've got a lot of expertise there. So that is super helpful. It is, though, definitely the case that we would like to have more staff input into the forecast. We did that in November. So just giving the staff more sort of freedom and time to sort of go away and not getting into all of the detail of all of the judgments with the committee. That was helpful. It also freed up a lot of committee time to talk about other things. So that was definitely good. So I think we're sort of on a journey there. As I said, it's going to take a long time. So, I suspect in February, it will look and feel quite similar to how it looked in November. And you'll certainly, I don't know, and let's see where we get to, but I think it unlikely we get to a situation where you just have a sort of staff forecast as an input only. I think you will always have involvement of the committee and the forecast and scenarios being a part of the communications, an absolutely critical part. And it's how the committee communicates its policy as well, through, forecast, through scenarios, through all the other communications that we do. So I'm afraid I don't think it's totally binary, and I don't think it should be, if I'm honest. On this question of sort of probabilities and cases, and actually I think this links a bit to the previous gentleman's question. Apologies, I forgot your name. I think, what I wouldn't do is I wouldn't think of this as some kind of spectrum and, you're at one end or the other and you put a probability of where you are and your vote naturally maps onto it, right? I wouldn't think about it that way. And that's not how we are thinking about scenarios. We are thinking about them as that actually, how could the economy evolve in a different way? What might be going on in the economic relationships in the economy? They won't necessarily be linear. It turns out at the moment we have a case that has inflation would be higher and inflation would be lower, but it won't always be that sort of circumstance. It's not the case that you plot your probabilities and you can read your vote off it. I do think and a bit to the question before, it's not right to think of these as kind of, this isn't a sort of big Bayesian updating exercise, right? Where we've got some cases and we map the economy against them. At some point, maybe we drop one or we change one or whatever. It's much more about actually, if you think about policy and if you think about the risks as you see in the economy as to what might be happening differently, what are the economic relationships that are going on there that are quite different? And how does that affect how you understand the economy and what the right policy would be? So it could be, at the moment, we've sort of model them in a certain sort of way, but we could do that in a very different way. So, we will think about probability, we will think about impact, but it's not the case that this is some sort of, spectrum. You just have to, if you just know where everyone is on it, you can work out what's going to happen. This is much more about how do we see different risks in the economy? How are different people thinking about those, and why? And what does that mean for policy?
Thank you. Final question.
Yeah. Jakob Lavert for Swedish Handelsbanken. So, for example, the Swedish Central Bank have highlighted one of their main challenges in the inflation prediction was that sort of historical patterns suddenly changed, for example, corporate pricing power. And I was wondering a little bit in sort of when one builds a sort of framework, what is your thought of how to incorporate this when sort of historical patterns break down? Is it to have different scenarios? Is it to have sort of more robustness? In what direction do you see this going?
Yeah, it's a really good point, and I think one of the areas that we will get most benefit from this sort of wider approach, we're looking at things like our modelling suite and looking at models that can particularly can do better at sort of turning points and structural change, and that was one of the areas that Dr. Bernanke drew out, was kind of actually modelling of the structural side of the economy and understanding of those sorts of things, and changes are a big area we want to focus on and look at. I mean, look, it is just incredibly difficult, right? That's the sort of hardest thing, but I think it's one of the lessons of the last few years and the sorts of shocks that we saw on the supply side, the structural side of the economy. It just shows actually we need to have more capability in that space to be able to respond to those shocks. But we're looking at a wider range of models, and we can talk to you about if you want, that sort of help and have better properties in those kinds of environments.
Wonderful. Thank you so much. That's time. We're a minute over. Thank you so much for all of the insight. Claire Lombardelli there, Deputy Governor of the Bank of England, and applause, and then I'll give it back to Dave.
Thanks a lot for coming today to this panel on inflation dynamics. My name is Claire Jones. I'm the Global Economy News Editor at the Financial Times, and it's my pleasure to be moderating this session with three extremely well-qualified speakers. To my immediate left is Ricardo Reis, a professor at the London School of Economics. To his left, we have Ben Nabarro, Chief UK Economist at Citi. And to his immediate left, we have Swati Dhingra, an External Monetary Policy Committee member at the Bank of England. We're going to begin with talks by each of our panelists before moving on to a panel discussion and then ending with a Q&A. Without further ado, Swati, please take the lectern.
Let me check before whether it works, since there's always a technology problem when there's anything related to the bank. So you've heard enough about that today morning. So I'm going to go straight into inflation dynamics. And one of the briefs that I was given was to think a little bit more about how different countries have had different experiences during this episode, and that's what I'm going to try and bring out, some in more detail, some in a little bit kind of broad stroke analysis. So let me start with actually laying out the groundwork for this, which is that the kinds of shocks that we face, both globally as well as sort of the more localized shocks that were faced, were actually quite different in nature, both for the UK as well as the EA. I've put US on here, and I don't really want to compare the US and the UK scenarios for the reason that the US looks really very different. So instead, I'm going to try and keep pointing out to you where the UK might look different from actually the Euro area as well. So broadly speaking, the energy shock that we faced was much bigger. It peaked for a much longer duration of time. And therefore, it's not that surprising that when we saw the inflation dynamics unfold on consumer prices, services, etc., that those were more prolonged, possibly slightly delayed, but then longer as well. The second thing I want to point out is that the consumption trends, by now this picture has become very famous, was actually first floated around by Silvana to all of us very, very early on, which is that the consumption trends were looking very different. And that just shows that the responses to the inflation shock were actually quite different as well. And the final thing I want to point out is that coming out of the pandemic, the adjustment that the economy was going through to that very, very, very sharp, sudden recovery that happened after the really sharp downturn was actually pretty pronounced in the UK and definitely more pronounced than what it was in the Euro area. Again, not particularly surprising given the very different nature of the labor market institutions in those two countries. And from there, I'm going to also just sort of quickly point out that much of the labor market sort of turning point arises actually a lot before what we think that, when the monetary transmission mechanism comes into play. So a lot of it is still very much the recovery period that's playing out. The next thing I want to point out is actually go to my first picture that I showed you, which is about the energy price shock. This pure global shock that happens, hits all of us, but hits us much more than anyone else. And I'm going to say not only was actually the intensity of the shock much higher for the UK, but also the exposure of the UK economy to energy prices from abroad is actually much more than, say, for the Euro area even. And this is what's being summarized in that pie chart. What the pie chart is showing you is, I'm going to give you a very straightforward example, and then I'm going to say that translate that into the entire consumption basket, and that's what this pie chart is doing. It's saying, think of a loaf of bread. Most of you buy your bread locally from a domestic shop, domestic bakery, but actually the oil or the wheat that's going into that bread making is really largely coming from abroad and primarily from, say, Ukraine and Russia, which are the bread baskets of the world. So, of course, if you start counting up the exposure that comes through those intermediate inputs that are embodied in the consumption basket, you end up with a very different picture than the numbers that we were originally looking at, which were things like 3.6% is the exposure of the consumption basket to energy. Once you factor in the indirects, you're basically looking at somewhere around 8%. If you also factor in that we're a small open economy, very reliant on imports, particularly of things like food, which are very important for the consumption basket, you're basically looking at a number somewhere around 40%. So 40% is our exposure to energy and to imports excluding energy. Just in terms of ballpark, these things are very sort of time consuming to do, so I can't really immediately replicate them for the Euro area and for the US. That would be a very, very ambitious project. But unfortunately, those are not the resources we have on hand day to day, and definitely not in real time. But I can get a somewhat comparable number for the Euro area for just what their total energy exposure is, which is 5% compared to our 8%. And I think in terms of imports, it would be fair to say that we're probably going to look more exposed as well, largely probably coming from the food side. The second chart, or to your right, shows you how important these global shocks were and how specifically we were so exposed to those global shocks in terms of sort of what is their contribution to CPI inflation. And the blue and purple parts of the bars here are really going to be energy and imports, while the orange stuff is what most of us are really usually concerned about, which is domestically generated inflation coming largely, in this case, from the labor market side. There's also some amount of yellow, which is the gross operating surplus. So again, you can take all of the various sort of 85 CPI indices, you can map them onto how their production is done through supply-use tables, and then you can use the very specific how much are workers paid in the bakery sector, and put all of that information together and then decompose how much of CPI inflation in 2022 was driven by energy and imports as opposed to wages and the gross operating surplus. I'm not going to take a very hard stance on gross operating surplus for the reason that most of us just really don't know how to measure profit margins very well. So this is really the residual price minus the cost that we can account for. So broadly speaking, what I want to point out here is that CPI inflation, about 75% at this point, was really driven by energy and imports. So it was not something which was domestically generated. There was some component of it, but a large fraction of it was really stuff we were importing inflation from abroad. If you look at services and core services, it's a nice summary measure to look at because, of course, the labor exposure of services is much higher than the labor exposure of goods. But that being said, at this point, even in services, you could see a very substantial component of energy and imports. Think catering services, for example, or which would have both a food component as well as sort of other labor factors. And the second thing I'm going to show you is that this wasn't true just for, we think in terms of our exposure on the goods side, but even in services, we tend to be much more exposed than the euro area to these shocks from abroad. And that's what this chart is trying to show you, the pie chart. The comparable figure I can get for the euro area is 4.5% direct total exposure to energy, while for the UK already that's about another sort of 6 percentage points. So in that sense, a lot of the numbers we were looking at were very contaminated with this imported inflation. Come 2023, we're going to start to see this picture change somewhat. So by this point, energy and imports are 50% of the story, but still pretty substantial. So this is not just about domestically generated inflation, but of course, if you get a shock, which is something of the order of 10% CPI increase, it's almost untenable to think that there wouldn't be any kind of second round effects. There has to. You can't expect to see a real wage cut of 10%. And consequently, what we see during this period then is the orange bars becoming relatively bigger, showing those second round effects starting to manifest themselves. And if I go over to 2024, this number is going to go, so it went from 75% to about 50% and now down to somewhere in the range of 36% by 2024 Q3, but still present, the energy and import component, and how long that will take to wear off is of course going to depend on, that's what we're here for, to think about those sorts of issues. And my guess is going to be based on some of these things that I've been looking at, which is through the lens of the supply use tables and our dependence on imports. I'm going to go from here to showing you some of the other things that are going on and then kind of wrap up from there afterwards. So of course, as these pipeline cost pressures have waned, so has headline inflation. And that's not particularly surprising. That's what you would expect to happen. I think most of us were worried early on that might be a very asymmetric process. But at least looking at some of the CPI outturns that have come in more recently, it doesn't look like we're seeing the kinds of asymmetry that we were really worried about. The second thing that I want to point out is that supply chains have played a really important role during this period. Typically, producer prices will get affected by these external shocks more quickly than consumer price inflation because there's still another step in that supply chain to go from producers to consumers. And that's a little bit what we see during this episode. That what I've done here is in the leftmost chart that you can see, in the orange line is the CPI weighted PPI, which is to say take the entire consumption basket, take all of the PPIs that are available to us as well as the services PPIs, and weight the PPIs in exactly the same way that the consumption basket assigns weights to different parts of the consumption basket. And once you do that, you see this very, very tight correlation between the co-movement between the two, and the PPI tends to lead the CPI. And up till now, the sort of good news is that it has been sort of dipping down, the PPI, as well as the CPI weighted PPI. There's somewhat of a slight slowdown that we're starting to see in services PPI. If I were to just take out all household services, housing services, and only focus on services PPI, but in large part, that seems to be driven by erratics. We've all heard about how you must discount the airfares that are going into the consumption basket because those tend to be very volatile, and that's something which is seeming to get reflected in many of these things, many of these indicators which are forward-looking. And finally, I want to show you some of these services inflation pictures. In June 2023, that was the period when the bank voted with a jumbo rate hike of 50 basis points. And at that point, this was already something which was sort of appearing in the data, but I think that's got much more crystallized now over the past few months, which is starting to show that we're not looking like really an outlier. We're starting to look very much in the middle of the pack as far as most advanced economies are concerned. And that's sort of still, there's some way to go in terms of how quickly services inflation normalize, but broadly, we're starting to see that sort of scenario unfold. Going forward, I think there are three things I would sort of think about. One is that in terms of how restrictive policy is, up till now, we've still had some buffer from the pandemic fiscal support that was given out, as well as the general energy support that came out during this period. But now with higher rates, as well as with sort of some of that buffer pretty substantially depleted, I think now it really is going to start to weigh more on the investment as well as the consumption side in cumulative terms, not in terms of growth rates. As far as geopolitical tensions are concerned, I'm sure we'll talk much more about them, but broadly speaking, I think that does pose serious risks if there is another sort of substantial escalation that ends up translating into a bigger energy shock than we've seen till now. I think that would be really that would be something that we would have to think very seriously about. And finally, I think we're still in that situation where there's not adequate data, particularly say if you were thinking of inactivity, or if you were even thinking of some of the erratic components of inflation, those numbers those sample sizes have shrunk there as well, and that's causing more and more volatility for us to make it harder to gauge what's happening in the future. And I think that becomes really important now, particularly given that these insolvencies are starting to tick up and some of those cash balances are starting to get drawn down. So I think that's what I would worry about in the future, but hopefully some of those of you who might have connections to the ONS will help us do a better job with that. I'll stop here. Thank you.
Thank you so much for those opening remarks, Swati. Much appreciated, and given some insight into the nature of the UK inflation shock. If we could now turn to Ben, that would be great.
Brilliant. Thank you, and good morning. There are 3 points I want to make in these sort of brief opening remarks. The first, inflation dynamics over the last 12 months do, I think, look increasingly benign and should provide a reasonable basis for reassurance. Second, the fact that the wage Phillips curve doesn't seem to have steepened, despite some extreme labour market outcomes, is an interesting finding, and I think speaks to a potential state contingency, depending on whether slack is driven in the first instance by supply or demand factors. And third, if the consensus view of more frequent supply shocks is something that we're going to see come to pass, then recent experience does, I think, speak to potential benefits in rethinking the balance between the use of monetary and fiscal instruments that are employed in response. So let me start briefly with recent dynamics. Echoing very much what Swati's already said, the inflationary surge in the UK since 2021 has primarily reflected this sequence of extraordinarily large overlapping supply shocks. These are shown for the consumer on the left-hand side in relative price terms, beginning with the surge in industrial goods prices in 2021, moving then, of course, to energy, food, and latterly services. The impact has been especially large, as Swati mentioned, so combined energy and food CPI, for example, increased by about 50% cumulatively in its peak in 2023 from 21. That compares to around 30 to 25% in Germany and France. Now, the right-hand side shows an indicative model-based decomposition of that surge. Again, as Swati mentioned, the story here is one of large cost shocks and large aftershocks. But what's, I think, particularly significant here is we haven't seen domestic slack really make a particularly large contribution. And this, I should stress, is relatively robust to most model-based decompositions. Now, the persistent risk associated with these shocks primarily reflects the difficulty associating such a large reduction in real living standards in a very short period of time. First round inflationary shocks have inevitably resulted in secondary ripples, but this has also resulted in a period of both strong services inflation and high wage growth. And that suggests some economic contestation over who bears the ultimate economic loss. Now, the good news as I see it in the last 12 months is we have seen that conflictual process begin to decay relatively organically. So we have seen, for example, wage growth remain broadly in line with its post-1997 norms. So the left-hand side chart here, for example, shows a decomposition of wage growth compared to modelled estimates based on a 1996 to 2019 period. As you can see, there's actually a slightly more, a marginal negative residual on that model compared to the realised outturns. And then the right-hand side shows the developments in price quote terms of the CPIX index, obviously an enormous acceleration in the rate of price changes through 2022-3, certainly something of a concern, but since then we've seen, at least across the index as a whole, a significant normalisation. Now, concerns here are not entirely expunged, I appreciate that. As the Deputy Governor said this morning, the DMP, some price quote changes in the services index give some cause for concern. But if the big questions here are, have we seen a meaningful structural break, and that to the degree that we might have done, is that persisting, the risks do now appear to us to be significantly reduced. Instead, the UK's core wage and price setting institutions have held in, and that in turn has penalised and enabled an organic process of decay. Turning to the Phillips curve, obviously tremendously interesting, I think, throughout this period, and the contrast with the US is something that probably isn't commented on enough from my perspective. So the left-hand side here shows the rolling 10-year correlation on a simple wage Phillips curve equation. Clearly in the US case, you see a pretty large steepening as we come out of the pandemic. The UK, by contrast, seems to have remained relatively flat. What's interesting from my point of view in this is it may reflect, again, as I mentioned previously, some important differences in whether slack in the first instance is driven primarily by strong demand, or by weak supply. So in the US, extremely low slack was, of course, driven by very strong demand. That meant a tight labour market was expected to last. And that should matter for wage growth today in terms of the impact on bargaining power and the transmission into wage growth, hence the steepening that we plausibly saw. The UK, by contrast, of course, saw very tight labour markets, but on the basis of weak supply, Resolution Foundation findings or not. And in that sense, you may well think that the transmission was a bit less. So the right-hand side chart shows a simple SVAR decomposition, looking at the impact of a 1 percentage point reduction in V over U, in a context where it's driven in the red or associated with improving or falling unemployment expectations, clearly a much larger impact of slack onto wages. The light blue shows the impact similarly when actually unemployment expectations are increasing. Now, I appreciate Phillips curve estimation is a tricky business at the best of times, so this is intended only humbly, but nonetheless, I think it's plausible to think we may have seen evidence of something of a state contingent difference here. Turning to what that means for policy, a flat Phillips curve obviously implies a harsher trade-off between wage inflation and output in the event of a cost shock. And actually, I think the picture vis-a-vis the price Phillips curve is plausibly even worse than that implied by the wage Phillips curve. The reason, in my view, is that markups in the UK, I think, show reasonable evidence of being counter-cyclical on a monetary policy innovation. So the two charts I'm showing here are taken from a proxy SVAR model applied to the UK over the 1998 to 2019 period. Here the model uses 20-minute windows or market moves in 20-minute windows around both policy announcements and speeches as an instrument for the one-year gilt rate. And generally markups here, simply measured as the inverse of the labour share, seem to increase markedly in the event of a contractionary shock. Now here again, plenty of reasons for humility. The measure of markups, as Professor Dinger mentioned, is a very, very tricky econometric problem. But here what I would say is, to the degree you start to use a markup measure that's a little bit closer to the marginal unit cost of labour rather than the average, this counter-cyclical picture becomes more and more aggressive. So in that sense, the trade-offs facing monetary policy look very difficult indeed. So, if fundamentally the aim of policy in the event of this kind of conflictual inflation is to discipline both real wage demands and firm markups in a way that sort of effectively pulls the economy back into line with an impoverished reality, then the output inflation trade-off implied by these differences is very, very severe indeed. Now, of course, that may imply reasons for policy to be somewhat patient. At the same time, you could say that if the institutional risks grow more severe, this may imply a huge amount of rates volatility. And I think you have to see both sides of that risk. What are the conclusions from all of this? Well, here, just in the spirit of discussion, I'd offer three very brief final observations. The first point, I think, is we should take some considerable heart from the fact that we are seeing inflation decay and underlying inflationary processes normalise in the UK. I think that's, contrasting with the 1970s, a remarkable success for monetary policy dominance and something that policy should be reacting to. Increasingly, I'm not necessarily sure, given the normalisation that we've seen, that it's obvious that there's an asymmetry in cost between further inflationary overshoots versus the potential downside risks around the labour market. And of course, bolstering policy credibility is best served by seeking return inflation to a 2% target on a sustained basis. To my mind, it now makes sense to pursue that in a symmetrical fashion. Second, repeated episodes of conflictual inflation may, as I mentioned, represent a more structural challenge for the policy toolkit available for monetary policy. Now, in terms of employing a fiscal response to that of course is very, very institutionally difficult. But it does at least strike me that fiscal policy, by being able to operate with a shorter lag and navigate between that steep and flat Phillips curve in a more reversible way, may well be a more robust set of tools to address these shocks in future. And if supply shocks do prove more frequent, we may have to entertain that discussion. The third and last point would be, I would be wary of directional overlearning from the recent or from the inflationary experience of recent years. Ultimately, given the shocks faced in 2022-3, a very sharp drop in living standards was required. And from my point of view, it does make sense that at least some of that was allowed to come through an inflationary mechanism, pushing all of that adjustment onto the nominal side, particularly if that reoccurs in future, would carry some tremendous institutional and economic risks. Leave it there.
Thanks, Cyril. Thanks.
Very good. Thank you for having me. Let's wait then for the slides to come up. But let me start by saying that any account of the inflation process necessarily has to talk about the shocks that hits the economy, the mechanisms that amplify or attenuate those shocks, and third, what monetary policy did about it. Monetary policy, when it comes to inflation, is not a mere spectator of shocks, but rather makes choices in terms of the trade-offs between absolute and relative prices, or between inflation and output. The two interventions before have spoken, I think, in a way that I've spoken already about the shocks, and I agree with much of what they've said. I'll emphasize therefore a little bit more the amplification and the policy consequences. And I'll split my comment into three parts. First, the past, a little bit like Swati did more, and Ben also somewhat of looking at what happened in the last couple of years. I'll try to rush through that to then tell you perspectives on what lies ahead over the next 12 months and over the next 60 months. Looking at the past then, I will not repeat the shocks, they have been said. In 2021, inflation rose in the UK, partly because of the shocks that hit in 2020, and where the amplification was that a pandemic amplified itself in terms of the reluctance of people to come back to work, and in terms of disruptions to supply chains that persisted much longer than we may have thought. Policy, in turn, contributed in 2020 with large fiscal stimulus and very large monetary stimulus. So that, if we now look back, in terms of revisiting, rethinking about what policy should be moving ahead. Back then, there was a reliance on what one may call a low R-star view of the world or a ZLB view of the world. We only need to go back a few years, but there was still, coming 2019, there was a view that, very influenced by ZLB, low R-star views of the world, that fiscal multipliers were gigantic. That's what the research said. So fiscal stimulus would be very important and would really put the economy back on track. As well, that very decisive forward guidance and very strong stimulus on the monetary side when constrained was very important in order not to fall into deflation traps. I think both of those views have been revised since then. In turn, the explosion then, after the increase in 2021, the explosion, if you want, of inflation, and I say explosion because, after all, you look at inflation options in 2018, what trade was there that inflation would reach 10%? Well, you couldn't buy that option. Nobody was selling you an option in insurance against inflation going above even 5%. Again, we can talk about the shocks, the energy shocks. Swati especially spoke very precisely and very eloquently about it. When it comes to the amplification, was really the unanchoring of expectations. I think we saw that firms, once inflation increased, firms and workers raised their expected inflation, translated into higher setting of prices and higher wages that still persisted today, as we saw already in the discussion, for instance, of Claire earlier on, and that fed into a second round effect on prices, making what was a transitory shock persist for a few more years. And at this stage as well, monetary policy was relatively loose in terms of keeping interest rates below or low for quite a while, even as inflation was increasing. And I think this led to a revision of, in monetary policy, the extent to which anchored inflation expectations, not in the sense of 10-year ahead credibility, but in the sense of 1 year ahead amplification of shocks, to what extent 20 years of very low inflation, people believing 2%, could really be counted as given, as opposed to moving when they saw a large enough inflation shock. How even very inattentive people and firms to what's going on to the macroeconomy, once you get a large enough macro shock, revise. Then, in the third stage with the decline, the tightening of monetary policy was probably the major shock, together with the reversal and dissipation of the supply shocks, as Swati noted, and the re-anchoring expectations, and most importantly, here in terms of the monetary policy trade-offs, the extent to which the rising of interest rates, a view that was common in 2002, tightening of policy causally leads to high unemployment, that causally leads to inflation was the mechanism, and I think the last 2 years have led us to revise that view, that actually tightening monetary policy does not work through reducing inflation through channels other than the economic slack one. Let's look then, let me take the view and the starting point that inflation is basically behind us. As of today, inflation is approximately back at 2%. Yes, there are some lingering effects from before, but one should be looking ahead at the new shocks that come, as opposed to trying to catch up with the past that, for the most part, is back at a rough steady state. Looking ahead, one can see short-run shocks on the upside. Expectations are re-anchored insofar as they're back at 2%, although looking here at the UK, one could arguably say that they are anchored on the ground, but not as solidly as before, insofar as they can be moved by other shocks. And I think one can see upside shocks to inflation, a main one being the fiscal expansion. I mean, the OBR does judge the last budget as being the most stimulative in more than 2 decades in this country. It's not just about NICs, it's about just the fact that it's a very large stimulative budget, for good reasons, but one that one would think would cause some inflation. And secondly, on supply shocks that may come very easily from not just tariffs, but also developments in geopolitics, as already brought up in the previous comments. But thinking about and going back to the 3 revaluations of monetary policy that I indicated, because again, monetary policy mediates to what extent, no matter what shock it is, affects inflation. Let me go in reverse order. The last point I had made is the extent to which monetary policy works through unemployment and through there affects inflation, or through slacks and from there inflation. I think a danger over the next 6 to 18 months is the extent to which supply shocks are confused for supply trends. A negative supply shock may not just be about slack, but about the productive capacity of an economy being lower, and as such, a loosening of monetary policy to combat an increase in inflation or an increase in unemployment may actually turn out to be not the right policy, or at least not calibrated to be the right one. And I think in the short run, that is the important upside shock, or upside change insofar as monetary policy not getting its trade-offs right. Whether it is because, again, the fiscal expansion, what impact will it have on the potential output in the US? Very ambitious targets for public investment. Let's see if they get realized. Not a lot of details on what the public investment will be. And likewise, when one looks at the changes in tariffs and others, the extent to which they lead to not just a supply short-run shock, but rather a change in the potential of this economy. On the downside as well, though, there are shocks, meaning inflation may be lower. The adjustment to the possible trade wars that come can easily come with exchange rate scenarios whereby inflation in the UK well undershoots. Moreover, supply shocks are also supply opportunities. Insofar as trade wars lead to an enhanced role of the UK in intermediating global flows, one can also see that it's causing lower inflation. In here, when it comes to monetary policy, let me go back to the second, in reverse order again, of my three evaluations. And that was, remember, the role of expectations and the role of expectations in the price-wage dynamics. If monetary policy is too gradual and too present-looking on the fact that inflation is slightly above target, it can very easily lead to inflation and it being too low by remaining excessively tight for far too long. And it's certainly plausible that without realizing the quickness with which expectations nowadays can really turn turn below 2%, one could have a scenario where monetary policy, through too gradual, not being forward enough looking, leads to a persistent inflation below target that settles itself for a persistent amount of time. Importantly, monetary policy in the last 12 to 24 months has been data-driven, which is hard to argue against. Unless one thinks of trade-offs, and data-driven means less principles-driven. And principles-driven is important, not just data-driven. And principles-driven means understanding that any release of whether it's a PMI or a CPI is but one data point that fits into a framework that has forecasts and scenarios, as we heard earlier. And therefore, the extent to which markets perhaps overreact to each and every release, each and every meeting, or each and every speech is a sign that monetary policy has to move to have more principles, have a clear sense of frameworks that better anchor exactly those expectations when thinking of the downside, or on the upside, better make a distinction through communication through what's a supply shock versus supply trend. So on the next 12 months, I would say that inflation is roughly on target, but with large uncertainty on both the upside and the downside, symmetrically around the target if you want. And I see the job in a watchers conference in how to hold the bank accountable is to not amplify either the upside or downside through either of these two potential problems, and more generally in terms of the principles, as I noted. What about 60 months ahead, 5 years ahead? Let me put out there a conjecture. In the interest of time, I will not defend it, that R star, by which I simply mean long run level of gilts, is persistently higher. Many arguments for it. I'll refer you to my colleague Charles Goodhart for some good ones, but there's many others that one could add for why that is higher. In that new world, let me put forward to you two scenarios when I'm thinking about inflation 5 years ahead. The first one is one in which the inflation bias is back. For those who remember the literature of the 1980s and 90s talking about inflation biases. Central banks, and now let me even turn you back and remind you of Milton Friedman's famous presidential address, who was not at all about natural rates, as is often taught these days, but all about a central bank that was trying to target a real interest rate that was too low, not realize that the R star, those are not the words that were used then, would have risen. A central bank that cuts too fast and too far, chasing an R star, if you want, that is higher than what it thinks it is one that leads to an inflation bias, that leads to an inflation that's persistently higher. Likewise, let us not forget that the bank's independence and generally monetary policy depends on fiscal factors as well. And in the last 3 years, we had very large fiscal stimulus, most of which has been paid off by inflating away the debt. To ask fiscal policymakers to forget this lovely experience of spending like a maniac in 2020 and 21 and having all of it paid off through inflation, and having them not see this to be a tempting thing, especially as we have a highly stimulative and large increase in the deficit, is I think to put a lot of, to not put enough faith that maybe inflation targets will be revised up, maybe the independence won't be there. At least some probability must be put in that scenario. And if that scenario is right, either through fiscal pressures or through mistakes in judging neutral rates, inflation may be back through the biases that were well studied and understood post the 70s. But let me put forward a second scenario as well. If we have that, again, being a bondholder who lost a lot of money in the last 2-3 years with the inflation episode, that starts being priced in through higher term premium, either because one understands there's potentially a risk of inflation, even if that does not get realized, or because of financial repression fears, again, very likely as an alternative to the inflation, or thirdly, even as a result of the limits of doing any more QE or if anything the QT, a scenario in which there's a persistently higher term premium can lead the economy to be stuck in what I'm going to call a double trap. Trap number one is a familiar one. With a high term premium, we could have that the short-term policy rate, neutral rate if you want, short-term R star, could be very low, back to pre-2019, at a point at which monetary policy finds itself in ZLB scenarios unable to stimulate, and therefore a deflation trap falling. But at the same time, with a higher term premium, fiscal policy with high public debt and high rates, high R stars in the long end, will find itself without the fiscal space to provide any stimulus as well, and unlike what happened in part in 2010s. In that scenario, in a double trap, inflation could indeed be persistently low, and we could end up with a 1% inflation trap that persists for very long. So when I look 60 months ahead, and I was asked to look ahead, I see again very two-sided risks of either very high persistent inflation and a high persistent deflation. So, as Deputy Governor Lombardelli said, it is unwise to give certainty when uncertainty is there, and I hopefully have, if nothing else, raised your uncertainty a lot. Both in the short run and in the long run, I think risks are two-sided as opposed to one-sided. They were one-sided for a long time before 2020, too little inflation. They were unsided in the last couple of years, too much inflation. I think we're back at a symmetric case. Both in the short run and in the long run, inflation uncertainty is higher. Inflation risk premium perhaps should be higher than what markets are saying, and especially the bank faces a great challenge for which its mission review and the openness of mind reflected in Deputy Governor Lombardelli is, I think, a very welcome one and an important one to face what will be challenges ahead. Thank you.
Thank you, Riccardo, to you, and indeed all three of you providing some really great insights into the past, present and future of UK inflation dynamics. Before we move on to a few topics for discussion, I'd like to just turn to Swati and ask if there's any comments that you'd like to make on either of these presentations. I know Ben noted this possible trade-off between discipline and patience in policy making. Riccardo called for you to be more principles-based and less data-driven in a climate where the 2% target may come under threat. Lots of food for thought there. Would you care to comment on them or any of the other themes raised?
I'll just comment very briefly on Ben's point about discipline versus patience. I think we did try to do that. I think early on, that was before my time, so I can only remark on it completely as an outsider, which is thinking about how the economy was going to come out of the pandemic. And then later on, thinking about, yes, these shocks aren't going to be transitory because 10% doesn't typically end up being transitory. But at the same time, you're not trying to destroy supply capacity, and it's not possible for our instrument to distinguish between those two things, whether it's excess demand or excess supply. And then finally, I think I'll remark a little bit on what Riccardo said about being data-driven. I think that's a very fair point, which is that if you do end up being too data-driven, every little blip that comes out of the nominal data in particular, there's a real overreaction to it, and to what extent that then translates into hysteresis, I think we saw a lot of that happening. And I think in that sense, month-to-month data anyway is so volatile that using that as then being the one that anchors what your next decision is going to be was never anyway something that was going on. It was much more about underlying trends. So I think, sort of moving the focus away from that monthly information package as opposed to what the broad picture is being told is definitely very important.
Would either of you, Ben or Riccardo, have any comments to add on one another's presentation?
Not for me necessarily,
Okay.
thank you.
I mean, something?
No,
Sorry.
go ahead. No.
I mean, something that was touched on a lot was this, the fiscal situation and, the fiscal consolidation that's going to take place in the UK, which could compare quite dramatically with the situation fiscally that we could see in the US in 2025. As we move ahead, do you expect to see a lot of monetary policy divergence? And if so, kind of, is the mechanism such as the exchange rate adjustment, or do we see the sort of movement in rates going out of sync that we've not seen for a good while historically? No. If we go to you first, Rebecca, and then we move along the panel, then that'd be great.
I think absolutely there's good reasons to expect more monetary policy divergence in the next year or two than we've had before. Why? Partly because we're seeing very different policies. Fiscal policies adopted in the different regions, and two, because even the structure of the economies is changing quite differently across these different regions. In the US, the fiscal expansion is to be much larger even than in the UK, and certainly much larger than what we see in Europe, starting with that one. Secondly, we see a very different fiscal policy mix. Tax cuts in the US, tax rises in the UK, just to compare those two. That has very different implications for what policy should do. And thirdly, also very different industrial policies and what they can do, whether we think about them broadly or more narrowly, including protectionism or not. Looking in terms to the structure of the economy, keeping on a theme that Swati emphasized, the evolution of the energy market, the incoming Treasury Secretary was emphasis on, very correctly emphasizing to those who weren't paying attention, that the US exports oil and wants to export even more oil, whereas the UK will keep on importing energy for the most part, no matter what the Chancellor or the Prime Minister wants to do, because that's just a constraint of reality. And insofar as we have changes in energy prices that are persistent, that will be important. And second, more generally, the extent to which technological change and optimism around it is quite different between, say, the US and the UK, let alone to talk of Europe. So if you have different economies moving different ways, and we have fiscal policy moving different ways, talking about those two alone, you would expect monetary policy to be quite different. On top of it, the exchange rate. I think the exchange rate is an important consideration to keep in mind, especially for the UK as a small open economy. We are in a world, and let me speculate a little bit, where the US continues to be a macroeconomy in which savings is lower than investment. That is an economy that runs a current account deficit. We are likewise in a world in which Chinese policy continues to be one in which savings will exceed investment through contraction of aggregate demand or other tools used by policymakers. That is a world in which China needs to run a current account surplus by macroeconomy. This is not trade microeconomics. This is macro. It has to be the case. Tariffs and attempts at trade tools may at best balance the current account between the US and China. But the macro has to balance out. And if we run a current account balance, or a trade balance even, between the US and China, that means that there has to be a third region that runs a surplus with the US and a deficit with China. That third region emerging, whether it is the euro area, whether it is the UK, or a mix of others, has to come with exchange rate adjustments. And these can be very large exchange rate adjustments. And when we look at exchange rate adjustments, before the real exchange rate adjustments that I'm talking about, they come with nominals, often overreacting, over-responding, overshooting what the adjustment in real exchange rates, and that comes with an immediate translation to inflation even before the current accounts adjust. That pose enormous challenges for monetary policy, especially in the UK, where the transmission from the exchange rate to price is particularly fast, and where, being a more open economy than, for instance, the euro area, the monetary policy response to the exchange rate has to be front and center.
Yeah, I mean, I'd agree with the FX point. Just to bring it back to the fiscal policy point of view, I'd make two very quick points on that. The first is the Bank of England and the OBR's characterisation of the 30th of October fiscal event still strikes me as a little bit counterintuitive. And it may well prove to be the case that indeed we have a very, very large net additional demand stimulus that will come through over the next 12, 18 months, and perhaps that's the case. Looking through particularly the NOV NPR, it felt as though the bank was adopting a measures basis for evaluating the change in the fiscal position. I understand that. It's easy to do, especially given the constraints and the timetable that they were under. But nonetheless, if you actually look at the change in the fiscal aggregates between the March EFO and the October EFO, the largest increase in borrowing was for the current fiscal year. Now, some of that's to do with debt interest revisions, but nonetheless, it does raise the potential that actually the biggest additional excess or additional demand that we now know to be there is actually right here and now. The implication would be actually we've got stronger near-term fiscal juicing and a weaker underlying picture for private sector trend activity. So I'd just throw that out there as a caveat. Nonetheless, if there is that big forward-looking stimulus, inevitably that will delay the emergence of disinflation and potential divergence. But what still strikes me in this discussion is the degree of the institutional constraints the UK faces in terms of its ability to inflate its way out of debt or to continue to do the kind of fiscal processing that you referenced, Ricardo, I think is very, very limited indeed. You know, we live in an economy where we depend on continuous inflows of capital. We depend on investors who can quite happily elect not to buy sterling assets. That is a very different position from the United States. And in that sense, I think the ability to run that risk on a continued basis, to play this game again, I think is very limited. And what I find interesting, just taking that one step forward and then I'll stop, is if you think about the fiscal, it's very bimodal, right? Either we run that gauntlet and we try and test market patience, or actually, you know, we don't run that political risk. We have to run a hell of a consolidation over the next few years, given where both domestic and global rates have gone. And for me, that leaves, to use your framework, Ricardo, the risk skewed more towards the disinflationary scenario rather than the inflationary. Just because I don't think in a debt-funded UK state, it's really plausible to really run that risk in a way that doesn't lead to immediate, pretty severe political ramifications.
I mean, when you say, you know, you raise this prospect of a disinflationary scenario, I mean, how severe could that be? I mean, you're effectively saying that there's very little that the UK can do to get out of a scenario, was the sense I got from your
I think it's very, very difficult, because I think, you know, for the way I calibrate, the way I think about cutting cycle, and unlike my two fellow panelists, I actually do have to publish a bank rate profile, as useful or as not as it may be. The way I calibrate it is how far bank rate now needs to go to allow fiscal policy to get out of this quite nasty consolidation scenario. So yeah, I think it is hard to escape up and until monetary policy sort of internalises or feels comfortable internalising a more responsible fiscal reaction function.
Okay.
You want me to react to those?
Yes, please.
No, I'll react very briefly to the fiscal point, which you've already sort of done it for me, that I don't find it particularly relevant an issue within the UK context that somehow fiscal policy is going to constrain us in terms of how we should take monetary policy decisions just to create more headroom for fiscal policy. I think that's just not a very relevant situation here. But there is the other aspect, which is that is how monetary policy should work in tandem with fiscal policy, that if they want to make public investments as elected government officials, that it is within their purview to do so and ours to react to that. And I think at the moment I would still say that from my point of view, and of course my voting record already sort of suggests that I definitely think that there is a disinflationary risk, and particularly given that already within the profiles that we have built in, there's a fair amount of judgment there about how much we think inflation might be above what our models tell us. So I think that there's definitely that situation, but not to say that I'm ignorant of the fact that there are other geopolitical risks that are potentially unfolding and could swamp everything that we're doing.
I mean, to what degree as a monetary policy maker in the UK do you feel constrained by what the Federal Reserve does? I mean, given the impact that it can have on global borrowing costs if the Fed decides to do very little next year, how much does that impact what the bank can do?
I think in the long run that matters. I don't think in the day-to-day necessarily it matters, but in the long run, yes, it's inescapable. We're a small open economy, and whatever the long run rates look like, there's going to be some amount of some amount of sort of co-movement between what happens in the US and what happens in the UK, even if that's something that's not necessarily what might be optimal policy for the UK.
And just turning to the topics of tariffs and the possibility of trade-related shocks. I mean, the kind of the standard textbook would be that will impact on demand and, in a sense, do some of central banks' jobs for them. But then there's also the possibility that if we get a tit-for-tat trade war, that could have an impact on inflation expectations too. How are you thinking about that balance of risks, or whether or not central bankers should be responding to tariffs?
So luckily I am an international economist by training, but fortunately there's also Sumaya here and Chris Giles here, who've both written the textbook version of this. So I'll give a very quick, brief answer, which is that yes, we would expect some amount of disinflationary pressure come from these tit-for-tat type of trade. Actually, blankly speaking, if there is the kind of big 60% type of tariff increase that's being proposed, that will have repercussions onto world prices, and mostly in the downward direction. The problem, though, is that if it turns out to be something which then becomes very much that there is this tit for tat, there is a question about which supply chain is going to be permitted where, I think then we're in a completely different sort of situation. As far as the evidence is concerned from the last Trump tariff war, the UK actually did much better than most economies, but that was from a very low point for everybody. So in that sense, when a 60% versus a 20% tariff is being debated, we're talking about very, very different situations. And I think that's something we're going to have to be monitoring very closely. Until the time you know which goods and services are going to be impacted by that, it's almost impossible to make anything but broad general statements. And there's nothing you can disagree with those broad general statements about. They're very textbook mechanism kind of such stories.
Ben, if we maybe move on, what would be your thoughts on tariffs and how that plays into how we think about inflation and what central banks should do?
Absolutely. I mean, the few thoughts I'd offer, and certainly we inevitably respond to this, or have to respond to this quite quickly. I mean, echoing all of what Swati said, we'll wait to see exactly what the administration delivers and what the retaliation is. It does feel as though, at least to me, the UK is particularly unlikely to respond with tariff measures, either against the US and obviously against the European Union and or China. And in that sense, that does increase the potential for an initial disinflationary impulse. And notwithstanding the point you made, Swati, about the potential for the wider trade system to become ensnarled in a pretty ugly way, it does feel that at least initially, while it was potentially supply destructive, UK, I would imagine, will seek to try and play for some kind of a deal with the US, given its trade balance and given its close relationship. And that would heavily disincentivize retaliation, which is the main driver of the first order inflationary impulse.
I mean, it may be just I'm looking at this in the wrong way, but I mean, we've got people out there who have, seen prices increase quite a lot over recent years. I mean, it does seem to me as though there is somewhat of a danger that if the public sees prices rise again because of tariffs, that their expectations of inflation are going to be challenged, and the kind of Bank of England's commitment to 2% and so on is going to be challenged. But would you say that's just not?
I mean, let me answer that question empirically, because we obviously have an inflationary survey, and actually based on Ricardo's work, we assign some weight to at least looking at various moments of the distribution rather than just the headline level. And you do see evidence of a little bit of an increase in the negative skew around the data, which would be a bit of an indication that maybe things are a bit more vulnerable. And I think that's logical as well. But I wouldn't overstate it. And I think the reason why is, again, it goes back to this institutional point and what I was trying to say in my discussion. I mean, maybe it's a matter of semantics, but I don't recognise Ricardo's description of inflation expectations becoming de-anchored. What I see is just a very large shock and a gradual sort of institutional redisciplining. And if that institutional framework is intact, then I don't see, I think there's certainly a greater risk than perhaps there might have been, but given the scale of the shocks that we might see, I wouldn't want to overemphasize it.
Sure, I'll come in on this. So first on the tariffs and then on the expectations. So on the tariffs, let me try to add something to what was said already, which is that if a trade war comes, and that comes with a change to a first order, to a reduction in efficiency in the economy at large, including the UK and the world, that means a lower level of potential output. That means potentially a higher extent of unemployment as a persistent phenomenon. So then I go to my presentation, and then I think about inflation, and again, with my monetary policy focused view of inflation, meaning it's as much about the shocks as how monetary policy chooses those trade-offs. The concern that a central bank responds to an increase in unemployment in a recession saying, aha, recession means I must cut rates to bring unemployment down, when maybe that low level of unemployment is no longer achievable in a world that is less efficient, that has been disturbed, where the natural rate, if you want, has been higher. So I worry about that scenario, as I did in the slides. And so I think the question, as much as the direct impact, which again has already been covered, I worry about then the reaction of the monetary policy to the direct impact, and whether the slight increase in inflation, but especially the increase in unemployment, is seen as a temporary slack as opposed to a persistent, less efficient economy, and leads to persistently too loose monetary policy leading to inflation. So I think that's the inflation side, even on the long run. On the other side of the short run deflationary impact that this can have. Secondly, on the anchoring and re-anchoring, let me be clear, I noted in my presentation that inflation expectations became unanchored in 2021 and re-anchored in 2022. Unanchored and re-anchored, not in the sense of long-run credibility, but in the sense of amplifying or attenuating shocks, in the sense of going up and then going down. Right now, as I noted, expectations look very anchored, relatively re-anchored in that sense. And again, I'm talking about short-run expectations as an amplifier, not long-run credibility. And I completely agree with Ben's description of the data. My looking at the data is very similar to his. Expectations seem pretty anchored, whether it looks at first moments, second moments, or tails, which leads me to say that in principle, they should be able to resist shocks, whether on the upside or the downside, when talking here about a shock that comes from the other ones. Of course, one wants to be, but at the same time, I added a word of warning, and this is maybe where Ben and I disagreed, or at least he noted a disagreement, which is that I worry that we go back to 2021 when the anchoring was taken as given. And so I want to say that, yes, to me, they look just like in 2021, they look pretty anchored, but I worry that, again, policymakers may take as given that they must always be anchored, and therefore miss early warning signals of persistence. But I don't expect that persistence to emerge. I expect that given a shock, and a temporary shock that's decisively responded to by a central bank, we'll keep expectations anchored, and I don't see any danger. I don't see any red alarm signals, just like Ben, in the expectations data that tells you there's any danger there at all.
So I'll add something to that, which is tying together both the points that Ricardo's raised as well as what Ben raised earlier. I think there's less of a worry if there is a real trade war about misreading things, for the reason that these are slow-moving things. Trade does not change overnight. I mean, yes, prices might for a moment look like they're going to move sharply, but generally speaking, trade patterns move fairly slowly. So I think we're not in that sort of real danger. And the second reason for that is we've already had that sort of episode unfold with Brexit, which is we saw much higher price increases in the UK compared to everywhere else. And those pressures have now come off much more quickly as well, for the reason that they're not inflationary, they just change the price levels permanently. And that's the sort of thing which, most policymakers are capable of understanding and looking at. And the same thing with potential supply capacity, which is if we know that, yes, Brexit potentially is having an impact on longer-term productivity, longer-term, export potential of the country, openness more broadly speaking, that's something we can take into account, and we don't have to react to it very quickly unless there's some kind of real strange ratchet effect that you're expecting. So in that sense, I'm not particularly worried that that would be misread. I think those are things which are much easier to read than many of the other volatility components that we end up facing through supply shocks.
I mean, what would be your big worries then? I mean, what are the things which you think are really difficult for central bankers to know how to respond to that potentially?
Largely, I would think of supply shocks that happen in salient items, food, energy. We've seen some of those unfold already. If that volatility becomes much more frequent and much sharper over the next, 10 years or so, that's obviously something which we have to, we have to think what would be the right tools to handle that sort of situation.
Thank you. Could I open it up to a first round of questions, please? I'm going to take 3 at a time. So if we could have the man at the back, then this man in the red tie, and then you there. Thank you.
All right. So Tomasz Wiarek from T. Rowe Price. I found it quite striking how in the discussion thus far, there was little mention of labor market issues and about wage inflation in the UK. It seems like most of the panel discussion, perhaps accepting one of Ben's slides, was really focused on price inflation rather than wage inflation. So what I would like to hear from the panelists, do you think perhaps wage inflation leads or lags price inflation? And how much of a risk do you see the labor market for UK inflation going forward?
I'm Roy, LCP and LSE. Thanks for excellent presentations. My first comments are to Ricardo, and I'd like his reaction first of all. While I sympathize with you in terms of a principles-based monetary approach, I do think that the Chicago, Minnesota school and doing priors, where I have prior distributions on some and I choose the likelihood function, encompasses both. And that's been practiced by Sargent, Hansen, Prescott, etc. So how would you react to that? Second, we as macroeconomists, this always baffles me, spend a lot of time on inflationary expectations, but ever since the Chicago Fed Listens conferences and those who followed it, Swainson, etc., there hasn't been unanimous agreement on what is the best way or best index of inflation expectations, and this is something that even Trichet and Bourdieu reflected on. What really surprises me and baffles me even more than everyone else is why are we shocked by consumption shocks being different? If the consumption structure is so different, US, UK, we teach it in Macro 101 at LSE and everywhere else, US, UK, Europe, look at consumption to GDP, look at openness figures, therefore the shocks often, whether you look at a standard VAR or BSGI, should be very different. And it's not something new that we should expect. If the structure is different, then the consumption responses will be different. But we every time seem to present it as if it's something new.
Hi there, Theo Harris from the New Economics Foundation. My question is for Professor Dhingra on, given the vulnerability of the UK to imported prices, particularly in energy, if there is any rationale for the bank to take measures based both off its primary inflation mandate and also off the secondary objective to support government policy, to take some measures to support the clean energy transition, for example, with the government's clean power plan.
So if you'd like to go first and then we come back to you, Ricardo, that would be great.
So let me start with giving the kind of slightly more generic answer to your question on wage inflation. I think the broad view is I broadly think that what happened during this episode was inflation happening first and then wages catching up with that. And that's something which seems to be dissipating, at least from what we're hearing from the agents, but that's not necessarily something which is coming through in to very much the same degree in, say, the decision makers panels or some of the other measures. Broadly speaking, though, I was very skeptical of the very sharp peaks we saw in AWE. I thought a large part of that was driven by volatility, which later sort of seems to get confirmed. And that the RTI, the payroll employee data was actually much more reliable than, say, what we were seeing in the annual weekly earnings data, the average weekly earnings data. So broadly speaking, I think the labor market is moving in that direction where it's really substantially eased to levels that we last saw in, say, 2018. And that was not a period we associate with, some kind of real wage inflation dynamics. So I think we're getting there, and particularly in the sort of low end of the labor market, which of course now is going to become a slightly more complicated picture because of the living wage coming in as well. And how that plays out, I think, is a hard question to answer. And I'll briefly answer the question which was directed at me, which is that what about the clean energy transition? You know, me as a nominated policy maker, I find it very uncomfortable to say it should be the case or shouldn't be the case. I think the elected officials should be the ones giving us that mandate if they want us to do it. I don't think it's up to me to decide what our remit should be. I think it's much better to have people like me as, you know, automatons who carry out the functions we're asked to perform rather than decide what those functions should be.
And just on the data topic raised, I mean, you raised it in your talk as well at the end of it about whether or not there's, you know, some difficulties in measuring certain things because of inadequate data. I mean, you mentioned inflation expectations, maybe labour markets are an issue too. I mean, what are you still, you know, struggling with data-wise, and what are the kind of potential fixes?
The obvious one, of course, the labour force survey, that our response rates have dropped so much. You know, I grew up in India. There are 1 billion people there. We managed to get the labour force survey answered. You know, so I don't find it particularly plausible that that's hard to do. I think it should be something which is feasible. And in fact, the Indian labour force survey was modelled off of, to a large degree, the UK labour force survey. So somewhere we lost those skills and the will to do it as carefully as we did. Other than that, of course, there's the payrolled employee data that we're going to get, which is great coming from the tax records. But at the same time, much of the self-employed numbers are so lagged that we get a very partial picture compared to, say, everywhere else. We have 15% of the people who are self-employed, and we don't really know what's happening there. So many of these sort of real black holes of data, I think, definitely constrain our ability to look ahead. And I think the price data, hopefully, will get to a point. I mean, it's great what the ONS does, which is releasing the micro data, but that's just not enough because some of the sample sizes for some of the items that we care about are so small that it's not going to really help that much.
Ben?
Yeah, absolutely. I mean, I'd love to pick up on the labour market and the wage question. Obviously, the correct answer, Thomas, to your question is, you know, it's both. It both leads and lags at any one time. I do think, just based on the decomposition of the contribution of slack and the characterization of this conflictual process, I would share Swati's view that primarily it's felt like a degree of real wage resistance and therefore a sort of lagging indicator to some extent. And I don't think the extent of that real wage resistance, going back to that Bernanke and Blanchard decomposition, is sufficiently large for it to have now become a leading component. It's obviously contributed back into a little bit of price resistance, but I don't think it's really fair, if you were taking a broad sweeping decomposition of this, to think of that as even now a very, very large contributor, or at least, thinking of in aggregate over the last 2-3 years or so. I do think there was a bit more of a wage contribution if you reweight the services components by labour intensity through the middle of this year, which is maybe a sign that that feedback effect is becoming a little bit large, a slightly larger driver of the headline services data. But nonetheless, I think at least so far it's primarily been a lagged feature. And the question now as we go into next year is whether, in my mind, we see the NICS changes and the NLW being large enough to generate a broad-based increase in wage levels that would see wage growth now take over as a leader, or whether, and in my view this is more likely, that feeds back into a reduction in labour demand. And increasingly I think there's a bit of a learned experience over the last few years where we assume this is going to be passed on in services prices, these further cost shocks. And I look very, very closely at the relative price of labour and non-labour inputs. And it feels to me that if you look at that change, and for the first time we're seeing labour costs become relatively more expensive compared to everything else, that can mark a bit of a state shift in terms of the way these shocks are transmitted. So far lagging, open question of whether it can start to lead, but I think we need to take the downside risks to the labour market quantities really very seriously. And I do find it interesting in a conference like this, private sector PAYE growth has been negative to flat for the best part of 14 months. Doesn't seem to get a lot of airtime. Uncertainties around the data notwithstanding, the PAYE is the best data we have, and it's not painting a pretty picture.
Good. Let me try to make 3 points. First, there is no index of expected inflation. Swati spoke for 10 minutes about inflation and showed you pictures. In just one slide, she had 10 or more, I didn't count, indicators of price inflation. It was core inflation, overall CPI, there was goods, services, there was the different 5 components that drive each one of them. There were 12 on one slide only, on our first slide. You didn't complain, oh my God, there's no one measure of price inflation. So why would you expect there to be one measure of inflation expectations? I mean, it's perfectly normal to have a multiple set of indicators to measure the current set of inflation. It's perfectly normal to have a series of indicators to measure expected inflation. A question on the labor market. Would you say there is no one index of slack in the labor market? Thus, until then, I can't really speak about slack. There's 53 measures of slack in the labor market. We combine all of them in a disciplined way. We come up with some impression of it. So I don't find that there's no index of expectations to be anything to even worry for a minute about. It's just there's 15 indicators and so on. But so that this doesn't sound too defensive, let me even tell you what those 10 indicators are. Give me the SPF surface forecasters mean expected inflation over the next year. Give me the standard deviation and skewness of a household survey expected inflation over the next year. So I'm at 3 indicators. Give me a firm measure of expected inflation next year, and especially a measure of sensitivity to conditions, whether it's wages or others or communication. Give me a 5-year expected inflation from the markets. Give me an options at the tails of the markets. I think I'm at 7, but probably it's 8 or 9 because I'm not counting very well. That's still fewer than Swati had in one slide to measure price inflation. Give me those 7 or 8, or how many I counted. I think I have an okay measure. Each one of them takes a lot of work. Luckily, the bank is investing in bank capability, so you can measure each one of them. Take away risk premium, think about liquidity premium in some of these, think about the biases, run some nice RCTs like in Michael McMahon's work or others on communication and so on. But think about those, and I think you'll do a great job of measuring expected inflation, as good as you do at measuring slack in the labor market. I see no theoretical or research reasons on why we can't do this, and I think we can. Second point, on models and likelihood-based consumption measures. I completely agree on that one. Having to on the first on that one, I completely agree. But I really draw encouragement here from, how this conference started. Exactly, there are differences across economies. That's why the Bank of England cannot rely on just reading the wonderful research produced by the ECB or the fantastic analysis by the Fed, but has to develop its own capability of filtering through data, of building models for the UK economy, to understand that as much as there's macro principles that are shared, its implementation measure for the UK are very different. And that requires not just investment at the bank, but also the community represented here in this room to contribute in that debate and bring some critical views of what I hope I'll offer sometimes, and many people I see in the room will offer, so as the bank can use those resources to do so. Likewise, when we come to forecasts, and as we think about scenarios and the different perspectives that were brought up earlier today, I think there's an important challenge. As you put it, we know how to combine, you called Chicago, Minnesota view, I'm not sure I would call it that, I would call it just a Bayesian perspective to decision theory, of combining using likelihood principles what are forecasts from different models. I certainly think that that's a very conceptually correct way of thinking about it, especially as the bank, and let's keep this focus on the bank so we don't just have an intellectual discussion, moves towards having multiple models and 3 scenarios or more, combining those towards an effective decision principle. And again, Deputy Governor Lombardelli already mentioned this a little bit, will require put both some probabilities in them, but where the important lesson of probability and likelihood thinking is that you have to combine priors with likelihoods and update priors to posteriors in a somewhat frequent way. That is, you need to think about how much weight you're putting in different models in an iterative procedure that brings in the judgment of policymakers, and that's why one has a diverse MPC, or like Governor Lombardelli said, the MPC should be involved in the combination of those forecasts, but also means from the ground up the staff saying, look, looking at recent past performance, this is how your prior should move to posteriors of different models and how much weight you want to put in them in some ways. That requires having multiple models that, as I think was framed not so recently by different members of the Bank of England, that requires thinking of models as not giving you one number, but giving you, if you want in 3 scenarios, a triangle of scenarios that provide you some bounds on what is acceptable in the discussions, understanding that then you're going to have to be putting some probabilities in an iterative process across them, which you can model as a probability process, but can be more understood as a subjective process of bringing things together in different ways towards reaching a good decision. So I think That is, in some ways, I see no contradiction between that and what I heard from Deputy Governor Lombardelli this morning in terms of just how conceptually one needs to combine different things, as opposed to trying to come up with a single indicator a single forecast as being the right one.
I think you missed my first question. I wanted.
And any thoughts on the question from the New Economics Foundation about climate goals and inflation?
For me?
For you,
I'm not an expert on climate economics.
Okay.
I think, yeah, I'm not an expert, so I shouldn't talk about it.
Can we have a second round of questions? Can I see a show of hands? We've got two gentlemen in the front here. Phil, gives you the mic to you first, and then to you, and then there's one at the back here. So if, sorry, just right on the front. If goes.
Thank you. Phil Aldrich at Bloomberg. Swati, this one for you. I just wanted to clarify, you talked about the 60% tariff scenario, and you said that this would have an effect on prices mostly in the downward direction. I just wondered if you could just expand on that to clarify that. And also, I think you were suggesting that the fiscal impact of the budget would may have a disinflationary impact. But I may have misheard or misunderstood. So I just wondered if you could explain your position on the impact of what happened on October the 30th.
So I'm not sure I said the budget would have disinflationary impact.
I may have made
the OBR and the Bank of England's assessment is 0.5 percentage points. I can tell you my version of that, which is I think something is amiss somewhere in the OBR forecast because the GDP deflator goes up by 0.5 percentage points, so does the CPI. I don't find that self-consistent given this is a very investment-heavy sort of spending as opposed to being very consumption-heavy spending. So something is amiss somewhere. Do I have a very strong view of how much is what? I think between the judgment that we already have built into our inflation forecast and more broadly how this process unfolds, I think there's a fair amount of uncertainty. I couldn't pinpoint a precise number for it. In terms of the 60% tariff, thankfully Chris has already made my life easier by very nicely explaining how the textbook example would work, which is to say you have somebody like the US put on a 60% tariff that takes massive amount of demand out of the world market, and the way the exporters, say in China or in other parts of the world, might respond to that would be by reducing prices, world prices, because they don't want to lose market share. Now, did we see that happen during the last Trump tariff war? Not really for consumer prices in the US, but for really like what were consumption items. But we did see that sort of evidence unfold for iron and steel. So in that sense, there's some view in the literature that maybe for intermediate inputs, there was actually a need to try and preserve market share, and therefore you saw reductions in world prices. My point about saying why the 60% matters, I think 20% increase in prices you might still be able to absorb. I think even that's pretty high. But 60% increase in prices for most businesses, particularly those operating, making products for which there is possibly excess capacity in the world economy, I think there we possibly are going to see some amount of disinflation in world prices. Now, that's a speculative statement for the reason that I don't know how much this 60% tariff is just going to be imposed on the one product entering the US market, or whether this is really about that if we are going to put a 60% tariff, we also expect you, when you use something which has that input in it, you're going to, sort of have this kind of cascading effect on it. I think that makes the problem much harder, and then I'm not even thinking about what the fiscal expansion is going to do. That's just another whole host of issues that comes with it.
Either if you want to add anything on this topic?
No.
So it was mentioned, or the key question here is sort of if we talk more the savings part. You had a supply shock, yes, but you also had a little bit of on the demand side, given sort of pent up savings. And I was wondering a little about if you guys could comment on sort of now that we move out of the sort of shock area, what will be the role of the sort of savings rate going forward?
Can you just take your name, please?
Sorry, Jakob Lauert for Handelsbanken.
Thank you. And then if we maybe go to, there's one at the back, and then get at the front.
Hi, Simon Newell, Positive Money. Given it seems that the impact of the bank rate on inflation seems increasingly long and variable, I'm interested in how the policy mix may change to reply to future episodes of inflation. So it seems as though in the UK, the energy price cap actually had quite a strong role in tempering inflation. So therefore, do we need to talk more about the role of managing systemically important prices like energy in responding to supply shocks?
Thank you. Jan Vlieger from Millennium. I had a question about Ricardo's assessment that inflation expectations were unanchored and then re-anchored. I'm sure there's a lot more behind it, but you showed a chart of inflation expectations going to 10% and coming back down, and which is exactly what inflation did and what everyone expected inflation to do. And so it seems like you could also just say that was a very irrational expectation to the shock. Everyone expected there to be a temporary spike in inflation of about 10%. What else would you expect them to forecast? So how do you go from then assessing that inflation expectations were unanchored and re-anchored? Because it seems to me it's also consistent with they were perfectly anchored throughout.
Maybe go to Ricardo first and then go down to Swati.
Okay, so let me go to the three questions raised. I think on the savings rate, I think that's a very important question. I think understanding the consumption behavior and savings behavior of households is something that really needs to be rethought looking ahead. We know from theory, if you want, that there's two key determinants of the saving behavior of households. One being their expectations of the future, the permanent income hypothesis. The behavior of US households and the way in which they're saving very quickly would indicate that there's a lot of optimism about future economic growth. That may be correct, that may be incorrect, but it certainly indicates a large amount of optimism from that perspective. And the second one, whereas for the UK, you see much less, which would be consistent again with much less optimism about what future productivity growth would be, and so at least qualitatively it seems consistent. But secondly, there's a very important role of precautionary savings, the extent to which people save more when there's uncertainty. And that is an important channel. We think it's an important channel. It certainly played a very important role in Keynesian theory, even if not formalized that way 100 years ago. And that is one that does not seem to have played as much sway as we might have thought, since even though when uncertainty was very high post-lockdown, we did not see people saving a lot to what seemed like a fairly uncertain world. And I think that leads to some revision of what that claims to. I think especially important when we think about savings behavior is the debates, and this feeds into, for instance, debates on R-star, is how do we think about demographics and how do we think about what part of your savings is for your retirement versus your bequests. I would not therefore understate the importance of discussions of estate taxation in this country in terms of how that affects long-term savings and in ways that can very easily, in a forward-looking sense, affect themselves now. But I think it's an important debate to have, and I really would tie it in especially to a reassessment of the precautionary motive and a reassessment of life cycle versus bequest motives for saving. I think those are important, not just in the long run, but also partly in the short run. Second question on interest rates and long and variable lags. Long and variable lags are the bread and butter of monetary policy. Again, I will emphasize the Bernanke review and Chair Lombardelli's initial intervention, which is that it's very important for the bank to continue investing in that. That is the bread and butter of a central bank. As much as there's many other concerns, from tariff wars to the climate transition, which are very important, understanding monetary transmission has to be the central role of the research staff and the modeling of a central bank. And that one is persistently changing as there are changes, especially in the financial market. I would especially point to, say, Andrew Bailey's very good speech at the LSE in May for the future of the balance sheet of the Bank of England, quantitative easing, quantitative tightening in that context. I think those are extremely important for the transmission mechanism, and I would look at those as being an important work in progress at all times in a central bank. Third, on Jan's on the anchoring and the re-anchoring. You're absolutely right in that if one just looks at the first median, at the average expected inflation across households, one sees them following what inflation was. That alone, as you said, may be, oh, they were rational, or, unfortunately, they were super backward looking. Look, as soon as inflation went up, because they followed it with a lag of 6 months to a year, which also fits extremely well the old style adaptive expectations models that we had before. So looking at that data alone, the one picture that I had the time to put, you can either say they're hyper-rational or as dumb as it gets, completely adaptive. They're telling expected inflation is whatever inflation was in the previous 2 months. That's why one needs to look beyond that first moment. I have modestly tried to contribute to that literature, but there's other people in the room who have done great work on it. I'm looking there, for instance, at Paul Mizzen, who's done incredible work in developing the firm survey and others. But I think the emphasis in that work has been to look at distributions, to try and look at, can we see disagreement, can we use skewness, can we see who reacted, how they reacted, how much they reacted. When we look at financial prices, can we look at options? Can we look at the extent to which we can separate risk premium from expected in finance? Can we combine firms with households and especially professionals and see who's leading who? And by using those, try to get a sense of why we get some re-anchoring or some unanchoring. I think that, so that's, I think, the only right answer to say. But looking at it like that, yes, it could be either they're incredibly rational or incredibly rational. I would add beyond just we have been developing technology, we have been developing those models, and those models exist, and they, I think, support an idea of some re-anchoring when we look at how much disagreement increased, when it looks at how households moved ahead of professionals, when it looks at the skewness and how it came back, when it looks at in the options how the tail probabilities of insurances went up for a little bit, when we look at the 5-year as well as the 1 year, how the swaps moved in a consistent low frequency way for a while and then reverted. Moreover, I would even point to the evidence that comes from theory, or not the evidence, I would point to theory noting to people tend to be inattentive, but when you have large shocks that you can get a very amplifying response to those public signals. And I would finally point though to, let's look beyond expectations. Let's look at the transmission channel. Expectation is just a signal, it's just what people think. What matters is what they do ultimately. Well, we have quite a few micro evidence using that in the last few years. Their expectations fed into higher prices. There's now several papers using incredible causal identification mechanism showing that they did. 1. 2, we have at a more elementary level what we saw in wages. After all, again, going back, I think it was Swati, no, it was you as well, who showed that the wage growth really increased quite a bit. And this coming down is the last mile, I think someone said, in the inflation. That is a translation from the expectations into the wages, back into prices. The expectations are one part of the wage price dynamics mechanism. And so in that sense, you see some of it just there. And then thirdly, one sees it to the pricing behavior. So reaction of firms, wages, but also the prices. What we see is that the frequency of price adjustment increased quite a bit. The duration of price spells has declined quite a bit. We see the size of price adjustments being large. Again, with using those, as in, for instance, very nice recent paper by Luminita Stevens and co-authors, you see a change in the way firms set their prices in the last couple of years that was not consistent with a purely backward-looking view. It's consistent with firms thinking, I need to set my price a little more often, adjust them a little bit more, which again falls into the broad category of expectations moving in them ways, in the sense that the price setting, or what economists may call the nominal rigidities process. So I think the combination of all these pieces of data, and I know I'm abusing Claire's patience, tells me that it's been some unanchoring, re-anchoring in a way that just that one picture cannot.
Does that suffice?
No.
Sorry. Ben.
Well, no, let me actually just start immediately with that question, even though not addressed to me. All of the micro evidence that Ricardo has alluded to is compelling, is interesting. I'd make 2 very simple observations. Bernanke and Blanchard tells you that the feedback from high inflation into wage growth has been commensurate with the scale of the inflation shock, not greater, which clearly weighs against the idea of a structural break. Second, notwithstanding, I think, the observation about frequency of price quotes again, or price changes, the question we should be asking is the scale of that change greater than would be implied by the scale of the shock? And at least looking at headline pricing behavior, the evidence would be no. So one method I quite like is the BIS in 2022 published quite a nice method of decomposing the rate at which inflation has been exported or imported across sectors. The UK is one of the few economies that actually shows a net reduction through COVID in the rate of export and import, which obviously weighs against the kind of de-anchoring logic a la sort of Lucas Islands and not knowing where things are going. So from my point of view, at least in the macro, what you say may all be true in the micro, but in the macro it's very hard to detect. Other questions. On the household savings question, I think it's an absolutely critical question and one that isn't discussed anywhere near enough. I see in a rather less academic or rigorous way than Ricardo, modelling this as a function of 3 things: uncertainty and precautionary motive, as was mentioned. RHDI growth, so real income growth, which naturally has a negative coefficient. But what's interesting for me is the development in UK household net worth, which has deteriorated very, very sharply through the pandemic. I think I have the numbers to mind only for the aggregated non-financial private sector, but the total balance sheet impairment is worth about 100 percentage points of GDP as a share of overall activity compared to 2019. We saw a similar impairment in the US post-GFC, and that resulted in about a 6% bump in the household savings rate. Ergo, I think this is actually to some extent here to stay, even if we see some normalization around the other components. The last question, the issue of systemically important prices, I think is a really interesting one. All I would say on that is you have to be pretty damn confident that that's going to be a temporary effect, in which case it may make sense to control the price. If it's permanent, then you have to get into the world of loss absorption. And here I just draw the link very quickly with a question from the gentleman at NEF, which I do think we should be asking the question to some degree about whether it makes sense to allocate that loss using a mechanism that disproportionately impacts investment, given the long-term growth consequences that Alan Taylor and co-authors have highlighted around that regime. So ultimately, you can't prevent the loss. If it's permanent, you have to recognize it. But the question of how you allocate it, I think we should be having a more explicit discussion about where we can.
So the last word to you. So since there's limited time, I'll just take the last one because that's not been answered quite as comprehensively as the debate we just saw, which is to say, should we be really monitoring systemically important prices? And my answer is a big yes. We've been trying to recommend this for at least 10 years. And now that these really big supply shocks have unfolded, and if we've still not learned that lesson, I think it's a really sad situation. Now, whether that means that we need to react to it through monetary policy, or whether that's something which goes into some other part of the government and then is sort of looked into more carefully, and it creates the database where we know where supply chains are, that we can have a debate about. But broadly speaking, this is going to be particularly crucial if we do enter a scenario of trade war and general geopolitical strife in the future. So I think this is absolutely critical.
A great way to end what's been a really, really fun session to moderate. So thank you all in the audience. Thank you to the organisers, and thank you to the panellists. You've all been fantastic.
Please take your seats. I'm Dick Berner. I'm Emeritus Professor of Finance at NYU Stern and co-director of the Volatility and Risk Institute there. Today we're going to talk about liquidity risk in the financial system, and we think this topic is very timely. Just last week, for example, the Fed, in its financial stability report, probably mentioned liquidity issues on both sides, that is funding and market liquidity, more than once. And in organizing this panel, we said we want to cover a number of questions related to the resilience of liquidity in financial intermediaries and in markets. How should central bank liquidity operations be amended, including asset purchases, but also lending operations? And what metrics are informative about emerging vulnerabilities in this area. So to answer these questions and more, we have three extremely distinguished panelists. I'm going to start at the far end of this group. Pablo Hernández de Cos is the former governor of the Bank of Spain, and the BIS just appointed him to be general manager, succeeding Agustín Carstens next year. Congratulations, Pablo.
Thank you.
Victoria Ivashina, sitting next to him, is the Lovett-Learned Professor of Finance and head of the Finance Unit at Harvard Business School. And Colin Teichholz, to my left, is former head of markets at Element Capital, vice chair and member of the U.S. Treasury Borrowing Advisory Committee, and member of the Financial Research Advisory Committee at the OFR. He's also a member of my advisory board at Stern, the Volatility and Risk Institute, and serves on the board of Good Shepherd Services. Welcome to all of you. So we agreed to start with a 10-minute presentation by each of you, followed by 30 minutes of discussion among us, and then we'll move to a Q&A session with our audience. And we'll start with Pablo. Pablo, the floor is yours.
Thank you very much, Mark. Well, given the introduction, I should start by saying that opinions are my own and do not represent either the Bank of Spain or the BIS for sure. And in my initial remarks, in my first 10 minutes, I will love to focus on one particular issue, which is banking, liquidity in banking, and precisely on what conclusions can one reach on the lessons learned from the banking turmoil that we experienced in March 2023. On the details of what happened, I can be very brief. The banking turmoil was, well, we know, the most significant system-wide banking stress since the great financial crisis, and of course we also know that it required wide-scale public support measures by some jurisdictions. The Basel Committee published last year in October a first interim report with a summary of the lessons learned at that moment, and then later this year, in October this year, also a new report to the G20 with more conclusions on the topic, and I will be focusing precisely on this. First is, of course, about the distressed bank outflow rates. And here, what we know is that in the case of failed banks in the US, the stress outflows of uninsured deposits were associated with deposit concentrations, idiosyncratic business models, and also with unique balance sheet structures, and that additionally withdrawals were amplified by widespread access to digitalization and social media, implying that the scale and the speed of the outflows far exceeded the levels assumed in the liquidity standards in the Basel framework, meaning the liquidity coverage ratio and the net stable funding ratio. Additionally, these uninsured deposit outflows led to systemic considerations with knock-on impacts to other large US regional banks with similar characteristics like their funding structures or their business models. The evidence shows, when we focus on Credit Suisse, is that the crisis at Credit Suisse was the result of repeated incidents at the bank itself, which in the end prompted two episodes where Credit Suisse experienced exceptionally large and rapid deposit outflows, significantly, again, exceeding the assumptions of the LCR and SFR for retail clients, especially uninsured high-value deposits. The analysis of the failure of Credit Suisse also suggests that internationally active banks may face not homogeneous stress outflows across different locations or legal entities, and in particular, the observed outflows at the domestic business of Credit Suisse were much lower. These were much lower than the outflow rates of wealth management client balances observed at its international operations. Having said that, the full potential of outflow rates in the US and Switzerland is difficult to gauge as immediate government interventions took place, which basically implies that the counterfactual scenarios with no public intervention could imply, or surely would have implied, more acute outflow rates. Focusing on the drivers of these outflows, a surge in negative media coverage, including social media for sure, and wide access to digital bank accounts were common risk drivers for the severe deposit outflows occurred within concentrated funding sources. And in addition, the customer base of the failed, in particular US banks, was concentrated in certain industries, and the funding relied heavily on uninsured deposits with a relatively elevated level of high net worth individuals as customers. This is the first point I wanted to make. The second is related to the materiality of additional risk factors that are not covered in LCR and SFR, and which were also very important, as you will see. In the case of Credit Suisse, additional liquidity requirements, liquidity needs materialized during the March 2023 turmoil. A large proportion of the liquidity buffer was used to meet these additional needs, and accordingly was not available to cover the outflows assumed in the LCR. And these additional liquidity needs included increased prepositioning and collateral quality requirements that were imposed by counterparties to facilitate settlements. It also includes increased regulatory and supervisory requirements and expectations in host jurisdictions, as well as the bank's own liquidity management requirements at the entity level. And it also includes increased intraday requirements. Well, in sum, the total increased liquidity needs which arise from these risk factors is estimated to account for almost 100% of the LCR net outflows for the operating parent bank, Credit Suisse AG, during March 2023. which of course raises questions on the treatment of increased liquidity needs in times of stress. We have seen how some jurisdictions, and in particular Switzerland, exclude preposition assets from HQLA. However, no jurisdictions have additional outflow assumptions under Pillar 1 to cover possible procyclical increases in prepositioning requirements during times of stress. And in a few cases, Pillar 2 requirements are in place or foreseen to cover the issue. Intraday liquidity risk is addressed by a minority of jurisdictions and with different approaches. Another point, which again is given by the experience with Credit Suisse, is related to the management of liquidity risk at a legal entity level. HQLA, held by a legal entity to meet its local liquidity requirements, which cannot be transferred to other entities within the group, can nevertheless be included in the consolidated LCR under the LCR standard to the extent that such HQLA cover the total net cash flows of that entity. And the reality is that complex banking groups like Credit Suisse in stress may face additional challenges to make use of their entire HQLA buffers of local entities when liquidity transfers within the group becomes necessary. So this is also important to be taken into account. Third point is about accounting treatment. Here I can be relatively quick. Well, you know that in the LCR, HQLA is based on market value regardless of the accounting treatment. In addition, eligible HQLA is subject to operational requirements to ensure that banks can immediately use HQLA as a source of contingent funds at any time during the 30 days stress scenario. And LCR does not distinguish between outright sale and repo transactions as monetization tools. In principle, banks, one at least should expect that banks that hold fixed income securities at amortized cost with a substantial amount of unrealized losses may refrain from selling them in a liquidity stress, and this is because the sale of such assets will crystallize associated losses in their accounting statements with a negative impact on bank capital. Under these circumstances, banks may be able to use repo transactions on an interbank basis or with the jurisdiction central bank to generate liquidity without necessarily crystallizing unrealized losses. But again, the experience of the US banks during the turmoil highlighted that private repo markets may become a less reliable option for monetizing securities held at amortized cost for distressed banks during idiosyncratic liquidity stress scenarios. And moreover, in such scenarios, the repo market itself may stop functioning smoothly, which suggests it could be highly procyclical and an unreliable source of contingent liquidity in severe idiosyncratic and market stress scenarios. Furthermore, and this is of course also very important, secure funding raised using liquidity buffer assets could have a significantly higher funding cost than the prevailing rates on HQLA securities purchased in prior years. This kind of negative carry is transparent to market participants through public financial disclosures, which could trigger additional liquidity stress. At the same time, well, of course, we have also to stress that the difference in ease for monetization between HQLA held at amortized cost and fair value may be smaller for sure if banks have either appropriately managed the interest rate risk or otherwise have sufficient capital headroom to fully cover unrealized losses on securities held. This is an obvious fact. Fourth issue, surprisingly, at least surprisingly to me, other identified impediments to the use of liquidity buffers during the March 2023 stress was the lack of preparedness and operational capacity at some banks to quickly finance their securities via established access to secure financing channels or other types of contingent sources, such as central bank liquidity, which in the end impacted also the ability to meet outflows by those banks. And we have also to take into account disclosures and the negative impact, market impact of disclosures, other than those foreseen by the LCR standard, which also play a role in this case in Credit Suisse. While the LCR standard specifies a lag disclosure of an average LCR, Credit Suisse appear to have had concerns about the impact of potential capital market-related ad hoc disclosures that would allow a breach of its regulatory requirements or the use of emergency liquidity assistance. And precisely with respect to the use of emergency liquidity assistance, market participants could have possibly infer the firm's usage of the facility from aggregate balance sheet positions in the Swiss National Bank's regular reporting with some time delay, which might have had further deteriorated the confidence in the bank. And then a final point is related to, well, you perfectly know, as a complement to liquidity standards, many jurisdictions also have some supervisory monitoring tools, and in fact most jurisdictions have implemented these additional supervisory monitoring tools. And the assessment that the Basel Committee made is that the tools have been useful in both business as usual and during the banking turmoil. But there is also a general consensus that these monitoring tools could be more effective if, for example, they are rigorously used by supervisors via the calculation of dedicated indicators, if they are reported with a higher reporting frequency during business as usual times for institutions with a structural high-risk liquidity profile, if they are additionally applied to individual entities of banking groups, if they provide an overview of the accounting classification of HQLA and its monetization, and if they provide more granularity on the concentration of funding, especially by category of deposits or by business activities. So these are the 5 conclusions that you can find in those 2 reports of the Basel Committee. Let me finish with some conclusions on my own. It's obvious that the banks that failed in 2023 had idiosyncratic features, but it's also obvious to me that all ultimately experienced significant liquidity outflows, and that the relatively new elements here of this episode include the increased speed of deposit outflows, the exposure of highly concentrated depositors clienteles, the effect of digitalization, the lack of some operational readiness, and the reliance on held-to-maturity liquid assets, with, of course, large unrealized losses. And while, of course, some of these issues represent basic, I would say basic issues of risk management, there are also broader issues to consider. Firstly, the scale and speed of runs have been so fast that recalibrating the standards to meet historical stress events is likely to significantly curtail liquidity intermediation. And while targeted adjustment could and probably should be made, I'm not sure these adjustments address the systemic issue. If, as seems likely, digitalization has fundamentally changed the speed and frequency of bank runs, and current micro-regulation is not designed to offset that increased risk, the big question is how should we think about liquidity from a system-wide perspective? And I think we need to think about some pretty fundamental questions here, such as how much do we expect banks to self-insure against liquidity risk, and under what conditions are we willing to rely on the central bank to step in? How should we think about policy options that increase access to liquidity ex ante versus ex post liquidity? Ex ante measures may include pre-pledged collateral with the central bank or committed central bank liquidity facilities, as those suggested in the G30 report. Spot measures include facilities that are developed once we enter a stress period. But of course, here an additional question is how does all this interact with central bank operating frameworks and the reach, of course, of deposit insurance, and where do we draw the line in terms of liquidity assistance? Should it be extended to non-banks? In all these approaches, in my view, we will need to weigh up questions, of course, related to intermediation, to moral hazard, and bank and system-wide resilience. And this is one of the topics on which a holistic, and I underline holistic and integrated approach is crucial. In thinking about how to strengthen the management of liquidity risk, we should not consider alternative measures on isolation. In particular, probably the best avenue to follow is to look to a combination of a stronger supervision, greater emphasis on internal governance and liquidity management, and an improvement in the system of central bank liquidity provision. Thank you.
Thanks, Pablo. Great questions. Victoria, you're up.
All right. So thank you to organizers for having me on this panel. I'm going to build in part on what Pablo said, but also I'm going to take you in a slightly different direction. And that, by the way, is intentional. We've talked briefly about remarks that we're going to make, and this is intended to broaden the conversation. So I'm going to make two points in my opening remarks. And first one builds on the paper that we wrote for Brookings, and it was born as a reflection on the 2023 crisis in United States, which is what Pablo highlighted for us. The question for us was what to make of the higher level policy response and liquidity provision as a result of the lessons that we learned from 2023. We actually took a step back here and thought about larger trends that landed us in the episode, in the 2023 episode. And from that perspective, we returned to the two policy choices of trying to stabilize US banking system. One was an increase in deposit insurance. So if you have a banking run, the obvious one is that if you have a full deposit insurance, that will stop it. The other one is a liquidity regulation. And both of them have very different costs. And this is why we thought that where the banking is going and taking a step back and thinking about why this what is the motive behind this regulation was central. I'm not going to present the whole paper, but the core of the idea is as following. So first of all, I'm showing you the bank lending to corporations in the US. And so what you see is a span of late 90s through 2024. And we're looking at bank loans as a fraction of total loans, which is a blue line, and bank loans as a fraction of total credit. And you can see that there has been a substantial shift. Where we start and where we end is quite different. If you compare 2000 to 2023, bank loans represented 57% of total loans. By 2023, it's 35%. They represented 23% of total credit. By 2023, it's 13%. So that's one important trend that we have to recognize, because part of why we regulate banking and how we regulate banking is to protect the service that it provides on the asset side. And that is the information-sensitive lending that otherwise cannot be cannot be funded in public markets. So given the trend in the lending, if you layer it up with the trend on deposits, not necessarily connected, but there is also a trend on the liability side of the banks. And so there have been generally a rise in deposits. I'm not putting you a picture here, but the picture on the loans is there is a counterparty to it of what goes on with deposits. The key is there is a rise. By the way, it's proportional to rise in wealth. So that all makes sense if you assume that the same fraction of wealth is held in deposits. Importantly, significant fraction of this deposit is held in uninsured deposits. So now if you think about the balance sheet, on the one side you have a rise in deposits, on the other side you have contraction in the lending, then something has to add up, and not surprisingly there is a rise in holding of securities, which has been at the core of the banking pressures in 2023. In the paper we also make a distinction between larger and smaller banks, and there is a big emphasis on the large banks. So this is a lot of the policy recommendations where we're going to land, they are similar to the points that Pablo already highlighted. One layer to emphasize for me here is our emphasis here is on that these elements especially pronounced for larger banks. And so this is a pattern that you can easily see in the cross-section. Deposits up, lending down, security holding up. So now if you go back to the policy, as I said, there is a choice of deposit insurance, and there were several advocates in that the deposit insurance is the answer. The problem with the deposit insurance, of course, is creation of a moral hazard, right? So that's the cost, as well as the fact that that's the taxpayers' bills that you increase in when you create a deposit insurance. The other policy measure is tightening liquidity regulation. So typically, we are concerned with tightening liquidity regulation because it consumes the balance sheet of the bank. And the reason we care about that is because that's the part that is supposed to go to lending. But it's the lending that is otherwise hard to replace that we care about. And so in view of the fact that this balance sheet of the larger banks is being shifted to security, an asset in which they do not have any particular edge, as a result of that, we kind of emerge in this framework for liquidity provisions, liquidity requirements for the banks and large banks in particular, and the way so from the deposit insurance as being an answer to this particular question. And as Pablo already alluded, we agree also with this idea of the prepositioning of the collateral. This is one thought that clearly emerged from the experience of the SVB, because the use of the lending facilities was not something that was tested, operationalized, et cetera, and so this is a point that vividly, one of the central lessons of 2023. All right. Now, the second point, and I think this might be close to this audience in particular, is I'm going to take you in the direction of where the financial markets and debt markets have been developing. And that is in the alternative space, the liquid assets. Think about private equity, think about private debt. Now, importantly, it's going to touch on pensions. And so I'm going to suggest you a hidden risk in pension, basically rise in short-term lending, short-term leverage that is not necessarily picked up in the balance sheet of pension funds, that is tied to the fact that they've been expanding the allocation to alternatives. This has a very similar spirit of the LDI crisis in 2022 here in the UK, although the mechanism is quite different. Now, the phenomenon of investing in alternative is a global phenomenon. I have a piece with Josh Lerner where we illustrate this point, and it's tied to the fact that the interest rates came down in post-2008. All right, so what is a concern? So, as you know, they've been, with the rise in alternatives and specifically private debt, the point that I'm about to make is not about private debt, it's about alternatives. But I'm putting a picture here from IMF report just as kind of something that you can relate to. This idea of general rise in leverage with an increase in alternatives has been floated around. And this is one of the graphics that kind of summarizes it. And just specifically to this graphic, this is not point of my opening remarks, but in other circumstances I have spoken that this representation as well as language surrounding it is very inflammatory and not accurate, and that's not how I would put it. This is how I would put it. Same colors, green, blue, orange. There are investors, there are funds. The investment in liquid asset classes happens through funds, and there are portfolio companies or underlying firms. Now, these three levers identify the 3 points of leverage. Okay, the two of them I'm not concerned about at all, the number 2 and number 3. The one I'm concerned about is 1. It goes further in that if you want to know granular details, there is 2 types of leverage that can take place at that level. That doesn't concern me either. But subscription lines, that's the important one. So what happens is, even though I'm going to skip the jargon, and if you're interested in it, you can easily pick it up. The word is subscription lines. But what's important is that effectively the investments in the alternative asset classes, be it equity, be it debt, be it infrastructure, happens on a levered basis to a significant degree. Basically, after a pension fund or another limited partner commits to this asset class, there is a line that is being raised by the fund, and it's out of that line the investments are funded for up to a year. And so that creates a leverage that could be demandable for the pension funds. For them, it's reflected commitments to an alternative asset class. In reality, the funding goes out of the credit line that is being raised. The leverage is taken by the fund, which is why we do not talk about it as a pension fund leverage. But let's be clear, was being levered as the assets of the limited partners, in this particular case, the pension funds. And so, to reiterate, the pension funds and European pension funds as well, and UK pension funds as well, have expanded significantly into the alternative asset classes and the liquid asset classes, including private equity and private debt. And underlying that structure, there have been a rise in levered investing. That funding has a leverage underneath it. And so, so the next question is, it could be that the pension funds have internalized it, and they're actually managing their liquidity differently. That would be a great answer. Similarly, like in banking, we think about liability and the asset size matched on the liquidity. But I suspect, and a lot of evidence about pension fund, the fact that the governance is kind of not oriented towards the long-term liquid asset classes, the fact that oftentimes they are under-resourced, I would be sincerely surprised that this is what drives it. Now, here's another sign. If you take it and this is the last point I'm going to make, if you take it a level higher and you say about, okay, well, the pension funds are already loaded up on their investment in alternatives, it's unlikely that from here the fraction of AUM in alternatives will continue increasing, and therefore that risk we need to understand it, but it's kind of stabilized. No, not as fast, because actually the terms on the leverage, that is a function of the activity of the alternative asset class in general. In fact, the push for this underlying leverage from a very short term to something that is now becomes a year on a demandable basis has been increasing. So one thing to watch out is actually the terms on the leverage have been getting a little bit more aggressive and more aggressive. So as far as my concerns emerging from this outside of the banking sector, something that we've experienced in 2022 and a hidden risk that might be looking at us, it's tied to the second point.
All right, Colin.
Hi, thank you. I appreciate the opportunity to participate on this panel. Given my core area of expertise in the U.S. Treasury market structure, I'll focus my remarks primarily on the U.S., but I'll touch on the UK gilt market as well. In my opinion, liquidity in the Treasury market is fragile right now, or more accurately, it's brittle. In non-stressed markets, business as usual type markets, liquidity can be facilitated relatively seamlessly, especially for on-the-run securities. But when volatility picks up, liquidity costs tend to increase at least proportionately with the increase in volatility. And at times, those liquidity costs can cross through a tipping point where they become much worse than proportional to the increase in volatility. There are multiple factors contributing to this liquidity risk, recurring large deficits are definitely one of those factors. Those deficits have led to a significant stock of Treasury debt, while pulling in the opposite direction. Well-intended regulation has crimped the ability of dealers to use their balance sheets for liquidity provision. No doubt everyone in the room is familiar with this situation of that ratio becoming more and more disproportionate. One way I like to look at this quantitatively is by comparing the size of dealer balance sheets to the size of the Treasury market. And if you look at the chart I've got here showing approximately the last 2 decades of data, what you can see is that back 20 years ago or so, The size of dealer balance sheets was actually larger than the size of the Treasury market. It peaked in 2007 at 1.37 times larger. When you compare that to today, the size of the Treasury market has grown fivefold, actually more than that, while the dealer balance sheets are about the same size, or actually slightly smaller than they were, say, back in 2006 or 2007. And so that ratio today is nowhere near, say, 1-to-1. That ratio is now around 19%. I can see that as a very dramatic shift, a huge shift that must have a meaningful impact. Unfortunately, the situation is pretty clearly poised to only worsen. If you look at CBO's most recent budget estimates, which were made in June of 2024, you see expectations in CBO's baseline of additional deficits each year in the zip code of about 6% a year, maybe in the out years as high as 7%. And so this large debt stock is already, according to CBO, which is nonpartisan, very technocratic, et cetera, baked in the cake from 2025 to 2034 to go up from about 100% debt to GDP up to above 120% of debt to GDP. But then, obviously, we just had a presidential election. Markets, I think, broadly expected that regardless of which candidate won, there was going to be an additional increase in the size of these deficits, with an expectation that if Trump was the winner, that increase would be incrementally bigger than if Harris had won. And obviously, we've gotten the Trump outcome. And so I did a little bit of a back-of-the-envelope analysis here. There's clearly a whole lot of policy uncertainty about exactly what the Trump administration will choose to implement. But the simplifying assumption I made here is that Trump will choose to extend his Tax Cut and Jobs Act tax cuts that he passed in his prior administration and extend those out through 2034. If you assume that a number of the other policies he might implement, for example, raising or putting tariffs on countries around the world, which would be revenue positive, cutting corporate taxes, which would be revenue negative, et cetera, if I guess make the assumption that that unknown set of policies cancels out, that leaves me with the TCJA extension. I used an estimate of that of about $4.9 trillion over this period, and I just added that to CBO's estimates. And what that adds is an extra 1.25% to 1.5% a year over this period, getting us to fiscal deficits on an annual basis of more like 7 to 8.5% per year. These numbers just get bigger and bigger. And if you look at that on a cumulative basis, that pushes the total debt stock up another 12 percentage points, up to approximately 135% debt to GDP ratio. So needless to say, this shift is going to put further pressure on Treasury market liquidity. I think a good question to ask as we look at the slide, showing that there's going to be an enormous amount of debt to be absorbed, is which investors are going to absorb all of this new issuance? And an important shift to note, and this is true both in the Treasury market but also in the gilt market, is the shift from what had been primarily what I'll call price-insensitive buyers. So in the Fed's case, or in the U.S. Treasury case, that was the Fed. It was domestic bank portfolios that had deposits growing during QE, and it was foreign central banks. And in the Bank of England's case, that was, or in gilt market case, that was the Bank of England, and it was the pension and LDI community absorbing this risk. All of those buyers in both markets either no longer exist, or in the case of the Fed, are going the opposite direction, or the Bank of England, or in the case of pensions and LDIs, have definitely cooled off their buying. So instead, who is absorbing the debt? It is price-sensitive buyers. It's retail investors, it's asset managers, hedge funds, who are picking up the slack and absorbing the securities that need to be absorbed in both markets. And I think, again, this exacerbates the liquidity risk in these markets, in part because certainly some of these buyers, notably the hedge funds and to some extent the asset managers as well, rely on financing to hold these investments. Needless to say, if either the financing is not available or if the price is not right, these buyers can pull back on a moment's notice. Again, leaving the markets in the face of all this issuance under further stress. So, where else can we turn to try to shore up some of the liquidity in the Treasury market? So I think one clear channel where we could regain some liquidity is from banks. But a key constraint, in my opinion, on bank-driven liquidity is the fact that treasuries, even short-dated treasuries that pose essentially no risk on bank balance sheets, nevertheless continue to count toward the supplemental leverage ratio, or the SLR. Here I'm showing a table that I took from a Fed paper that was published in October that shows that banks in the US do in fact have some buffer between the actual absolute limit on SLR of 5%, if you're a systemically important bank, that is, and the current holdings or balance sheet committed to treasuries that those banks have. And you can see as you look down the list, the SLR for, say, JP Morgan or Citigroup, about 6%. True of B of A as well. Goldman and Morgan Stanley, more like 5.5%. So there is some additional room. You could argue, well, maybe these banks aren't really constrained by this at all because they could push down another 0.5% or 1% on this SLR before there would be a true binding constraint. But I'd note that as was stated in the paper, it's possible that the SLR could still affect dealer treasury intermediation, and I very much agree with that. I think that that banks are trying to be prudent managers. They're very sensitive to the regulatory oversight and to their own risk management. They don't want to be exactly at the boundary. They want to leave themselves a buffer to be safe. And then secondly, it's not lost on the banks that in crisis situations or even periods, say, going over a quarter end or a year end, that having some additional space either for their own accounts or for their clients is likely a prudent strategy on their part. So, I think that from the bank's perspective, they probably see themselves as approximately constrained by the SLR right now. One solution that I hear get proposed to deal with this is a counter-cyclical SLR rule. So let's keep the SLR rule during business as usual times, but if we get a crisis situation such as March 2020, then we can do what the authorities did in 2020, which is we can temporarily lift this requirement for treasuries. And I just don't understand why that would be the right solution. Why have this extra implicit capital charge on banks in normal times if we know whenever banks' capital really is important in a time of stress, we're just going to lift it? It just doesn't make sense to me. So I think bottom line on this issue, if regulators and central banks want banks to play a bigger role in liquidity provision, they should relax this SLR requirement for treasuries and give them more breathing room. If banks are not considered, part of the solution, then I guess you could leave this rule in place, although I still wonder what the real social purpose it serves, given the low risk of these assets in a balance sheet perspective. One more source of market liquidity I'll mention are PTFs, principal trading firms. They seem to kind of always get a bad rap in discussions like this as pulling back liquidity whenever volatility picks up. But it's very hard to find that in the data. What the data tends to show is that principal trading firms maintain constant volumes when volatility picks up. Oftentimes when volatility picks up, overall volumes pick up, and so the principal trading firm's market share might decline. But nevertheless, they seem to run a pretty consistent business in the data, providing liquidity in the market. And just because volatility and volumes pick up, they don't try to bite off more than they can chew. It doesn't seem like a bad thing. But the PTFs seem like a part of the solution. I don't see evidence that they're a growing part of the solution, nor do I see evidence that we should try to push them out of the market for some reason. I've been talking about, there's both liquidity in terms of, let's call it market-making liquidity and funding liquidity. I want to focus a little more directly on funding liquidity here. And the current state of the Treasury market seems pretty good. Bank reserves are likely still abundant, although they are inching slowly towards being nearly ample in the Fed's terminology. One guidepost that I like to watch is the Fed's overnight RRP facility. And you can see in the chart on the right there that facility has been steadily shrinking. This only goes back a year, but steadily shrinking for longer than that now. Nevertheless, there's still $200 billion of excess liquidity sitting at the Fed in this overnight RRP facility. As that $200 billion shrinks closer and closer to zero, that's just another source of residual liquidity in the market that will disappear, again adding additional brittleness to the Treasury market. A question that gets posed is, how much funding liquidity, funding market volatility is acceptable. And in my opinion, a modest amount of funding rate volatility over a quarter end or year end, for example, doesn't seem particularly problematic. In my opinion, that funding rate volatility indicates both to market participants and regulators where and when even incremental tensions might lie. And I think that's useful information for everyone involved in the market. This modest instability comes at some cost. Market participants are savvy and they will price that into future funding cycles and demand slightly higher yields on Treasury securities in order to compensate themselves for that. Sort of evidence of this funding instability, if you look at the chart on the left, you can see at the end of Q3 this year that there was a temporary spike in the SOFR repo rate 15 basis points above the rate that the Fed pays IORB on reserve balances that banks hold there. The fact that it can spike up by 15 basis points even briefly says to me that banks are not able to instantaneously shift reserves into this economically advantageous rate that now for a brief period was higher, but that there is some friction in that process. I think this it reveals that there is at least some shortage of these reserves going over quarter ends, which I think is useful to know. I do, as a market participant myself, and speaking with other market participants, there's some who hold the view that even 15 basis points is far too much volatility, that these funding levels should be, essentially absolutely fixed. I understand why that's advantageous for market participants to be the case, but I do think that for those participants who want absolutely fixed funding rates, they can pay up for that in the form of term repo. To the extent that one funds on a very short-term basis, there should be an expectation that from time to time there will be at least some small risk associated with that. I'd like to switch topics slightly to some of the other facilities that the Fed uses in order to backstop liquidity in the funding market. In particular, I'd mentioned the standing repo facility, the FEMA facility, and as Victoria talked about, the Fed's discount window. I think that there is a common challenge both for the Fed and the Bank of England in encouraging market participants, well, banks in particular, to take advantage of these stressed financing liquidity facilities provided by the central banks. In particular, in the case of the US, the discount window, or for the Bank of England, indexed long-term repo. In each case, both encouraging banks to be prepared to use these facilities, and maybe even more importantly, removing any residual stigma associated with such use, will be important to maintaining liquidity during future stressed periods for these markets. The The Treasury market, of course, is going to move to a centrally cleared repo model in 2026. That could have some small positive impact on liquidity. For example, it'll become easier to test and implement all-to-all trading. And while I'm somewhat skeptical that all-to-all will have a big impact, I hold out some hope that I'm wrong. Some students of the Treasury market structure, such as Darrell Duffy at Stanford, are big believers that all-to-all will have a significant impact. I hope Darrell does turn out to be right on this. That said, I do think there are unintended potential consequences of central clearing, maybe in both directions. I believe regulators expect that by implementing central clearing, there will be more margin held against U.S. Treasury positions, not less. But if there is also successful implementation of cross-product margining agreements between, for example, FIC and the CME, the net result of that could actually be appropriately lower margin in total to be posted on Treasuries versus futures basis positions, not more. I think that could come as a surprise to regulators if that were the outcome of central clearing. On the other hand, if cross-margining is hard to get put in place, and it appears it will be challenging, then there might be excessive requirements for the margin combined on a Treasury versus futures position. In that event, that'll likely lead to wider Treasury futures basis levels, reduced liquidity provision from the hedge funds that are essential to this aspect of Treasury market structure, and again, more liquidity brittleness. So to sum up, I do believe market liquidity is brittle due both to the increasing scale of debt markets as well as to decisions by regulators to constrain even very low-risk liquidity provision by banks. Regulators and central banks will need to make important choices about how much illiquidity in funding markets is optimal, and hopefully will calibrate their policies accordingly. Thank you.
Well, knowing that we had a lot of ground to cover, I've been extraordinarily lenient as a moderator. Now we're going to have to tighten up things a little bit to allow time for questions, and we're going to start with some questions from among the three of you. We want to delve more deeply into that. When we discuss the resilience of liquidity in firms and markets, how should we think about the assessment of liquidity risk management at financial firms, if any of you have thoughts about that? Should we and can we improve liquidity stress tests and those for other risks? Colin, you touched a little bit on funding markets. So did Pablo. You want to make some comments about that. And specifically, Pablo, you talked about a holistic approach, something I completely agree with. How should we improve bank liquidity regulations in a way that supervisors get firms to comply with them? Why don't we start with that list of questions? Maybe Pablo, you want to go first?
Yes, thank you. Thank you very much. Maybe starting with this stress on having a holistic approach to the problem, which was also mentioned by Victoria in her presentation. So let me perhaps put three quick examples. If we want to move in the direction of more stringent liquidity regulation, so we know that there are clear limits to that.
Maybe better, but not necessarily more stringent.
Yeah, but that's about supervision. This is why I was emphasizing in my remarks that it was more about supervising the banks and be sure that we know the liquidity that they have and that is fully prepared, and that the collateral that it is needed for accessing the central bank facilities are ready, etc., etc. But that's more about supervision. But the reality that we are talking, and you were also, Victoria, talking about regulation. But let's put the numbers into context. For example, Silicon Valley Bank, I have here, the bank suffered the withdrawal of 25% of its deposits in one day. And the expectation was for another 60% for the following day. So there are no liquidity requirements that you can fix, unless, of course, you want to kill the intermediation capacity of the bank. But then let's think, this is why, it's not that I think that there is no room to some changes in the regulatory requirements, but I mean, we have to know well in advance which are the limits and the consequences, of course, for bank intermediation. But the same is you can have a similar analogy when thinking about deposit insurance. So there was this proposal also in the US to increase the deposit insurance to now uninsured, some of the uninsured deposits. But we know that the proposal was affecting just a very small percentage of the current uninsured deposits in the US. If we want to move much farther in that direction, then we know that the cost for the banks will be much higher and potentially also for the taxpayer. Okay, so again, let's put the things in perspective. And the same thing with preposition of collateral in the central bank. Well, we know prepositioning of collateral at the central bank is done with haircuts. So again, the calibration of the prepositioning of collateral, the central bank should also be done with care. If you don't want to reduce, to affect negatively the intermediation capacity of banks. So this is why probably a holistic mix of measures, including and even I would put it a big emphasis on supervision, including stress testing, not only at the individual level, but also the systemic nature of liquidity, including non-banks. Okay, and this is something that, for example, we, Steve is there, Steve Cecchetti, we are trying to perform at the European Systemic Risk Board, try to do this stress test not only to banks and non-banks, but also to mix and to do a complete stress test to the whole financial system. I think is absolutely key. But expecting to have a single bullet to solve the problem, I think is the wrong approach.
Right. And to be clear, the proposal in the G30 report for prepositioning was calibrated as a percentage of uninsured deposits, so to create an incentive not to have uninsured deposits. And the Bank of England, as you know, is also doing a system-wide exploratory stress test, similar to what you're talking about in the ESRB. So, Victoria, the broader point, as Pablo mentioned, is what about the connection between banks and non-bank financial institutions? And we used to think of them as spare tires in Alan Greenspan's terms. Now we see how interconnected they are, and indeed how there may be a circle of risk, which you alluded to with the pension funds. But I wonder if you think it's broader than that, and how do we address those issues?
Can I add to Pablo's comment first?
Sure.
I think that you ask a question of risk management at the banks. And I think that Silicon Valley is a fantastic example of how...
Of its failure.
Of how complete lack of expectation. The ex post, we know that there was a significant, the nature of their clients was creating the significant correlations on withdrawals, right? And so, and in fact, that's a perfect lesson. There is also something for us to reflect in that Silicon Valley Bank stands out as a bank that falls outside of stress testing inside, and yet it's a bank that's been growing at such a quick pace. And we are incapable of kind of direct our stress testing capacity to something that is ballooning in our face, right? With that, let's transition to alternative space. So I want to reiterate the point that I think that there is maybe at some level being generally and unclearly scared of the alternative space is not a bad idea because it leads us to look into it. But I want to be specific in that I'm worried about particular channels of it. Actually, the current interconnection between banks and the alternative space, I do think that we need to dig a little bit deeper, but that said, so the one thing that the alternative space cannot do and that the banks can is provision of liquidity. And that's tied to the nature of the balance sheet of the bank. So what that means is that private debt funds for all its trillions of dollars are not a natural balance sheet for provision of revolving lines. Right. And yet they do provide some revolving lines, and thanks God, because that's working capital and that's kind of important, we know that. All right, well, where those revolving lines come from? They come from banks, right? So what happens is that the private debt vehicle loads its portfolio on the loans, and it gains that, it takes a revolving line from the banks. Now, that typically comes at a very senior level, so it's not that terrible for a bank. There's also some insight, at least within the Fed, and this is something that central banks should be looking with the data that they see, because they can see how the banks market internally. There is a credit rating, internal bank credit ratings that is assigned to it. There is a pricing that we can see from that. From what I've seen internally, there is actually banks thinking about it very carefully. So between the fact that it's structurally, so yes, there is, first point, there is important interconnection between the non-bank lending growing and the bank lending, and that comes in the form of this liquidity provision. Structurally, it is senior. Internally, it seems like there is a lot of attention that banks, a lot of thought that goes on the bank side into this. But of course, this is something that we should keep track of in a systematic way.
Great. So I think that leads me a little bit to you, Colin. You talked about the plumbing of the system and whether or not, as we move to central clearing, both for Treasury collateral and Treasury repo, that there's one view that says that's going to increase the demand for liquidity. If we combine it sensibly in other ways, it may reduce it. But what I'm thinking about is in stress. What is likely to be the outcome? Is it going to really help, or is it something that is going to be, contrary to what Daryl says, maybe a little bit misleading?
Well, I think in part that could depend on the nature and the type of the stress and how extreme it is. I certainly would imagine that if you talk about a 2008 type scenario, where the source of the stress is that you cannot trust any bilateral counterparty, having central clearing is going to be very helpful versus the alternative. But in stress scenarios that are not quite that dramatic or extreme, and one hopes that a lot of the sort of regulatory oversight that's gone in place after 2008 at least reduces the probability of another 2008 for many decades to come. Sources of stress and illiquidity might look more like just the system being short of cash for some reason. So I don't distrust you as a counterparty. I think you'll probably still be there tomorrow. You're just not extending the same amount of credit today as you were last week or last month. And in that scenario, I'm skeptical that central clearing is going to play a big role. Another suggestion that's out there is having FIC be a participant in central clearing. That obviously would be I'm sorry, not FIC, but the Fed being
SRF,
a participant.
for example.
Two different things.
And yes, absolutely. And that would be potentially a game changer in terms of the amount of liquidity that could be pumped into the system through the central clearing channel. But that's much more of a fanciful idea than anything that's implementable right now.
Right. So last question for all of you thinking about what we've been discussing. Obviously, central bank backstops and all the discussion and rules and governance around them are hugely important topics that are being discussed right now. Any thoughts about those, like those from the G30? Pablo, maybe you want to start. What should be the governance? How about asset purchases? How should we think about the governance around them?
Well, perhaps for me the most interesting aspect and something on which we have still to learn is the connection of the topic we are discussing now, liquidity, and including regulation of liquidity and monetary policy frameworks. Something that initially we wanted also to touch upon. And this is a complex and evolving issue, and this is why I think the last mile of the central bank's reduction of the balance sheet is going to be critical and has to be done with great care. Well, we know for sure that the monetary policy frameworks of the central bank fix the average opportunity cost of holding reserves. That's by definition, but not only the average, but also the marginal, both of them. At the same time, one could claim, looking at regulation and banking regulation, that is not clear that it explicitly generates incentives for banks holding reserves. But when you look at more detail, for example, again, to supervision, in stress testing, when you are basically looking at how banks are able and how quick they can monetize their assets, for sure you can create a certain incentive for banks to hold reserves as compared to other level 1 high liquid assets. So the interconnections are obvious. At the same time, it's also clear that banking regulation, the banking regulation that has been developed for very good reasons during the last decade, has affected for sure market transactions, and in particular the unsecured market. And this is why, I mean, the development of this market is interbank unsecured market is so complicated. On top of it, now we have all that we were discussing, in particular Victoria and myself in our initial presentations, on these new developments, digitalization, social media, that could create an incentive for banks even to increase, in addition, the reserves that they hold. So, in other words, I think that there are structural elements of banking regulation that interact with the operational frameworks of central banks on the one hand, and there are all other more conjunctural issues that we need well, conjunctural, neo-structural, new issues, not necessarily conjunctural, probably of more structural nature. And this is why it's true that the reduction of the balance sheets of the central banks has gone very, very smoothly, also because central banks have done in a very gradual manner. Communication has been also very, very clear. But now that we are, in some jurisdictions more than in other, approaching the last mile of this reduction, I think we have, or central banks have, to be particularly careful.
Victoria, you mentioned that some of the alternate investment managers, non-bank financial institutions, get credit lines through, liquidity lines through the banks. Mm-hmm. Should they have more direct access to central banks, and under what circumstances?
And it relates to my opening slides. I do not worry about the vehicles themselves. And especially in the current state, and I don't see why would it change. Much of the all of the private equities happens through the closed-end funds that typically sits on a lot of what's called dry powder, in other words, liquidity. In the private debt space, only a third, and that's in US context, it's actually even less than that in Europe, of the vehicles have this element where they depend on the market funding. As a matter of fact, if I think about the US composition, where a third depends on the market funding and 2/3 of them are doing roughly the same thing, issuing private credit of one kind or another, and are sitting in a lot of dry powder and a lot of liquidity, well, that's a perfect market mechanism for them. If one type of vehicles goes under, the other ones will step in. So as of right now, I don't see a need other than data, liquidity needs to support those vehicles. Where I do see a problem is the fact that there is recent entry into alternatives by limited partners, and I'm specifically concerned about pension funds, and there are a couple of UK pension funds that are heavily exposed on that. Is there that there is a leverage is being tied up with a investment in alternative. It's effectively, in the short run, it's a levered investment. And there I'm concerned that we can run into a squeeze similar in nature like the ones that UK experienced in 2022, which in turn can bounce into the public market and create a huge mess, given everything that Colin mentioned. So that's how I would think about it.
So Colin, I'd like your thoughts on some of these issues, maybe for access by CCPs in the United States who otherwise don't have access to the central bank. But in addition, since you're such an expert on Treasury markets and have thought a lot about the Treasury cash futures basis trade, any thoughts about the risks there and in normal times, how that provides liquidity to the system, but in stress times with the unwind of the leverage, it might not. And what should we do about that?
Yeah, a couple of thoughts about that cash futures basis trade that gets so much attention. One is that I think there's been a lot of good work in the last 3 to 6 months from TBAC and from other sources detailing why that market structure exists in the first place. And the driver of the richness of futures contracts are various incentives that theoretically unlevered asset managers face that make it appealing to them to hold treasury risk in the form of futures contracts. And in order to entice the market, someone in the market, to sell them those futures contracts, those asset managers are willing to pay a rich price for the futures. And the hedge funds who hold those basis positions are facilitating that. They're the other side of the trade. So, firstly, if there were changes made such that asset managers no longer had an incentive to hold futures instead of holding cash treasuries or using short positions in treasuries as well, there would probably be a dramatic reduction in the size of those basis trades. There's no plans I'm aware of to make changes like that. So in the meantime, while this market structure exists, to the extent the size of the treasury market grows, that has correlated with the size of the basis trade growing. So we should expect it to get bigger and bigger, not because hedge funds are becoming more risk-taking, but just because the market is getting bigger and the need therefore will grow for it. In most normal, sort of business as usual market environments, this is just a normal part of the market, doesn't pose a lot of liquidity risk. In stressed environments, the biggest risk is that the banks who are providing financing on the treasury repo side of this trade pull back some of that financing because they can no longer extend as much financing during a stress period. And that can cause holders of that basis trade to become forced liquidators, whether they want to hold it or not. And that can exacerbate moves, at least in the short run. When research, analysis has been done, say in a period like March 2020, you kind of get like mixed effects of that. It seems, from what I've seen, that maybe, for example, real money holders of treasuries like central banks played at least as big a role, maybe a bigger role in some of the liquidation seen in the treasury market during that period. I also do think that there is a real moral hazard problem in that holders of these basis positions do believe that if things become too stressed, they're not going to go bankrupt, but instead the Fed is going to come in and save the day. And they were right about that last time around.
Yeah, so it's something that doesn't originate stress, but it certainly may amplify it in a stress scenario. Now it's time to turn to questions from the audience. And I see a couple. Why don't we start right over here? And then we'll move over there. And here and here. Please identify yourself and
Jakob Lauer from Handelsbanken. So thank you guys for an excellent presentation. In particular, you mentioned this sort of massive outflow in Silicon Valley Bank and the sort of difficulty for any bank to sort of survive such a large outflow. So if one takes one step back to the sort of asset liability sort of one-to-one, where would you want to see sort of strengthening, or what sort of added regulation or practices to facilitate or avoid this to be a problem in the first place?
Before we answer that, why don't we take this question over here?
Thank you. My name is John Whittaker, Lancaster University. I'm interested in looking at the ample reserves regime in US, but also in Britain. And I noticed that, in the last year or so, there's been a facility put in place by the Bank of England allowing the banks to borrow from the Bank of England at bank rate, collateralized, but for week loans, one week repos. Now, looking at the data, in the last sort of few months, 5 or 6 months or something, that's the amount of drawing off that facility has risen from 0 to about 50 or 60 billion. I wonder why, and it seems to me not make too much sense. So some banks have got loads of reserves, ample reserves, while some others are borrowing from the bank, also at bank rate. Why don't they just sort of deal amongst themselves and sort it out? Or does this indicate some kind of stress that we ought to know about?
Sure, good questions. Okay, why don't we answer both of those? Anyone want to go first?
No, maybe on the first one again. I mean, of course, I cannot deny that there might be a need to change regulation, and that we might increase, for example, in the liquidity standards, the requirements for certain segments, in particular, of the assets. But let me stress that I don't think that this is going to be the solution, and in particular, we want to face and solve the systemic issue. If we focus in particular on entities, on banks, I'm more of the opinion that it's supervision. Also because in the case of Silicon Valley Bank, the issues were much more of a solvency nature, failing risk management, the business model, if you want to put it this way, of the bank, and there are no standards that will give you the right solution to this. But for sure, supervision, if it's sufficiently strong, it will identify. It's able to identify the problems and to push the bank to do the right things in the right moment. So again, I will put more the focus on supervision rather than on regulation, even if I, of course, accept that there might be some need also for stringent requirements.
Yeah, I'm sure that comment's going to, trigger some other alternative views about that. Victoria, do you have any thoughts?
If you allow me, I'll reply to the reserves, hoarding of the reserves comment. There is actually, on the one hand, it's a puzzle. And in fact, it was already a puzzle with this 2020 and 2023 episodes in the US. There is, I think that the answer that feels true to me is the research agenda by Viralacharya and Ragurajan. And their basic point is, so they first spotted this phenomenon where banks are sitting in a lot of reserves, and yet they are not providing liquidity, they are not using it. And their basic point is that this whole experiment with the QE and the ample reserves made banks lean into creation of liabilities that back this reserve structure. And as such, even though it looks like liquidity, it's actually not liquidity. Let me give you a concrete example. And they have a follow-up empirical paper where they try to tie it to revolving lines in particular. And there I was not yet fully with them. But now if you tie this to our earlier point that the private debt, which is in a couple of trillion dollars at this point, we said that the revolving line part for that business comes through banks. Well, that's one of the expansion of the revolving line facilities from the banks. And so this kind of ties, if on the liability you stick in your neck on providing the liquidity, then you need to sit on liquidity. So it is a puzzling question, and I think that answer kind of makes a lot, I think that has a lot to do with what we see.
Any thoughts? Could it also be the composition of liquidity and where it is, not just in the aggregate?
I think that's certainly possible. I mean, one thought I wanted to add, just from my discussions from people at various banks who are very involved in making some of these funding decisions, or like how they're going to allocate even on a daily basis the bank's capital, is like how different that process has become today versus call it 10, 15, 20 years ago. And I think this is wrapped up in the brittleness of the system overall. Is that it used to be maybe a person in Treasury made a phone call to one other person, and 10 or 20 or 30 billion pounds or dollars of liquidity could shift from one use to another use to take advantage of an arbitrage as small as a few basis points. And now that same process at the largest systemically important banks is something like a 72-hour process with committees involved and sign-offs and so on and so forth. And so that means both that, obviously it takes longer, but also it raises the bar before someone wants to initiate that process. And if it doesn't look like it's going to be, that big a payoff, do you want to jump through all the hoops that are necessary, even, within your bank, but necessitated by the changes in regulation and structure of these institutions, to shift reserves around? And so I think a lot of times, unless the payoff is going to become quite large, it's just not going to happen.
Yeah. Okay, let's see, we had a question over here, and there was one over here in this row.
Rhys Bitter, King's College London. I wanted to pick up on Dr. DeCosta's comments on the increased run risks and on liquidity provision for non-banks and combine it with Victoria's points as well. It made me think of the CBDC and stablecoin debates. People often wring their hands about bank disintermediation, but as Victoria noticed, that's arguably declining. And this goes on top of the whole too big to fail, too complicated to fail problems that we know they have. I was just wondering if the panelists think this is informative of stablecoin policy, maybe allowing them to take on more of a role in payments. You know, if the stablecoin is unambiguously backed by treasuries, gilts, or indeed digital gilts, based on last week's news, then should the central bank encourage them and set up lines against them, maybe pre-positioned, to enable singulars of money and to take banks out of, fragile banks out of the role of payments, or at least shrink their role?
Do any of you have thoughts about that? I do.
They should defer to Dick.
Yeah. Stablecoins are really too small to think about as having any systemic impact at the moment, but they are growing rapidly, and the potential for that rapid growth, I think, is something that every central banker is going to watch, and they're going to watch what happens to regulation, particularly, as Colin mentioned, in the wake of the election outcome that's likely to be much more favorable to stablecoins in particular and digital assets in general in the United States. And maybe that will change the backdrop, encourage more rapid growth, encourage the use of stablecoins. I mean, in many ways, they have characteristics of money market mutual funds, but with less governance, less oversight, less transparency than what we now have. And so stay tuned. Let's see, we had one over here, and we have one right here.
Richard, can I add a reference for that, since I've been spreading here the references? The Boston Fed annual conference this year was related to financial innovation and the interaction with the banking system, and they had a panel and a paper presented on the subject. So I think that related to the stablecoin, I think that might be a good insight for how to think about, in addition to what Richard said.
Hi, Guglielmo Santamaria from the Bank of Italy. My question is mostly to Professor Ivashina. You've spoken of your concerns about especially liquidity and exit options for pension funds and other LPs investing in private equity. I was wondering whether you had an opinion on the state of the secondaries market and other exit options developing, such as private equity collateralized fund obligations.
So the second, I'm not sure exactly what you're referring to, but so the first point you raised is about the secondary market and private equity. So let's start with the fact that even 2022 US event, pension funds are sitting on 80% of liquid securities, and yet it's a liquidity squeeze, right? And a lot of them are treasuries. So that immediately starts you with that it's even with generally accepted liquid securities, this is a problem. Where we are with liquidity on private equity is nowhere close to that. So yes, the secondary market as compared to where it started, which is zero, has been growing a lot. And is projected to continue to grow, but it's a small fraction of the overall market. Moreover, it's a market without trading muscles, because it's all purchased by the secondary vehicle, and that's the dead end of it, right? So if you want to sell your position, you sell it to this expert at a 10% discount, roughly, if it's a good date at an 8%, and so it's not really a solution for that.
Okay, right here.
So it seems a lesson from the last couple of years.
Your name and identification.
Simon from Simon Yule, Positive Money. So it seems like a lesson from the last couple of years is that financial markets are essentially going to be bailed out almost endlessly by central banks in the provision of liquidity. So it seems a sensible solution in that the terms of that liquidity provision are set up before, so the pre-positioning or pawnbroker for all seasons approach seems sensible. However, is there not a risk that you could potentially increase the risks of kind of regulatory arbitrage in non-bank institutions or stablecoin issuers issuing more money-like liabilities without the corresponding regulation, and therefore should any such pre-positioning also be extended to non-banks or anyone issuing short-term liabilities that are money-like? And how would that work? Would it be intermediated via their own banks, or should it be via the central bank directly?
Okay, so do you all accept the premise of the question? And if not, why not? And if not, tell us how we can make things more resilient without having the Fed or the ECB or the Bank of England charge over the hill to rescue everybody.
Well, coming from a former chair of the Basel Committee, the only response that I can give is the correct regulation and adequate supervision. That's clear, no? And again, many of the things that happened last year were related to supervision that was not sufficiently strong. Yeah, of course, this doesn't mean that regulation and supervision will be in a position to solve all the problems, and this is why we need to think about these backstops, but not to give the impression with the moral hazard that this would be behind it of central banks being always the solution to the problems.
And I think one common theme that you all raised was, where do we draw the line, and how do we think about normal fluctuations in the market versus those that can turn systemic and those that can create dysfunction in the financial system? Any other thoughts?
Yeah, I mean, I think I essentially agree with your premise that it does seem like the revealed preference of central banks around the world is to intervene, and that it's, you look at the examples of the bank failures in March of 2023 in the US, and it seemed like any bank that fails is systemically important as it relates to its depositors. So if that's the system, if all deposits are implicitly guaranteed, even though they're not explicitly guaranteed, then I think to some of Victoria's points, then that should be rethought out, and some combination of carrots and sticks should be put in place so that this is priced accordingly ex ante and not just bailed out ex post
in the moment. Let's see. How about in the back over there? Yep.
Yeah, thanks. David Marsh from ONFIF, and it's a question for Colin and Pablo. You spoke about the two sides of the Atlantic in your slides, and I was struck, Colin, you seem to be getting really worried about the US and 120% of GDP debt. Well, we've got all that over here in spades. So the question for you, Pablo, is that at least in America they do have a unified system. They have this centralized clearing, they have repos and things like that. We're very fragmented over here. How worried are you, given the fact, Pablo, given the fact that we've had this ECB financial stability review last week, which seemed to sound a few alarm bells? How worried are you about this fragmentation having an effect on liquidity at times of stress? Because we had your two former colleagues, Mr. Nagel, Villoy de Gallo, sounding off the clarion calls of alarm on this on Friday. It should be the governments doing that, not the central bankers.
Yeah, well, I mean, if you look at the financial stability reports that are produced by the European Central Bank, but also by national central banks in Europe, you will find that probably one of the main concerns and origins of potential financial stability in the future is related to public debt. That's clear. And for sure, in the case of the European Monetary Union, there is always the potential risk of this driving to fragmentation, no? And this is why from the ECB side, but Bank of Spain side for many years, this emphasis on first having an adequate fiscal framework. Now we have this new stability and growth pact, by the way, put all the emphasis on debt sustainability and I think this is very good. But of course now meeting the requirements that are derived from this new fiscal framework are of the essence, no? Precisely to try to avoid, David, the type of risk that you were emphasizing. Well, the good thing, if you want to be positive here, is that I think most governments have already sent to the European Commission the budget plans for the following years, the medium-term budget plans, and on paper they fulfill the criteria of the new SGP. So now, of course, the jury will be on the implementation of these fiscal plans that have been sent. And I think it's of the essence for guaranteeing the sustainability, public debt sustainability in Europe, that this is the case, also to guarantee the credibility of the new framework.
I think we have time for one more. Over here.
Hi, this is Nikos Panigirizoglou from JP Morgan. I'm a bit confused about this argument that more supply of government paper implies low liquidity. In fact, I would argue the opposite. We had the German government bond situation. A few years ago, there was not much supply of German government paper. The repo market was not functioning. At the end, they corrected that. We have more supply and more liquidity as a result. So, question for Colin.
Can I take that? Yeah. Look, I think, I guess there must be a U-shaped curve around this, obviously. If a market is too small, and I think back to issues in the U.S. bond market circa 1999, when we were concerned that there would be that we'd run out of treasuries, there'd be no more treasury issuance, and that we'd have to spread corporate debt issuance off of Fannie Mae or Freddie Mac benchmark bonds because there would be no treasuries left due to the peace dividend surpluses under the Clinton administration. Obviously, we fixed that problem really quickly and issued a lot of debt soon thereafter. So I think on one end of the spectrum, when you look at the relatively small size of the Bund market, coupled with especially call it like the mid 2015 give or take, when QE was happening and there weren't even lending facilities in place yet, and there was a real shortage of collateral, that made the market much less liquid, and so getting incrementally more issuance and providing financing facilities and so forth from the central bank liquefied that market. I think that what I'm worried about is the opposite end of the spectrum. And by the way, this is not a short-term worry of mine. Notwithstanding, like both the current size of the stock of debt, the expected deficits that will be run, and the likely changes in tax law and so forth that will make those deficits even larger. None of that's a secret, right? The whole market's keenly aware of that. And yet term premium in the US market is still well below long-term historical averages. So that tells me that there's an extraordinary depth of demand for US Treasury securities to absorb a lot more paper. But that also tells me that there's going to be no impulse from the market to create political will to address the size of these deficits. And so what I think will have to happen is the Treasury market will just have to grow and grow and grow until we break through some threshold level that does get a reaction from the bond market. And then the bond vigilantes, as they did in the 1990s, will strike again. And hopefully then there will be some political will at that point, but it'll be a worse starting point.
All right, well, with that, please join me in thanking our panel.
It's lovely to see everyone still here for the last sessions of this fantastic Bank of England Watchers Conference. I'm Chris Giles, economics commentator at the Financial Times, and I write a weekly newsletter, Chris Giles on central banks, on central banking issues. So sign up if you haven't signed up, and if you've got a cheapskate FT subscription, upgrade and then sign up. We're here to talk about a reaction to the Bernanke review. I've got a great panel with me to discuss it. So as far as you're concerned, on the far right is Charlie Bean, former Deputy Governor of the Bank of England and general person who knows everything about everything. Next to him is Petra Gerards from Cambridge University, and next to her is Jan Vlieger, who's now at Millennium but formerly of the MPC. We're going to do the same format as the other panels. I'm just going to say one thing before we kick off, which is that we were very lucky this morning to have Deputy Governor Claire Lombardelli talking about the Bernanke review, and my completely non-AI generated human summary of that is it's big, it's happening, it's going to take a long time, and it's all terribly difficult. Charlie.
Thank you. With that introduction. Well, the recommendations, of which there are sort of 12, although they have lots of parts, in Ben's report fall into 3 buckets. And that was clear actually in one of the slides that Claire had in her presentation this morning. So the first bucket relates to the infrastructure that underpins the forecast. The second bucket relates to the forecast process itself. And then the third bucket relates to communications around policy. Well, starting with the first of those buckets, clearly the IT and modelling infrastructure at the bank has degraded somewhat, certainly since I was there, and fixing that obviously needs to be a priority. And as Claire said, there's quite a lot of work potentially involved in doing that. Now, I don't have anything really to say on the IT infrastructure side of things, but I do have some thoughts on the modelling infrastructure. Ben's report provides a checklist of desirable features of the model, but he's not prescriptive on the sort of model that the bank should use, and notes that some central banks use a semi-structural macroeconometric model. You might think of it as sort of somewhat old style as their organising framework, and others rely on dynamic, stochastic, general equilibrium models, which are more familiar to people in the academic world these days. In anticipation of some remarks I'm going to make in a moment about the role of the forecast in the MPC's deliberations and the potential role of scenarios, I would want to stress the twin importance of having a framework that the committee can relate to and understand, and which is also sufficiently flexible to allow scenarios to be constructed rapidly. Now, the present setup, Compass, and I blowed if I can remember what Compass actually stands for, but actually dates from the tail end of my time at the bank, and it was actually supposed to deliver that, but I think in practice it seems not to have reliably done so. I think it's worth saying that bank staff are keen on DSGE models, because they think it represents best practice at the academic frontier, and that they're therefore superior to more ad hoc semi-structural macroeconometric models. While it might be true that they constitute academic best practice, I think it's important to recognise that micro-founded DSG models are really just laboratories within which to study economic processes, and are not really descriptions of the real world, and in their way are just as ad hoc as semi-structural models. But in practice, they're much less flexible and unsuitable for executing fast turnaround simulations of alternative scenarios. So in my view, the bank would be wise to revert to using a semi-structural macro model as their central forecast organising framework, then with DSGE and all the other models in the suite used to inform the necessary judgments involved in forecasting and simulation. And I note from Claire's remarks this morning that she said that the bank is putting some more resources into developing such a model, and my guess is that going forward that will turn into being the central organising framework, at least, for the forecast process, which is the second bucket of Ben's report. Now, I think in considering this second bucket of recommendations, it's worth emphasizing that the forecast is indeed a process. It's not just a table of numbers that are input into the MPC's deliberations along with data and stuff like that. This may not be fully appreciated by people who've not worked inside the bank and seen the MPC process from the inside. There is actually a very good discussion in Ben's report and quite a good chart, figure 2 on page 25 of the report, which actually lays out schematically the forecast process and brings home the way the forecast enters at multiple points, or the discussion evolves at multiple points. And the forecast is sequentially a vehicle, firstly for processing data news at the start of the forecast round, secondly for exposing the key economic issues that the committee need to debate, thirdly, and this is as the end of the round approaches, it helps committee members form a view on the appropriate policy response. And then finally, after the policy decision, is central to explaining the committee's decision to the outside world. And the modelling framework needs to be appropriate to all of these 4 tasks, which is why I said earlier that flexibility is so important, and especially if greater use is going to be made of scenarios, as Ben recommends. Now, in this second section of the report, Ben really has a couple of major recommendations. The first of these is to try to avoid what he terms incrementalism, which arises from the fact that each forecast starts from where the forecast at the previous round finished up and then tweaks it at the margin, if you like. But that starting point involves a load of previous judgments from earlier forecast rounds, and there's a risk if you operate in this way that you don't realize that things are going more seriously wrong beneath the surface. Now, I think the key here is not to say we're going to start each new forecast with a blank sheet, but rather that the bank needs to be much more systematic in ex post forecast evaluation. Central forecasts can turn out to be different from the ultimate outturns for a variety of reasons. And these include revisions to past data that essentially change the starting point. Second, inappropriate conditioning assumptions, for instance, on policy. Thirdly, an inappropriate economic model, inappropriate coefficients or something like that. Fourthly, inappropriate committee judgments. And finally, and importantly, unexpected and essentially unpredictable events, such as the pandemic or the invasion of Ukraine. Now, the last of those 5 sources of forecast error is usually the source of big forecast errors, and we've seen that in the recent past, but the others can be important at various times too. And in my view, the best way for the bank to avoid incrementalism is for the bank to be much more open and rigorous and forensic in unpacking the sources of forecast error. Now, the OBR, where I also spent a 5-year term after I finished at the bank, is actually required by law to produce an annual forecast evaluation report, which actually seeks to do this, and I think is an extremely fruitful endeavour. I was very pleased to hear from Claire this morning that the bank has envisaged committing themselves to producing something similar to this, which goes much beyond the rather cursory annual 1-page assessment of forecast performance, which the bank has tended to produce in the past, certainly including when I was there. So it sounds like the bank are moving in the right direction here. One thing I would say about it, though, is to do this properly will probably require more granularity in the description of the forecast, certainly if it's to be understood by outsiders. The other key recommendation that Ben has in this part of his report, but it reappears in the subsequent communications section, is to make greater use of scenarios, simulations under alternative assumptions about the behavior of both exogenous and endogenous variables, how the economy functions and the like. Now, I should say I support this recommendation very strongly. I think it's the single most valuable contribution of Ben's report. Why are scenarios useful? Firstly, I think it allows the committee to bring out the nature of the risks and uncertainties explicitly in a way that the fan chart doesn't really do. The fan chart was an important innovation when it was introduced. It's about 30 years ago. Yeah, it's nearly 30 years ago. Almost as old as me. I think in practice, though, it's probably failed in communicating uncertainty to the broader public. The good thing about scenarios is they're quantitative narratives of different views of the way the economy may unfold. And I think they help people to get their minds around risks and uncertainty in a way that just a fan chart doesn't. The second thing that scenarios are useful for is that it allows the committee to handle circumstances under which its normal conditioning assumptions might look unrealistic. So that includes cases, for instance, where a future fiscal policy reaction might be likely. Examples here included the repeated extensions of the furlough scheme during the pandemic, and then more recently the support to households during the recent energy price spike. The bank, when carrying out its forecast before those fiscal announcements, but nevertheless knowing that they might be likely, and there's quite often reference to that likelihood in the minutes, but no potential quantification. And even though they would be stylized, I think scenarios of those possibilities might be helpful when it would be awkward to actually put it into a base forecast. This does naturally lead to the question of whether the bank's forecast should be conditioned on the committee's own projection of the path for bank rate rather than market path. Now, unlike the two people who are going to speak to me, who speak after me, who I think are enthusiasts for this, to be honest, this is something I can't get very excited about. As most of the time, the committee's own projection of bank rate ought to be pretty close to the market path. If, firstly, outsiders share pretty much the same view as the bank on the outlook, and secondly, there's a common understanding of what the Monetary Policy Committee's collective reaction function is. And I do think that there can be a real danger if you go down the line of saying every time we have to have the committee's rate path, that you end up succumbing to what I call the narcissism of small differences. The main reason things will be different is not because of the marginal differences between the market path and the committee's view, but because there are other things that will happen. The pandemic, the invasion of Ukraine, and so forth. But I'll stress I wouldn't be categorical about this. And I can imagine circumstances under which an alternative interest rate conditioning assumption makes a material difference and is better sense. And I see no reason under those circumstances why the committee shouldn't adopt it. And here again, I would note that the OBR has on occasion, including in its most recent economic and fiscal outlook, assumed not the market rate path, but that there would be a subsequent monetary policy reaction to the fiscal measures, in this case, the budget. As I say, I'm not inclined to think this is a big deal. I think for most of the time, sticking with the market rate path should be fine. But if circumstances dictate, then the MPC shouldn't feel shy about showing what happens under an alternative viewpoint. The one thing I would emphasize with scenarios is the value of making them sufficiently different from the base case to be revealing not only of the risks, but also the committee's likely policy response. I do think this is one of the value scenarios, that it should help the outside world to get an understanding of how the committee will respond if there are unanticipated events. Now, in that respect, I would say that looking at marginal variations, as we used to do in the old Table 6b of the inflation report, those of you who can think that far back, is actually not desperately revealing. And I have to say, when I read the latest monetary policy report, I did worry a bit that the bank might be about to make the same mistake in describing its three non-quantified scenarios, which, if you want to put it cynically, as opposed to the way Claire described them this morning, case one is no persistence, case two is a bit of persistence, and case three is a little bit more persistence. However, I was actually rather heartened to hear from Claire this morning that actually, compared to what was published this time around in the monetary policy report, the internal development of the use of scenarios has actually gone a good deal further than that, including looking obviously at scenarios which really are fundamentally a bit more different and do involve endogenous policy responses, which I think is key to their usefulness. So it sounds like the bank probably heading in the right direction after all. Now, I'm running a bit short of time here, so I'm not going to say too much on the communications bucket, and that may get picked up by later speakers or in our general discussion. But there's one area I just want to comment on, and where I do want to dissent from Ben's recommendations. And in particular, he suggests that the bank should ditch fan charts altogether. Now, I see scenarios really as a complement rather than a substitute for the fan chart, but I would change the understanding of what the fan chart represents. For a long time, it's been described as representing the committee's subjective probability distribution over the range of possible outcomes. And Ben's quite right to criticise in his report the lack of real foundation for that in the way it's constructed. But nevertheless, I think it remains a descriptive tool for describing essentially the historical uncertainty that has attended forecasts. So having the fan chart simply mechanically calibrated to a suitable window of past forecast errors and leaving it as that seems to me quite useful. If you don't do it as a fan chart, you have to do it as a table or candle charts or something like that. The fan chart seems to me as good a visual description as any. So that's one of the few areas, I have to say, where I depart from Ben's recommendations. As Claire said this morning, there's lots of work for the bank to do. And we shall all look forward in being involved with it as you take it forward. Thank you. Thank you.
Gotcha.
All right, it's a great pleasure to have the opportunity to go and discuss the Bernanke review. I hope my slides will be coming up. There they are. All right, I think that many of the recommendations in the Bernanke review are very sensible. In fact, I made very similar suggestions about a year ago at a NISA workshop, which was organized specifically to provide input to the Bernanke review. So I was very pleased to see, some of the things being picked up, including the need to go and make serious changes to the model. Also the importance of learning from past forecast errors and using scenario analysis, especially in times of heightened uncertainty. But also aspects of the review where I think the review hasn't been sufficiently developed. And there are also a few things where I strongly disagree. Okay, so the Bernanke review is actually very critical about the bank's forecast infrastructure and the forecasting framework, and really exposes very serious shortcomings in it. And frankly, it's it's a bit shocking to see how bad it got. And one of the things that's not really mentioned in the report that I think should be addressed is how on earth did it end up getting so bad? So it's suggesting a certain type of negligence that is very worrisome from a governance point of view. Now, the Bernanke review recommends to build and maintain high-quality infrastructure for forecasting and analysis, including a much improved data management software and forecasting framework with a completely revamped or even replaced COMPASS model, which is kind of like the organizing model. And by the way, it stands for Central Organizing Model for Projection Analysis and Scenario Simulation. So how ironic to find out in the report that actually bank staff found it no longer suitable for it and wasn't really using it as a result. So by definition, the COMPASS model is no longer fit for purpose. So clearly it needs to be changed. And given also advances in IT, it's very disappointing to hear bank staff struggling with what seem to be relatively things that should be relatively straightforward. So it's very important to have significant improvement in that, and I'm very glad to hear that that is on the way. Now, the importance of having a changeover of the forecasting framework, in particular COMPASS, is particularly for the UK vital because of major structural changes to the economy. So all countries have experienced the effects of COVID with long-lasting effects. And in the UK, on top of that, also the structural changes due to Brexit, which have had a profound impact on, for instance, the flexibility of the labor market and therefore directly impact on monetary policy making. Another reason why it's also important is because of the large forecast errors. And in this respect, the Bernanke review suggests to provide a forecast process that better supports MPC decision-making, including learning from past forecast errors, and expanding the use of scenario analysis to identify and quantify the risks to forecasts. So I was really delighted to hear that the bank is going to have an explicit forecast evaluation report, and I fully agree with Charlie that the report of similar quality as produced by the OBR with a very good addition to what the bank does. And although the bank has expanded its analysis of past forecast errors from, indeed, it used to be about a page in the monetary policy report. Now it's a bit longer than that. But what it's really lacking, it's just mostly a bunch of graphs and comparing paths. But it's really lacking a proper analysis of what was driving those differences and analyzing to what extent it's due to differences in condition assumptions that didn't work out, or the judgment added by the MPC, or structural problems with the model. And in this respect, as the Bernanke report points out, scenario analysis can also be very useful in terms of decomposing the forecast errors. Scenario analysis is also very useful, as has been mentioned by Charlie, for other reasons, including getting a better understanding of the monetary policy making and the monetary policy reaction function. Now, with respect to the MPC outlook, the Bernanke review recommends to better communicate the MPC outlook and the policy rationale with less emphasis on the central forecast. Now, I do think that in terms of the bank's communication, there is indeed excessive emphasis on the central forecast, although I think that the central forecast does play an important role, especially during normal times when there are no significant risk management considerations. So I think it would be a mistake to downplay it greatly. But the use of alternative scenarios is going to be very fruitful, I think, especially in times of heightened uncertainty. Now, the point where I strongly disagree with the Bernanke review, and actually similar to Charlie, is the Bernanke review's recommendation not to have any fan charts. I think the fan charts are really very useful. So they are a great way of conveying uncertainty, but I would not make that the only way of conveying uncertainty. I think the ideal is, as suggested by Charlie, is to have both a fan chart as well as scenarios that perfectly complement each other. So all in all, I think many changes were overdue, especially after the big structural shocks to the UK economy, Brexit and COVID. And there's really a need for a rigorous public evaluation of the MPC forecast. And I think it's really important for that to be open. So I'm delighted there's going to be this forecast evaluation report. And I also think it's important that that leads to an annual assessment and update of the forecasting models, so that any persistent forecast errors are adequately addressed so that you can prevent them from repeating them. And finally, there's a need to improve communications rather than just change them. And it is important to not just make them more fuzzy, as the Bernanke report is suggesting, especially with respect to the fan charts. It's just suggesting to have some qualitative things that are mostly backward-looking, and an important element of communication would get lost as a result. Then, with respect to scenario analysis, so it refers to comparing projections with different conditioning assumptions. It could greatly improve both internal decision-making and external communications. So improve both the quality of the monetary policy decisions by having a more thorough view and analyzing what's going on, but also communicating that to the public so that they gain a better understanding of monetary policy making. And scenario analysis is a really vital tool in times of high uncertainty. Now, it's important to realize when it comes to the publication of any projection that the full benefits are only realized if the central bank is transparent about the conditioning assumptions, because otherwise you don't know how to interpret the projection. And I would like to add to that, based on what Claire said this morning, that it's also very important that it's the projection owned by the monetary policy makers. And the reason is that a central bank forecast allows the public to better understand the monetary policy decision and to figure out whether the monetary policy decision is in line with the central bank's stated objectives. That only works if you have access to the MPC forecast. Only then is it useful in terms of understanding the monetary policy decision. So I would strongly like to urge the bank to really make that and keep that, because it's very important for transparency purposes. Then, with respect to the conditioning assumptions, so knowing the conditioning assumptions, it allows you to infer what the intentions are of the central bank, and it also allows you to infer, especially with scenario analysis, the monetary policy reaction function. So that's really very useful in terms of improving the effectiveness of monetary policy. Now, with respect to the conditioning assumptions for the MPC central forecast, it's based on market expectations of the monetary policy path. And they need not coincide with the bank's view. So from that point of view, the MPC forecast may not actually represent the outlook that the MPC really has. So there's a potential inconsistency there. Moreover, there's actually an internal inconsistency in the forecast because when it comes to monetary policy, we have market expectations, but for fiscal policy, we use only announced fiscal policy measures, rather than what is already anticipated by financial markets and priced in. So there's actually an internal inconsistency in the current forecast, the baseline forecast. Now, the Bernanke review is touching a little bit on it, but not fully, and it's just like basically suggesting, well, just de-emphasize the central forecast rather than addressing it. The ideal would be to have a forecast based on market expectations, including like anything that's going on in terms of like what's anticipated by markets, so that you have something that's fully consistent with asset prices. That gives you a very accurate way of assessing whether the monetary policy stance needs to be adjusted. But then, of course, it's not consistent necessarily with what the MPC wants. And when you look at scenario analysis, moreover, the monetary policy path on current market expectations is likely to be inconsistent with alternative scenarios. So there's a need to adjust the policy path and asset prices for proper scenario analysis. So it's very encouraging to hear from Claire this morning that in her speech that the bank is going to use an endogenous policy path. But then, if you want to be transparent and have the full benefits, you got to go and be transparent about it. So how is this endogenous policy path constructed? Is it going to be some, monetary policy rule? Then if you're being transparent about it, then that can be very confusing for the public. Because then if it's not really corresponding to what the MPC thinks, then it is not really that useful for learning the MPC reaction function, which is like one of the main benefits of using scenario analysis. So it's much better to use and publish the MPC's projected policy path for scenario analysis. And that extends to the central forecast. Now, that has the advantage that publishing the projected policy path for the central forecast provides comprehensive time-dependent forward guidance. But some people may be worried it could be misinterpreted as a commitment. And that is where I think the use of fan charts is really vital. Because when you look at a fan chart, there's just no way you can mistake that for a commitment to any particular path. It's like intuitively obvious. And very useful for that purpose. So I think that fan charts should definitely not be ditched. They are a very effective tool of illustrating uncertainty. Scenario analysis is basically highlighting possible policy paths within that fan. And it provides very useful state contingent forward guidance for the public to learn the monetary policy reaction function and thereby enhance predictability of monetary policy and improve the effectiveness of monetary policy. So the combination of having both the publication of the projected policy path combined with scenario analysis actually provides comprehensive, time-dependent, and state-contingent forward guidance. So from a transparency point of view, that's kind of like as good as it gets. Some may argue, well, but you don't really want to publish forecasts in times of heightened uncertainty because you cannot really tell much about the future. Well, even in time of high uncertainty, when there are large forecast errors, the publication of the MPC projections is still very useful for understanding the monetary policy decisions. In fact, it's even more useful in times of heightened uncertainty because people may have very different views about what is likely to happen. So it's all the more important to have the MPC's understanding of what is going on to better understand monetary policy decisions. But of course, if there are large forecast errors, it is vital to update the forecasting model and to improve the quality of monetary policy making. Thank you.
Thank you, Jan. Thank you very much. Thank you for inviting me to this. And before I start, I should say that these are my personal reflections and don't reflect the views of Millennium. So I'm going to talk about three things. I'm going to talk about models, I'm going to talk about communications, and then I'm going to talk about scenarios. The episode of high inflation in 2022 and 2023 and the failure to forecast it was mostly not a model failure. That criticism is based on a misunderstanding of what models can and cannot do. Two things happened that were completely unprecedented in the historical macro data that we have available. A really sharp global supply chain disruption following COVID, following the shutdown and the reopening, and then a historically unprecedented natural gas price shock following the war. Models are not supposed to see these things coming. Models are there to predict the economy conditional on those things having happened. And seen in that light, the models did pretty well. Inflation in the most recent quarter is in fact below where it was predicted to be for the past 6 forecast rounds. And that includes forecasts that were produced when inflation was still 10%. The correct exercise to evaluate the model performance, which I think neither the bank nor the Bernanke report have done, is to run the inflation forecast again, conditional on the energy prices and supply chain disruptions that actually happened. This answers the very precise question: if we had known about these 2 shocks in advance, how much of the inflation spike would have been correctly predicted by the model? And that is the correct measure of what is missing from the model, if anything. The ECB recently performed precisely this exercise and found that, conditional on knowing the path of energy prices, the model would have predicted an inflation spike of 8% rather than 10% that we actually got. So most of the forecast error on inflation was in fact a forecast error on gas prices, which has nothing to do with central bank models. Note that this is a question about forecasting, not about policy. There's a separate question, also the subject of much confusion, which is, if you had known about these shocks and the resulting inflation pressure earlier, how would policy have been set differently? And how different might the outturns for inflation and for the economy have been? This exercise has been done separately by my former colleagues Silvana Tenreiro and Ben Broadbent. And the answer is, you could have started the rate hikes a little earlier, and it would have made very little difference to the inflation spike that we observed. Alternatively, you could have hiked rates much more aggressively, well into double digits, to prevent the inflation spike, but that would have come at the cost of pushing the unemployment rate also into double digits. The idea that there was a pain-free option available, that inflation could have been prevented without crushing the economy, does not stand up to scrutiny. And it creates unreasonable and I think damaging expectations of what central banks can and cannot achieve. So, back to models and forecasting. What we have really learned about models is that we used to think of inflation as being mostly driven by excess demand and some small but transitory supply and cost shocks that policy can ignore. Now we know that those supply and cost shocks can occasionally be very, very large. So large, in fact, that monetary policy cannot ignore them. So quantifying the impact of supply shocks has already been a big part of the agenda and will continue to be a fruitful avenue for making models better. And having a broader framework for thinking about labor market slack is also a useful direction for model improvement. We need to move beyond simply the unemployment rate and incorporate vacancies and survey evidence of labor shortages, etc. Now, this is not new, and a lot of good work has already been done, including at the bank. These features need to be added to the model infrastructure, which needs an urgent upgrade to make it easier, faster, and more reliable to use. Such an upgrade is something that needs to be done periodically anyway, as model technology evolves. And the Bernanke report pointed out that the review is overdue. The Bernanke report was not just about models. It was also about how to communicate about the monetary policy outlook. 2 important points in my view are to build confidence about the central bank bringing inflation back to target and not to make the communications overly complex. Looking back, I think there's room for improvement on both of these fronts. The main message ought to have been simple. Inflation has risen a lot because there has been a large shock, but we, the central bank, will bring it back down to 2% over time without excessive damage to the economy. And actually, the Bank of England remit provides for exactly this scenario, namely that inflation can move away from target due to shocks and disturbances, and that the effects of these shocks can sometimes persist for an extended period. But this message was only to be found in about the 10th paragraph of the monetary policy statement, and not very forcefully. And it was not nearly used often enough in other communication channels. This allowed two very damaging narratives to take hold. First, that the above-target inflation was somehow evidence that the bank had failed. This point was made over and over again at the Treasury Committee and is in fact still being made as recently as last week. I did not hear an aggressive and systematic rebuttal from the bank to this point. The fact that inflation moved away from the target following a large unexpected shock is not a sign of failure. You don't judge the quality of your captain by how much he was thrown off course in an unexpected storm. You judge him by his ability to correct his course and still reach the intended destination. The second damaging narrative that took hold was that inflation was outside the bank's control. The main message should have been that the bank has the necessary tools to bring inflation back to target. Instead, other messages ended up distracting from this main point. We heard, and I quote, that the bank was powerless in the face of energy price shocks, that workers shouldn't ask for pay increases, and that forecast models have let us down. This risks sounding like blame shifting, whereas what's needed is reassurance that no matter how far the inflation gets knocked off course, the bank will steer it back to 2%. So my recommendation, as also echoed in the Bernanke report, is to keep it simple. By all means, share your analytical insights and explain the drivers of the forecast. But put the simple messages up front and never stop reassuring people that inflation can and will be brought back to target. All inflation is transitory. The central bank will make sure of that. Finally, let me turn to scenarios. This is a good idea in principle, but you need three things. You need to choose the right scenarios to be informative. You shouldn't have too many, otherwise it becomes overly complex. And you need the scenarios to have different paths for interest rates than the main forecast. In general, I don't think using the same basic model and saying, what if things were a little stronger and what if things were a little weaker is useful. That's just what the fan chart already does. Rather, consider cases where the mechanism in the main forecast might be wrong. Some key parameter could have a very different value. Some part of the economy might have experienced a structural shift. And crucially, there must be some evidence to justify this worry. At any time, we could be wrong in hundreds of ways, but that's not a constructive way to proceed. It's more constructive to explore the most likely way and that we could be wrong. This is difficult. There should not be an expectation that there will be informative scenarios in every forecast round. Use it when it makes sense. One interesting scenario is way more informative than 5 trivial or eccentric ones. Next, the scenarios need a relevant interest rate path. If the economy is very different from the baseline, the interest rate path will be very different too. We shouldn't just say things could turn out quite differently. We should say things could turn out quite differently and this is how we would react. Of course, once you produce a path for interest rates in the interestingly different scenario, you will face the inevitable question of why you are not producing a path for interest rates in the main forecast. Don't worry, I won't spend any time relitigating this. I've tried for many years, so far without success. I think all the arguments in favor of an interest rate path are strong, and all the arguments against it are weak. I have not seen any evidence over the past 6 years to change my mind on that. One interesting thought experiment is, what would have been a useful scenario in 2022 or 2023? In my view, it would have been to articulate, alongside the central case, the tail risk of unanchoring inflation expectations and how they should be re-anchored. This is clearly what the MPC worried about at the time. And at least in some of 2022,
I agree that worrying about this tail risk was justified, even though I think the risk did not materialize. And as I made clear earlier, I disagree with Ricardo on this. But spelling out this upside risk in more detail would have better explained the tension between policy, which was hiking rapidly, and the central forecast, which often implied pausing or cutting. So to conclude, explain what models can and cannot do. Keep your monetary policy message simple, and use scenarios, but use them sparingly and with appropriate interest rate paths. That's it from me. Thank you very much.
Well, thank you very much to all the panelists for very interesting talks. I have to say that you didn't quite hit your time schedules. So I'm going to be quite short in talking, asking some questions myself. So everyone in the audience, think of questions. Because they ran over, think of challenging questions. I think that would be a more interesting and fruitful way forward. I mean, I think on the panel we saw quite a lot of agreement on certain aspects, on the benefits of the forecast evaluation report, although there's some difference on exactly how it should be framed. We saw some agreement that it is pretty bad, frankly, that the Bank of England's modelling got into the mess that was described in the Bernanke report, and we saw some agreement on scenarios being a good thing, although again some differences of opinion on exactly how to do them. I'm going to cover a little bit of that there. But there was obviously a difference of opinion on the panel about conditioning assumptions, with Petra and Jan being in favour of having the Bank of England's optimal path or the MPC's path as the main conditioning assumption. Frankly, I agree with that as well, so that's three of us against Charlie. And Charlie disagreeing. So Charlie, I wanted to ask you a specific question here about the November 2024 forecasts. Because the bank can't do things very quickly, it closed its conditioning path assumption on the 29th of October, I think, and it's 2 weeks before then. And then we had a interest rate decision and a press conference in which there was lots of talk about this is the forecast on the market path. But it wasn't the market path. It wasn't anything like the market path at the time. In fact, it really was the bank's optimal path of interest rates that would get inflation somewhere close to target. The world continued. It wasn't consequential. Bernanke was dead wrong on that. It wasn't consequential. It was inconsequential. The bank got away with it. It was a perfectly successful inflation report. What's wrong with just doing that every time?
Well, as I say, I mean, I'm not categorical about this. I'm open to having an MPC rate path when it's materially different from the market path. And I agree there's obviously a question because the market path may bounce around. And ideally you want to be in a situation where the committee you can change the conditioning assumption at the last minute appropriately, which the technology doesn't necessarily allow for at the moment, but that's where you want to be. I mean, one thing to bear in mind, though, about having a committee path every time, this is not something you can decide at the beginning of the forecast. You have to go through the forecast round with something as the base point, which would most likely be the market path. People don't know how they're going to vote, exactly what their not only the current vote, but also future path might be, until you've gone through that process. That's the whole point of the process. It's to help committee members form judgments, make a decision, and so forth. So what I would actually have is just right at the end of the process, the committee say, well, you know, are you happy presenting a forecast with this conditioning assumption, or do you want to show it under a different conditioning assumption, either additionally or as a replacement? The important thing to realise, though, is potentially, if you're going to do it in every round, you're adding some extra complexity. And I think it'd be a mistake if the committee ends up spending a significant amount of its time, which would be better spent discussing the outlook, things like that, as opposed to internal negotiations about what rate path they should have. And of course, different members are going to have different rate paths and so forth. In principle, the way you would have to construct it is by backward induction, voting over the terminal date, then back one point, and so forth. So it could be, in principle, quite a complicated process. But as I say, I'm not against doing it when it's a helpful thing to do. But I wouldn't, I just don't think this is the most important thing to be worrying about. I think this is a marginal issue, even though academics get caught up in it.
Talking about scenarios, everyone was in favour of them in a sort of theoretical sense. One element of them that I've often worried about is that when you add in additional scenarios, this is an accountability issue for the Bank of England, particularly public accountability and about making mistakes. Now, if the bank's forecast evaluation report is entirely brutal and really always exposes exactly what the bank got wrong, this isn't an issue. But let's assume that there's an element of covering your back going on in a forecast evaluation report. I don't think that's an entirely inappropriate assumption here. If you have lots of scenarios, you go up in front of the Treasury Select Committee, and isn't just then the answer to every question about your performance, oh, well, we had a scenario about that, and that's what's sort of come out. Petra.
Yeah, I fully agree with your concern, and I think that's why it's a mistake in the Bernanke review to downplay the central forecast. I think in normal times, that is the useful way of kind of like summarizing and motivating why you make the monetary policy decision. Now, there are certain cases where there's heightened uncertainty and the monetary policy makers are making a different decision because of risk management considerations. And then, indeed, you want to use scenarios to illustrate that and to motivate that. But in normal times, I think it's very important to have a central forecast. That's kind of like the best kind of like summary statistic, especially for an inflation targeting central bank, which, as we know, effectively amounts to inflation forecast targeting. And so a central forecast is very important, and that is what you want to use for forecast evaluation, I think. And indeed, if you have multiple scenarios and you try to evaluate those as well, then anything goes. So I think it's important to maintain a central forecast. It is very important. I think it should be de-emphasized in some of the communications. It's like both in the monetary policy summary and in terms of the monetary policy report. I think it's excessively focused on the central forecast, but I think it remains like, one of the best kind of like summary statistics for explaining why the central bank is making its decision.
Yeah, and if I could come to you, again, another sort of practical issue about scenarios. If you've got, and you said you had some particular scenarios that you wanted to test, not just whether inflation was a little bit more or less persistent. Do these differ every forecasting round? How do you decide you are in the world of one of your scenarios? Does this need a process? How do you actually do it in a practical way?
So it is very complicated, which is why I don't think you necessarily want to have scenarios in every forecast, and you certainly don't want different scenarios in every forecast, because that's completely unwieldy and it'll just, I think, confuse people. I think at any point there might be one, maybe two sort of alternative versions of the world that you worry about, and you can carry those through potentially for multiple forecast rounds. And then where you spend your energy is you spend your energy on saying, what data will I be looking at to decide whether I'm still in the world of the central forecast and I'm just, there is some noise around it, or I'm actually in one of these alternative scenarios. And then also, well, I think Claire talked about this and I very much agree, you want to worry about, okay, if I am in one of these other worlds, how different does my policy reaction need to be? Is it just, oh, it's a bit weaker than what I thought, or a bit stronger than what I thought, or is it in fact completely different? And you want to worry about that risk. But I think the accountability comes from,
I'm not so worried about this, going back and then saying, well, we weren't really wrong because it was in line with this scenario. I mean, that's a cheap point. But the more value-added point is to say, these are the numbers we'll be looking at to decide whether it's becoming increasingly likely that the central forecast is not the most appropriate discussion for us to have, and we should put increasing weight on one of these alternative scenarios. And I think that's often missing is, so far we've had this quite complex discussion of, well, the world could be like this, could be like this, could be like this, and there's probabilities, and there's preferences, and there's loss functions, and you layer things on top. But what we really want to know is, okay, so what are you actually looking at? And when will you decide that one of these other cases is becoming material, and what policy implications does it have? And that we get very little of, and I think we can get a lot more of that.
Charlie, you made a face there.
Oh, did I?
I'd also like to follow up on this.
Oh, I hope it was an agreeing face. I mean, I think Jan is absolutely right that you want to be flexible in how you use these. So you don't think we have to have 3 scenarios every time or whatever it might be. There might even be occasions when it's not particularly useful. But there are times, so particularly early on in this inflation episode, when we knew there was a big shock, there were doubts about how the economy was going to operate. Was it going to behave in the way that it did or appeared to behave since the early 90s? Or are we're potentially going to have a replay of the 1970s, where there was much more wage resistance built in? Those sorts of alternative stories, and things like inflation expectations, de-anchoring, stuff like that, you can lay out in a quantitative way. That, as I said in my remarks, I think of scenarios as basically quantitative stories.
Do you think, so I'll come back to you in a second, Petra. Do you think on those quantities that models are actually quite good or bad at giving them? So, I mean, if you think about where you were at the OBR, and the OBR does produce scenarios, most of them, frankly, make no difference. The only one that makes a difference is the productivity improvement or decline. And all the other ones that were essentially published, they all came out pretty much in the wash.
Well, that in itself is a very important insight, actually.
Or the IMF's latest forecast on tariffs, which basically say don't make any difference to the world.
No, I mean, there may well be an issue with something like that, because it may not be the tariffs, but the consequentials that start being important, and they're not fully incorporated, well, not incorporated at all in the most of the IMF simulations, I think. But the value of scenarios is just bringing out these issues in a way that doesn't really happen with the sort of purely literary description of risks that you have at the moment. I mean, the bank could quite legitimately say, well, we talk about lots of risks. And indeed they do, but they don't stick in the way that they might if you have a calibrated scenario that brings it out. And Jan's right that, it may well be that you have pretty much the same scenarios for a sequence of NPRs. And, you can be evaluating, do we look as if we might be in scenario 1 or scenario 2 or whatever. And then as the situation changes, well, you drop them if they're no longer relevant. The key thing is selecting scenarios which are relevant at the point in time, and essentially being flexible and pragmatic.
Petra, you wanted to...
Yeah, so I fully agree with the importance of selecting relevant scenarios. And it also makes sense that, for instance, in the current situation the bank faces, that, yes, there's going to be some persistence in scenarios. But I think it's very important not to kind of get stuck in certain scenarios. So, for instance, one of the scenarios that was missing, is for the current situation, which I think is very relevant for the bank, not just the Bank of England, but also, say, the ECB and other central banks, is the Trump scenario. I mean, seriously, how bad can it get, right? So this is going to be very important for monetary policy making. It's going to could be very disruptive. So I would very much like, the bank not to just get stuck on the 3 scenarios that Claire referred to in her speech, but also start thinking about, okay, what could a Trump scenario look like? And we need to actively, go and think about this.
Do you think it's realistic to ask the bank ahead of Trump's inauguration to actually say more than what Andrew Bailey said a week or so ago, which was basically, we will work, the British government always works with whatever US administration is, and we'll wait to see what they actually do? I can't see how they could really do much else.
So one thing we know for sure, there's likely to be a lot more uncertainty. There's likely to be another trade war. So there are a few things that we can be fairly confident about.
Do you think the central bank could say so publicly?
That's an issue that you can consider, but it is going to be very relevant for monetary policy making.
Can I just inject there? This is one of the virtue of having scenarios. If you have quite a few of them, you can have one that might cover things which are awkward to just have in your central scenario. So if you want to talk about the consequences of trade war or the possibility of fiscal action or something like that, you can put them in a scenario in a way that is less awkward than if you were putting it into your central forecast.
Okay, so we pretty agreed that scenarios can work, although exactly how they are integrated into the process is important. How do you think dissent should be integrated into the process? Because it is a very important feature of the UK system. And you dissented a few times, but how do you think in a new process with a new forecasting model, a new communications environment, we should have dissent? Should we have dot plots? Should we have different forecasts? Everyone, what should it look like?
So maybe an easier place to start is, I don't know if this is on, what it shouldn't look like. So
just speak up.
We have 9 members. We certainly don't want 9 scenarios. So each person says, well, I want it slightly differently. That'll be horrendously confusing. And actually, I think, can people hear me? Should I speak even louder?
Take a mic.
Thank you. So I was saying we certainly don't want 9 scenarios. As to the interest rate paths that you talked about, the one thing I agree with Charlie is this is not the thing that's going to fix everything. It's going to be the thing that exerts more discipline on the committee's deliberations, and whether it's a model-driven path or whether it's a median of a series of dots. I'm open to all these things. I just think that the current state allows you to hide behind this market path and just avoid the discussion altogether. And people keep saying, oh, it's really complicated to think about these things. Yes, but right now we're not thinking about it at all. So that's the thing I'm trying to get over. But just another point I wanted to make on the dissent is that it's perfectly fine for people to have different views on the economy and to be more on the side of wanting to keep rates high and more on the side of wanting to cut rates faster. But I also think one of the things that's been missing is the MPC, even though they're individually accountable for their votes, they still play for the team. And the team is the Bank of England. And the Bank of England has a broad message to the broad public. And everybody should be held responsible first for communicating that message. And then secondly for saying, and relative to that central message, by the way, my individual view is I'm a little bit to this side or I'm a little bit to that side. And I think sometimes that central message gets lost, and then it just creates confusion, because then you hear somebody who says, oh, inflation's fine, or oh, actually I'm worried about it undershooting, that's the main risk. And somebody else says, no, it's not fine at all, I think it's going to be high for a very long time. And then people say, well, what is the message from the Bank of England? And I would like to see that brought back, and that has nothing to do with scenarios, but that has everything to do with how you communicate the message, how you build the central scenario, and how much you kind of discipline the committee to say, look, you can do 2 things, not just one thing. You can speak for yourself, but you can also speak for the committee.
I think you made the point about exactly on those core communications, issues. I think you made it very well, and perhaps it is time to, I don't know, maybe you can give us a bit of a flavor of what you think the central bank should be doing. What should it look like? So
it is time to
put to bed the typical MPC member speech, which is on something completely nothing to do with monetary policy, and then the last two paragraphs saying, this is what I think about the current conjuncture, and by the way, we are still going to get inflation back to 2% as the afterthought. Before I open it up, I just had one final question for everyone on the panel. At the moment, the Bank of England is incredibly reluctant to talk about things we know exist in the model, R star, what the word gradually actually means, loss functions, all of these things. Should the bank just generally, is one of the things that it should be doing is just generally being a little bit more open and transparent? Petra, I'll go to you first.
Yes, so I think definitely with respect to things like R star and the gradual kind of like fuzzy forward guidance, it's important that there's sufficient clarity about what is meant by that. And sometimes with respect to fuzzy forward guidance, like in the case of the Federal Reserve, who already used it even before the great financial crisis, then they said that it would go and remove policy accommodation at a measured pace. And this quickly became to be understood as kind of like regular 25 basis points increments. But there can be also other cases where it's not clear what is really meant. So for instance, when they're referring to like we're going to keep rates low for an extended period in the aftermath of the great financial crisis, and then when they changed that into a quantitative forward guidance, and actually calendar-based forward guidance, where it was made clear that that extended period was lasting nearly 2 years, we actually saw a very pronounced market reaction. So there is a great merit of having quantitative forward guidance because it creates clarity. Now, with respect to R star, so there was some discussion about that in Claire's session. So conceptually, it's a very important concept. And I think it's important for monetary policymakers to make clear what is a neutral interest rate. And so now, while Claire said, well, I'm pretty confident that currently we have still restrictive policy, it's still clear now, but as the bank starts reducing rates, it becomes less and less clear. And I think it's important for monetary policymakers to say, like, we think it's more likely than not that we still have restrictive monetary policy. And then there comes like a zone of ambiguity where they're not quite sure. And so they have to kind of like figure out whether it's still restrictive or not. And then you have another on the other side where you're pretty sure that it is expansionary. And yes, there's great uncertainty about it, but I think it is important to know what monetary policymakers think, whether they think they are clearly above R star, the neutral level, or whether they're somewhere in the zone of ambiguity where you cannot really tell.
Charlie.
Yeah, first of all, as regards R star, we should recognise it's not a number, it's a function. It's a general equilibrium concept. And if you change variables, potentially you change what that equilibrium is. And I think we should avoid some misplaced concreteness that we know it's 4 or 3.5 or whatever. It's also worth saying that we don't have good empirical models that explain the evolution of R star over long periods of time. You can explain them over subsets and so forth. And generally speaking, I think we know a lot less about it than we think we do. So I'm very wary of anything which gives the impression that the bank have a good fix on it. Now, that doesn't mean to say they can't say, well, our central estimate is 3.5, but it could be anywhere between 2 and 5 or whatever. But I think it's important to, if you go down the direction of more transparency, that you don't end up giving the impression of more certainty than you really have about the world.
Yeah.
Just a few things about R star. So I can't remember who said it. I think several central bankers have said, it reveals itself by its works or something like that, which is true. And you can really only infer in a backward-looking sense, where R star was in some recent history. And if you want to say something about where it is now or where it's going to be in the next few years, you need a model, and by definition, you will not have full confidence that that model incorporates everything you want it to incorporate. But
You will have a view.
If you're setting policy, you still need to take a view. If you want to make a statement about, I think policy is definitely still restrictive, or is possibly still restrictive, or is possibly not restrictive anymore, you need to take a view. And I just want to push back against this idea that just because something is uncertain, you should leave it unsaid. I think that is not helpful at all. You know, inflation over the next 2 years is very uncertain too, yet we put a number on it. So our star over the next 2 years is very uncertain. Why do we not put a number on it? That I don't understand. And when you put a number on it, again, that'll exert a great discipline on the committee to say, okay, if we're going to put a number on it, let's talk about it. You know, does it move quickly? Does it move slowly? What are the arguments for thinking it's now higher than it was a few years ago? By how much can it plausibly have moved and why? And these are really productive debates to have. And by saying, no, we mustn't talk about our star, we must be quiet, we're suppressing that whole debate, and we're allowing people to get away with potentially one committee member thinking it's 0 and another committee member thinking it's 4, and not having a discussion between the two. And that's just a huge missed opportunity.
Thank you. Right, open to questions from the floor. Can I see your hands? I'll take 2 at the front here. Tony, and Richard.
Tony Yates. What do panel members think the bank needs to do with regards to managing and organising itself differently so that it doesn't get into the situation it did get into regarding the infrastructure, the models, data handling, all of that kind of boring stuff that pose an existential threat to the forecast process?
Thank you.
Couple of questions. The way that Claire discussed scenario analysis this morning, it sounded like there were structural issues that might be involved in some of the scenario differences. How do you incorporate those into a model without taking account of those structural differences? Second, if you're doing scenario analysis, would you be interested in using some of these scenarios to guide stress tests, macroprudential stress tests? A little bit the way that the ESRB and ECB do it, but would those be useful in terms of thinking about a more holistic approach to thinking about the intersection of monetary policy and macroprudential policy?
Charlie, do you want to take the first question?
What should the bank do to avoid getting in the same mess in the future? Firstly, in terms of management, it has to make clear that it puts a priority, as far as personnel are concerned, in staffing up those areas. So that includes both the quantum and the quality of the people there. There is a problem in the bank which Ben refers to, and I always agonized when I was about there, and which is not unique to the bank, it's a problem with the Treasury as well, which is too much churn, which is people don't stay long enough in jobs. They get on top of the job and straight away they're moving on somewhere else. So you always have people who just don't quite have enough knowledge. I think also, and this connects with what I was saying a moment ago, that perhaps the jobs servicing the forecast have not been seen as sufficiently attractive enough compared to some other more exciting bits that people can work in. So the key is for the relevant bits of the bank management to redress that, whether that's through salary or through promising a future career path or whatever. But ultimately that's where the responsibility lies, I think.
Petra, do you want to take the second?
Take the scenarios. So with respect to scenario analysis, like, yes, stress testing could be interpreted as a form of scenario analysis. So, but I think there is an important difference between the way like the stress testing is used for financial stability purposes and the way you want to use scenario analysis for monetary policy purposes. Because for financial stability purposes, it's essential that the scenario is sufficiently extreme and demanding to be a proper stress test. And if it's kind of like, a plausible thing that is likely to happen, then it's probably not sufficiently challenging to be a proper stress test. Whereas for the selection of scenarios for monetary policy purposes, it's very important that it's relevant. This is something that very plausibly could happen, and so you don't want them to make them too extreme, because then they kind of like become irrelevant. So yes, conceptually there are similarities, but in terms of the selection of the appropriate scenario that's used for stress testing compared to for monetary policy purposes, I think it's important that they are different.
Do you want to take it?
Just maybe quickly on the question about structural shifts. Conceptually, I don't think it's that much of a challenge. Obviously, detecting a structural shift is difficult, but how do you then put it into your model infrastructure? Is either you decide that it's well described by your existing model, but with a key parameter that's different, and so you change it and then see what difference that makes, or it's a change that actually doesn't fit into that infrastructure, and so then you have a separate model, maybe something much simpler, but which has a lot of detail on that particular mechanism that you're interested in. And I think both of these things are exercises that the bank has done in the past, so we're just talking about making it more systematic, but I don't think conceptually it's that complicated.
Okay, I forgot to insist that people could, if you could introduce yourselves when you ask the next question. I'm looking actually for some women to ask questions. The two in the second row over there. And can you make sure it's a question? So that's a short sentence which ends in a question mark, please.
Sonali Panhani, Bank of America. So when you look at scenarios, if the bank, for example, does not publish their path of interest rates, how do you think they will communicate the reaction function? I mean, it does seem like the bank isn't very keen on doing that. So what are the alternative ways in which we can understand what the reaction function of the bank is going to be under these different scenarios? And secondly, on the mean inflation forecast, right now we kind of interpret that as a probability-weighted distribution of different scenarios. Do you think once we start doing scenario analysis, we won't have mean forecasts, or they won't mean anything because it'll probably be a probability to different scenarios? How do we interpret the mean inflation in that scenario?
Hetal Mehta from St James's Place. First question more for Petra. You highlighted the difference between, or the inconsistency between the conditioning assumptions for monetary policy versus fiscal policy. But how do you propose the central bankers take into account the speculation around unannounced fiscal policy? There's not a single fiscal policy index for people to trade or for you to interpret. So any thoughts on that? And then secondly, just for the panel, do you feel that attaching probabilities to different scenarios would end up being a big waste of kind of thought and energy amongst policymakers?
Thank you very much. Charlie, can you take the first question? So how do you communicate a reaction function if you don't condition on your forecast? And does this mean the death of the mean, median and mode, three things that exists but not many people look at?
Can I just clarify with the question? When you talk about getting the reaction function, are you thinking about the scenarios or the central forecast? No. This is one of the values of scenarios, that enables you to talk about how policy would respond in response to the crystallization of shocks and uncertainties. So if you don't do that, you're throwing away half the value of the scenarios, in my view. I mean, what you want as a central bank is you want the private sector to have an understanding of your reaction function. One of the reasons I don't like dot plots and things like that is they conflate two things: the outlook of the economy and the reaction function. And you really want to unpack those two things. It's perfectly reasonable for the private sector to have a different view of the outlook, but you don't want them having a different view of the reaction function. You want them to understand your reaction function. And I think the problem with most central bank communication at the moment is it actually doesn't really talk very much about reaction function. Not just the Bank of England, it's true of lots of central banks. I mean, it's true, I guess you do implicitly, because the reaction function is to get inflation back to target within a reasonable period, as Jan was suggesting. It was the message that should have been being reiterated over and over again. But you may want to say more about what's a reasonable period and what are the factors that would determine how much you would alter rates in response to a certain shock. So I see that as one of the key values of having scenarios. It's called a monetary policy report at the moment. It doesn't really talk much about monetary policy. It's still really the inflation report. But actually, if you start talking about the policy response to the crystallization of certain sorts of events, you are getting into the space of talking about policy.
Yeah, do you want to take the question about whether you should attach probabilities to different scenarios?
Yes. That's the answer to your question, not the answer to that
Yes.
question. So I'm going to just remind everyone of a high-level point I made a minute ago, which is don't make it too complicated. So technically, what you can do is you can assign probabilities to all the scenarios, and then you can make choices. Then you can do one exercise, which is I'm going to set optimal policy for the baseline, and I'm going to see what the outturns would be in case the baseline doesn't prevail. Or you could even, because once the machine does it, the machine does it, you could even say I'm going to have a probability-weighted scenarios. I'm going to set optimal policy across this probability-weighted space. I mean, you can see this is a complete nightmare for anyone to understand. So I suggest not going there, but instead focusing on simpler things like, so even conceptually the idea of, what if I set policy for the central forecast and it turns out that scenario 1 is the actual state of the world. If you do that in a machine, it'll produce this complete garbage, which is that you never learn. You just keep making a horrendous policy mistake because you never update. Instead, a much more interesting question is, what data is going to tell me that I am in scenario 1 and therefore is going to allow me to switch, to stop making a systematic mistake that the machine is assuming I would make? And that's something that you can explain, saying, this bit of the economy is giving us some concerns because it suggests maybe something has changed, maybe not. These are the things we'll be looking at, and we'll be updating you regularly on whether you think it's becoming more likely or less likely that it has changed.
Okay, so the message is absolutely don't average over scenarios.
No.
Yeah, Charlie.
Yeah, just to reinforce that point, these scenarios are only a tiny subset of the range of possibilities. And it only makes sense to be assigning probabilities if actually you've described a universe of possible outcomes.
Petra, there's a question.
Yes, just to quickly follow up on the other two questions. I fully agree. There's no way in which you could possibly identify all the possible scenarios to actually attach probabilities to them. And even if you could enumerate them all, how are you going to attach probabilities to that? This cannot be done. So these scenarios are really for illustrative purposes, like plausible ways in which the world may evolve that are relevant for monetary policy making. Briefly, following up on what Charlie said, doing scenario analysis without publishing the path basically means that you're missing out on most of the benefits from the point of view of external communications. So that is a bad idea. Now, with respect to the question that was asked specifically to me, with the inconsistency of conditioning assumptions, then how would you come up with a forecast that incorporates fiscal policy expectations? Now, in principle, that is, we have ways of figuring out what people's expectations are using surveys. Bloomberg has a survey, for instance, with respect to macro releases. The bank has its own survey of external forecasters. So you can have a survey where you ask the question, what are your expectations with respect to fiscal policy? And you could use those market expectations as part of your conditioning in the forecast. So yes, it can be done. Conceptually, it's not difficult.
Yeah, so I mean, it was sort of madness in the November monetary policy report that the inflation forecast was conditioned on fuel duty rising by 5p and RPI come April 2026, which we all know is not going to happen. Gentleman there, and then one behind the back there. Yeah.
So Jakob Lavred for Handelsbanken. So there's been a lot of talk about sort of scenario analysis, and there are sort of there are many ways to do scenarios, of course, but if you say broadly, like one way is that you condition on different inputs. So you say, okay, energy prices are going to be something different. Another way to look at it is that you say that the mechanism internally is differently strong. So for example, the impact of energy is weaker or stronger. And I would be interested to hear the panel's view on these two ways of doing scenarios, and which one do you think is which of these, what role they should play?
And there's a, yeah.
Hi, Siddharth Desad from Citadel. How do your points relate to non-NPR meetings where currently the communication is a set of minutes and a TikTok video?
TikTok
video? Oh, I haven't seen that. Right, on the difference, if it's the input, if it's the price of energy that's changing versus the effect of energy. Jan, do you want to have a go at that?
Sure. I mean, depending on the circumstances, both of these could be interesting. The first one is much easier to do than the second one, and in fact, the bank has frequently in the past already done that and said, I'm going to show you something if these prices are 20% higher or 20% lower, and it's useful to periodically remind people of that. You don't even need a fully worked out scenario. You can just bump that one conditioning assumption, which will remain a useful thing to do. And my point earlier was that scenarios really come into their own if you have this idea of the mechanism through which the economy works is actually different from the main one. Then it becomes interestingly different. But just in case it wasn't completely clear, I'm going to say it a little bit more explicitly now. I would rather see fewer rather than more scenarios, and I think this quickly is going to lead to risking becoming incredibly complex and taking up way too much of the committee's time away from the just bread and butter, what's happened in recent months, what have we learned from that, how do we need to change our reaction function as a result of that.
Petra, do you want to take the question of non-monetary policy report meetings? What would you expect to see in them in the perfect new world that we're moving into?
Yes, so obviously there's a lot less information because there's no fresh round of forecasts. So at the least you want to have a clear idea of what the committee thinks, whether there has been a significant change compared to the previous round. Some central banks actually took that further and decided, including the Swedish Riksbank, to then produce a forecast for every meeting. Now that may be a bit too much, especially considering the current problems that the bank faces. If there is a significant difference compared to what you were anticipating, then you have to make that clear and also talk about the implications of that. Whereas if the economy is developing exactly as anticipated in the projections, then you can basically say yes, everything is fine, and the demands on having additional explanations are a lot less. So it really depends on the situation.
I think we've got time for one more round of questions, so I will try and take some people. So gentleman right at the back there, and another one there, and I'll take one more. Person with his hand very high up, he's very, very keen, just there. Yeah.
Hi there, Michael Hume from MKP Capital. Is there a case for having a different number of scenarios within the bank to the one that's actually published? Because there's obviously two objectives. There's one to understand the world and the probability distribution, and another to communicate. So is there a case for a difference in number?
Yeah, and we had, where was the second person?
Martin Wheel from King's College.
Just shout it, Martin, just shout into the mic.
Martin Wheel from King's College.
We can hear you.
Good. Isn't there a risk that the most relevant scenarios or the most important scenarios will be about the things that occur only very infrequently? For example, a 5-fold rise in gas prices or something like that. And so the committee risks being stuck without a relevant scenario when something really big happens and subject to the same sort of criticism that it's had to face recently.
And gentleman back there.
David Vines from Oxford. I want to ask a question about policy coordination. Nearly 20 years ago, Charlie taught us that the Bank of England is a Stackelberg follower and the Treasury is a Stackelberg leader. We know that the energy price cap caused inflation to be 5% lower than it would have otherwise been. Some of us argued that given the correct assumption that supply chain difficulties and energy price rises would be temporary, that the energy price cap should have been twice as tough as it was, and roughly speaking, inflation should have not been 10 instead of 15, but 5 instead of 10. Now, I exaggerate, but the question is, should one think of taking present disturbances of a temporary kind onto public debt in the future and making the job easier for the Bank of England?
Well, that would be a good question for the last question. So internal versus external scenarios. Is there a case, I mean, presumably this is all under the scenario that you can actually do these scenarios quite quickly and that they've sorted out the models. But Charlie, is there a case for just doing lots of experimentation in the bank and then picking a few for external consumption?
Absolutely. I mean, the bank should be selective in what it publishes in order to align with whatever it's trying to communicate. And that doesn't rule out it doing all sorts of other things internally. So I don't see any reason why there need be any alignment. And something Jan said earlier on about, you know, a small number of well-chosen scenarios, I wholeheartedly agree with. You know, the key is to have scenarios which make the point you want to make.
Yeah. So I think the answer on the panel to that is yes. Petra, do you want to take the second Martin Wheel's question, which is that scenarios are most useful only when they're really extreme and you probably would never ever publish them?
So I think scenarios can be very useful even if they're not very extreme. Just look at the scenarios that a bank has sketched. I think they are very relevant about, like, you know, no significant or very strong persistence in inflation. Yes, there can be certain scenarios that could be very material, but are unlikely to be realized. So if there's a case where there's kind of like no other scenario that you can think of, then you could make clear, okay, this is kind of like, you know, long-term thinking about something that could have a very profound effect, but it's very unlikely to happen. But some of these things are best done for internal purposes rather than for external purposes, unless it's really affecting your policy making. So also going back to Charlie, yes, those extreme scenarios could be useful for internal purposes, but you probably don't want to communicate them unless they are affecting your thinking about monetary policy right now.
Right, and the final question, which really has nothing to do with the Bernanke report whatsoever, but it's a good question, so I'm going to force the panel to answer it in any case, which is that should we, when we're thinking about inflation control and doing what Jan asked us to do to make sure we get back to the 2% target, should the government be putting some more, I suppose it's cost when there are big terms of trade shock, should we be putting more onto the public balance sheet? Jan, do you want to go first?
Sure. So I think somebody earlier made I think it was Ben from Citibank, made the very valid point that you need to be very careful in, you know, we now know ex post that this was a temporary shock. We didn't know that at the time. It could have become very expensive very quickly. I'm glad we did it. Given that it was a temporary shock, we probably could have afforded, you know, to have an even more generous scheme. But again, we didn't know that at the time. So I think, you know, conceptually, I think this idea has proven its merit. And, you know, in very exceptional circumstances, we can consider it again. I'm also just going to bring it back to the Bank of England for a second and to say that the MPC or, you know, any individual person in the bank should definitely never be seen publicly to be making a comment on whether this is a good idea or a bad idea. But the Bank of England can, if asked, you know, provide very helpful, quiet advice to the government, say, well, if we did this, what would the consequence be in your view? And if we did that, what would the consequence be in your view? And, you know, that already happens to some extent, and I would be very supportive of that happening at even greater depth. But that's very different from, you know, putting out a scenario which smells like, you know, I think this would be a good suggestion for the government, because that would be a really bad idea for central bank independence.
Petra.
Yeah, so I agree with that. So the bank definitely should not be suggesting that inflation control measures be implemented. I'd like to add to that it was not just very convenient for the bank that there was the issue with the energy price cap basically reducing inflation significantly. It was also actually very useful for the government itself because it has a large amount of index-linked gilts. So bringing these inflation numbers down actually reduced the bill that they had to pay on these index-linked gilts. Yeah.
And Charlie, with your your public finances hat on, I presume you felt a bit of a shudder at the idea of the public balance sheet taking a lot of inflation risks in times of a terms of trade shock.
There is a very solid argument that the public sector balance sheet should take the strain when there are bad events, wars, financial crises, pandemics, and arguably really bad energy price shocks. But that's up to the government to decide what it wants to do, bearing in mind intergenerational fairness and all those sorts of things. It certainly shouldn't do it to make life easier for the Monetary Policy Committee. It may have the side effect of making it easier for the Monetary Policy Committee, but I don't think that should be at its forefront of its thinking. The bank certainly shouldn't be advocating one thing or another openly. I have no objection to private discussions about the consequences taking place between the bank and the Treasury. But this is a case where this is a decision for the elected representatives of the people.
Good, that's something for Her Majesty's Government to, or His Majesty's Government, I'm so out of date, to do. I'd like to thank the panel for a very, very stimulating hour. I think this has obviously helped, in some ways, the Bank of England, the discussion in the room, think harder about exactly how it's going to respond to the Bank of England, to the Bernanke review. So thank you very much, Charlie, Petra, and Jan.
So let me start by complimenting David and Richard. Where's Richard? There, on the organization of this. For those of you that have been coming, this is the third time, and to be this successful, I think on your third time is really quite something. There are nearly 400 people here, so that's, I think, really a wonderful sign of success, and I think that we owe you a tremendous thanks for organizing this. The ability to, I also want to compliment the Bank of England, if there's some people remaining, on participating in this. It's important, I think, for accountability and transparency that the central banks participate in this. This is modeled after the ECB and its watchers, which some of us have participated in the U.S. Monetary Policy Forum in the U.S., where we get lots of people from the bank, from the central banks as well. So congratulations to both the organizers and to the Bank of England. It's my privilege today to introduce Philip Lane. I've known Philip for probably longer than either one of us wants to admit at this point. Philip is, I think of Philip as a distinguished academic who's been on an extended field trip. He graduated from Trinity College Dublin and then from Harvard. And I think we met probably not long after that. He was on the faculties at Columbia University and at Trinity College. And at some point, he served as head of the economics department there, so you have my condolences. Also president of the Irish Economic Association, a fellow of the Irish Economic Association, a research fellow at the CEPR, and he was managing editor of economic policy for those of you who are interested in economists and academics who are trying to contribute to economic policy in Europe. I think that's the premier publication. I know of Philip from his extensive and incredibly influential work on foreign assets and foreign liability flows across borders. I remember once, Philip, that you said that we have to stop thinking about small open economies as small versions of big economies, and I think that your work and has helped us to do that. So if you look at Philip's biography, what you're going to see is that it looks more like somebody that hangs around central bankers than someone who is a central banker. But in 2015, that changed. He became the governor of the Central Bank of Ireland, and then in 2019 joined the executive board of the ECB, and is responsible for economics and monetary policy at the ECB. And I think as the person with, in my view, on the governing council with the best grounding in macroeconomic theory and practice, I think we're very, very privileged to have him here. So with that brief introduction, okay. Philip, we look forward to your remarks.
So thank you, Steve, and let me thank the organisers for inviting me. And I think actually it's fairly organic to have someone from another central bank, because central banks, we do watch each other. I think Claire had the same comment this morning in her speech. We do watch each other. I personally pay great attention to everything that comes out of the Bank of England. And I guessed that today a lot of discussions would be indeed about how to handle uncertainty. So what I want to do is really report on how uncertainty and risk is incorporated in the monetary policy process at the ECB. Now, it's of course important to remember how we are set up is different to the Bank of England and the MPC. And in particular, as we go along, when I say the ECB in this speech, a lot of the time I'm going to mean the staff of the ECB. Sometimes I'm going to mean the Governing Council. But it's very important to recognise that there's a sharp distinction between the work of the staff and the work of the Governing Council. And of course, every institution makes different decisions there. So with that, I think it's not going to be hard to disagree that even though uncertainty, of course, has always been with us, that essentially, if you think about the recent years and on an ongoing basis, the quantum of uncertainty has gone up. So in this first chart, I just report different external measures of uncertainty coming from various ways to think about it. And of course, there's a very big academic literature in terms of measuring uncertainty in different ways, including macroeconomic uncertainty and economic policy uncertainty coming from academic contributions here. But let me also mention work at the ECB. So this is basically coming, which again, I suppose maybe also originate from academia. There's a lot of interest now in using the earnings calls of publicly listed firms to listen to what corporates are saying. And this is basically text-based analysis, identifying how frequently various types of risks are mentioned. So you can look at this in terms of the overall amount of risk kind of mentions in earnings calls. We can also look about where the risks are coming from. And maybe I'll highlight the fact that inflation as a source of uncertainty, that kind of pale yellow contribution was definitely high. It's still a lot higher because it used to be totally not talked about. So before the pandemic, it was never talked about in these calls, and it's still a topic of conversation. Now, I think, as Jan mentioned, really, we shouldn't pretend that the world is all that predictable. There is such a thing as an unpredictable event. So whether that's, say, Russia's invasion of Ukraine, which triggered extraordinary jumps in gas and oil prices, and which also operates through, I think, a generalized sense of insecurity in Europe. This has brought both inflation shocks and geopolitical risks to the fore. And this has an ongoing ramifications for the euro area economy. And it's not just simply looking at the impact on commodity prices. You have to think, for example, now about the appropriate scale of defence spending and also the refugee flows. So, it really cuts across so many different elements of policy that we really, should be reminded of that. I've skipped over the pandemic, but of course the pandemic was also, of course, although you could say, okay, it's conceivable that we have a pandemic, and you might say, okay, what should happen when we have a pandemic? You can go through that, but in terms of the risk for the next meeting of the ECB or the Monetary Policy Committee, it was not going to be to the forefront until it actually happened. Now you might say, well, given that level of uncertainty, it must be the case, and we spent today talking about it, it must be the case that policy making doesn't only depend on the baseline, the most likely path, it also depends on the risks around that path. And so this, of course, has been a very long-running issue, a long-running debate. This is not invented now in recent years. And of course, we can think about the use of probability distributions around different outcomes or scenarios. And I will come back to probability distributions later on, including those embedded in financial options markets. But I would also say, and again, it's been a theme today, if a risk is crystallized or realized, how the economy reacts to that risk and whether it reacts in a way in line with pre-shock kind of historical estimates, or whether the risk itself triggers changes in behavior, that has to be part of how we think about risk. And of course, there's a whole world out there of people who look at complexity theory and look at it in a very kind of deep way about the interactions between the risk and the response to risk and so on. And of course, this is very closely connected to the long-running debate about, how we think about risk in terms of, what we can try and calculate in terms of probability versus novelty and uncertainty. And of course, again, there's nothing new about that. But let me say also, is in terms of how we make decisions under those environments, there has been a lot of progress in recent years about decision making under uncertainty. So a lot of the work from behavioral economics, which has been there at a micro level, is more and more being embedded in macroeconomic models. And that's really, I think, consequential in terms of our understanding of how people, not just policymakers, but how firms and households react to risky situations. As it was also, I think, mentioned throughout today, I mean, it's fairly straightforward, or it doesn't take that long to conclude. If you have a wide range of risk scenarios, you really want a robust policy that does okay across all scenarios, that is not fragile to essentially the world turning out differently to your base case. And I will come back to that in a while. Okay, so in terms of the recent history, the surges of inflation in 21 and 22 did originate in these shocks, whether the pandemic and in the war. But it also, the whole impulse responses that we saw also were driven by the changes in behavior in the context of those risks being realized. And Ricardo, again, this morning went through some of that. So what we had was a period where essentially, indeed, the forecast errors were pretty big. So whether for headline, less so for core, and in a different way for GDP. So in this situation, of course, there were many questions were being asked about what exactly is the role of macroeconomic models, what exactly is the role of forecasting, and what do you make of these errors? And I gave a speech a week ago, and you can find it on the ECB website, which goes into the role of macroeconomic models, and in fact, basically, agreeing with a lot of what Jan said today. So how did we, in that context, if you go back to late 22, when we had these, or mid-late 22, when we had these really big errors, how did we adjust to that situation? And so what we did at the ECB was essentially say, well, okay, it's always true monetary policy responds not just to the baseline but also to risk. What are the risks we need to focus on in this situation? The first risk was, given this sequence of shocks, given the very high inflation, essentially at that point in time, if you go back to late 22, there's quite a wide distribution of possible future inflation paths. So in that situation, the weight on the baseline we felt should be lower than normal. And also the weight on underlying inflation should be higher than normal. So in other words, it would be important in a nuanced way to update beliefs about the probability of different inflation paths depending on the incoming data. So we said our reaction function is number one on the inflation outlook, so the most likely path. Number two on underlying inflation, to learn from the realizations of inflation, and again, in an adjusted way, because every month looks a bit different. But then the other thing that was going on was a really big monetary policy tightening cycle. So there's another source of uncertainty, which is, what is this going to do? We had not done a really big tightening cycle before. And of course, with structural change in the financial system, exactly how monetary policy works, the transmission, and in our context, the transmission in a bank-based financial system was also uncertain. So we said in calibrating policy, the third leg of our reaction function is essentially looking at the strength of monetary policy transmission. And again, that's across many factors. So essentially from late 22 onwards, for those of you who pay any attention to my speeches, I've essentially had two speeches. One is, where are we on underlying inflation? And the second is, where are we on monetary transmission? And that's essentially what we've been doing throughout this period. So it's a reaction function, a specified reaction function in the sense of telling you or the ECB watchers, these are the things we're focusing on. We're not going to tell you, because it's not a case of saying there's a single equation for the interest rate, which kind of has a coefficient on underlying inflation and a coefficient on the strength of transmission. But in terms of shaping how we're going to respond, these are going to be the issues. And again, this is essentially reflecting when you're far from target with inflation, and simultaneously, and in response to that, you're doing a big hiking cycle, there's two pretty big sources of uncertainty at the same time. So how do we build the inflation outlook? And I'll focus on the most likely path. But the outlook also includes a very wide-ranging risk assessment, which I'll come to later on. And we do, and unlike maybe the kind of ownership of the MPC, what we do is we ask the staff of the year system, please give us your projections. So there's total clarity that this is the staff doing it, not the governing council. And again, we don't have the time or the professional qualifications to do macroeconomic forecasting. Someone asked in a recent round, well, what happens at the non-projection meetings? Well, the non-projection meetings, the incoming information is best interpreted basically as an opportunity to test the most recent projection. Either the data is more or less validating the projection, or it's casting doubt on those projections in either direction. And in our communication, in those non-projection meetings, essentially that's what people are interested in. Is the projection still your base case, or are you tweaking your views compared to that projection? And so I think that's a reasonable way to think about it. And just to remind you of where we are, this is the history of inflation, and then in September, what we had coming up is essentially a return to 2%, not immediately. We're not that far from 2. There's going to be some wiggles in the process. But what I would say is the inflation outlook at least in terms of the base case, it doesn't tell you a lot. You know, it doesn't, because I think as Jan said, it's pretty much going to be pretty uniform. Central banks will always get back to 2%. That's our job. So the fact that we have a projection of getting back to 2% is a feature of projections, because behind this forecast is an interest rate path. And the interest rate path is designed to deliver that projection. And again, I agree with Charlie, we use the market path, but the market path believes that we're going to do that. So it's not a terrible way to go. Okay, so then the second element of the reaction function was trying to look at underlying inflation. So again, let me say here, and again it goes back to, it's not a good idea to kind of use a shorthand for this. And also, as I think Ricardo said this morning, there's no particular reason to look at one measure. We have many measures of underlying inflation. And again, what is underlying inflation? It's where inflation is expected to be a year from now or 2 years from now, you know, once the kind of transitory factors have dissipated. That is not so easy to calculate. You can do, as I say, some proxies like exclusion-based measures such as core, but it's also important, I think, to use models where you do extract the persistent component of inflation using the history of data. And so what we try and do, and again, there's no particular reason to ask the Governing Council to zero in on one measure or some average measure. So we use the whole range. But let me say is that in the context of a big energy shock and also pandemic bottlenecks, essentially these are neither noise, they don't disappear within a month or two, but neither are they permanent in nature. So looking for adjusted measures of underlying inflation was important. So essentially the staff you know, ran a VAR type system and dummied out the impact of energy prices and bottlenecks. And that gave you the dark purple. And that's really what I think I focused on. Because if you go back to late 22, headline was at 10 point something. The top of these unadjusted measures was around 8. But once you say, well, actually, that's just because when you have a really big energy shock and bottlenecks, that's not going to remain in the system. So the adjusted measures were around 5% at the peak. And so if you're trying to think about why ECB bringing the interest rate deposit rate to 4 was an appropriate response to an inflation rate that peaked at 10, you have to think about what is the element of inflation that is projected to be in the system a year from now, and therefore is sensitive to monetary policy. So again, using Taylor rules based on the current values of inflation and so on was just going to be totally misleading. So I would say that this second approach of underlying inflation is now an industry trying to think about it. And then maybe there's much to be said about the uncertainty about monetary policy transmission. And we did, and you know, in my various speeches, I've tried to explain all the different dimensions of it. So again, in that situation, what were we looking at? Because a lot of data come with a big lag, and this is where surveys are so important. So for us, the bank lending survey, the SAFE, the survey on access to finance of enterprises, also what we learned from the consumer expectations survey is very important. But let me emphasize, it's not just about how credit responds to monetary policy, it's also how expectations respond. But by the way, it's also how firms respond to that. And maybe what's interesting is when we say, okay, how sensitive are pricing decisions to monetary policy? This is essentially, again, rolling regressions here, where the blue box, or the blue line is what we thought before the pandemic. So if you ask, well, if we tighten monetary policy, what happens to the kind of monetary policy sensitive elements of core? It's quite low elasticity. Whereas if you included these years, it turned out inflation was a lot more sensitive. Another way of saying this is if we kind of convinced people that inflation would come down in a timely manner, so it was not going to remain in the system very long, then it was wiser not to kind of try and maintain high profit margins as we implemented the monetary policy. Okay, so let me move beyond that reaction function, and let me move beyond the baseline forecast, and let me explain how the staff primarily try to report to the Governing Council about risk and uncertainty. Let me start with basically our version of fan charts. So our version of fan charts is basically using past forecast errors to calibrate uncertainty. Let me emphasize, because again, the staff do not want to step in the shoes of the Governing Council, that these are used to create symmetric error bands based on the mean absolute value of past errors. So the Governing Council might choose in its communication to say this upside or downside risk, but that is for the Governing Council's own risk assessment. The staff, in terms of making calculations, does not try to do that. And so what you see here is in our most recent projection, and these are for different sizes, whether it's 30%, 60%, or 90%. And the question is, how useful is this? Because I think you need to take a view about what are the errors you're worried about. What is the origin of the shocks you're worried about? Because you just take, well, say, like historically, you're going to be wrong. And historically, here's the different ways you can be wrong. Maybe it doesn't hurt in terms of not misleading the public about the kind of certainty we have about our projections. And that's probably a fair issue. Publishing these type of fan charts is a reminder that even though we report a baseline, there's a lot of variation around that baseline. But of course, if any of these paths were followed, we would be responding. So, at the next meeting, if the downside or upside risk were materializing, we would be responding. So in the sense of saying, is this the kind of what's actually going to happen? No, it's not, because next meeting we would respond to any of these forecast errors being realized. So let me come to some other ways we do it. So before I come to that chart, which I'll leave there, what's important at the ECB, which we do not publish, is the subjective probability distributions of the staff. So we do have a survey. So it alternates between the ECB staff, senior staff, and then the Monetary Policy Committee of the Eurosystem, where they basically list out the risks they're worried about, and they give basically a likelihood assessment. That is important to us, but we don't want the staff worrying about publication issues. It needs to be a private survey for them to speak in an unvarnished way. So that is helpful, because all of these are experts, and to have a range of experts filling in at this survey, we do think is helpful. But for communication, of course, it doesn't help you when we don't publish it. But let me turn to model-based risk analysis. And so I'm going to go through different levels of this. The first level is essentially taking advantage of the recent trend towards macro at risk type approaches. So people like Tobias Adrian has been very prominent, David Lopez Salido at the Fed, and so on. And we can use this in different ways. And so one example is coming from September. It is essentially, this uses the macro at risk technology to create a probability distribution. And again, so it's not the forecast errors. This is basically all the information they have in September. And if you're trying to build a probability distribution around the projection, that essentially, you can see here there is a skew to the upside. So not gigantic, but there is some skew to the upside in this forecast. So for 2025, this said essentially that the September projection, more likely it'll be a bit above than a bit below that baseline. And again, I think that that's helpful to look at that. It's also helpful to look at the joint distribution of inflation and GDP, because of course the policy response is going to take into account, is high inflation coming from a stagflation scenario or an expansion scenario? Let me focus on the right side here, which basically says, looks, okay, if you're going to have inflation, let's say above 2.25, so material distance from the target, under what circumstances are you going to see that? And what is said is that essentially, if I take 2025, the most likely scenario, it's a stagflationary shock. It is driving it. There's not much probability of it coming from essentially a demand-driven overheating economy in 2025. So that is helpful for policymakers, not just think about is inflation distributed more above or below the target, but also where that might be coming from. Let me also mention, of course, it's fairly routine to think about differences in energy price assumptions. So the blue line is the market forward curve. You can think about a constant price assumption, but you can also think about the variation around that depending on what is in the financial markets. But again, I think I won't dwell on that because I think that's known. But let me mention that not only can you do it in terms of compared to the baseline, you can also do it compared to the, again, the conditional, the densities around the baseline. So here, the dotted blue line is essentially from our modeling, the range of possibilities around the baseline according to our macro models. And let me just in passing mention, we've responded to Charlie's request. So the foundation of our forecast process is indeed a semi-structural model, the base model that you can read about online. So you have a conditional forecast from us, and then what you see here is if you feed that with these alternative energy price assumptions, it can move the baseline, but it also moves as the whole distribution. So again, you might say, well, if I'm worried, am I more worried? Or if I wasn't worried before, am I now worried? So I think it's important also not just to think about going one at a time around the baseline, because you can use these risks to move the whole distribution. And I think that's important for policy. Okay, I've run through some standard issues there, but let me now come to scenario analysis, where a lot has been said today. So in other words, up to now, I said the ECB runs through a lot of, let's call them sensitivity analyses. How sensitive is the projection to lots of different adjustments? That's good, it's necessary. The Governing Council does get a lot of things to read, absolutely. There's a lot of charts produced. But when we come to scenario analysis, this is useful in two ways. One is to help the Governing Council think through a major issue. And then second, for communication. So we do see this. So before the pandemic, it's only when there's something rare and unfamiliar. And actually, before the pandemic, in my memory, the main one we did was a no-deal Brexit, from our point of view. But of course, from March 2020 onwards, it became very important. And I think if you go back to the scenarios we published, or the staff, I should say, because they did the work, in April 2020, they did a really good job of mapping out the different, what's plausibly going to happen over the next 2 years. So I think that's been very impressive. And then more recently, you can do about geopolitical events. We did one on the Middle East. We've done one on China. But we also can take on big questions. So I think in Claire's 3 cases this morning is about persistence of inflation. But we've also done, which in the euro area context is important, is different scenarios for labour productivity, which has been part of what we've had to think about. So I do think these scenarios are attractive in terms of interpretation and communication, because otherwise it's really hard for the Governing Council to think through these issues. It's also forward-looking, which is very important, because we want monetary policy to be forward-looking. It's also, I think, helpful even in thinking through scenarios where you don't know the likelihood of it occurring. I think someone else said already, maybe once you have a scenario, going meeting by meeting about saying, is it more or less likely than last meeting, that you can do. But in terms of the absolute level of uncertainty, I'm not so sure. So just to illustrate, but before I get to my illustration, let me just say, there's a clear trade-off which has been analysed today. If you present too many scenarios, first of all, the meeting will get consumed by having to concentrate on hypothetical circumstances. They may have only a small probability of being realised. So you can have too many. In the other direction, however, you can go too small, because if you say, I'm going to focus on this type of risk, it might divert attention from something else that could be far more important. And I'll come back to that as well. So what I want to show you here, it's a scenario about consumer confidence, which is another topic which is of current interest. And it was motivated by the left chart, which basically says, okay, what have we seen? We've seen really subdued consumption this year. We've seen housing investment still negative, and we've seen an increase in the savings rate. And on the left side, we do have signals from consumer confidence and consumer uncertainty, where essentially there's a natural evolution to that. But what we wanted to do is ask, how consequential is it whether these whether these rise or fall at a greater or lesser extent than is in the baseline. So that is the motivation. And what we get here, and this is using our semi-structural model, where again you can do a lot of experiments in a semi-structural model, which I think in a reasonable way. And what you see here is that, and if I focus on the cumulated impact, you get a fairly big difference in the GDP outcome, big difference in the context of a slowly growing European economy over these 2.5 years. You get a very big difference in consumption. You don't get much on inflation, which basically behind everything is probably a flat Phillips curve working in the background. But it isn't. So at one level, you might say to someone, this is really going to be important for GDP, but don't overly fixate on the inflation impact, because the inflation impact, at least in this setup, doesn't look so big. Let me come back to scenarios again in a minute. Another issue, going back to the impact of our policy, is not being exactly sure how powerfully monetary policy works. So what staff also does in kind of preparing the monetary policy meetings is thinking about alternative monetary policy paths. And so if I take June, just to make sure these scenarios are stale, so the market people in the room don't learn too much. So the stale range of scenarios here basically asked, let's imagine that we either go a bit faster or a bit more slowly. Someone earlier on said, well, you really only want material scenarios which would really be a game changer. You also need to think through, okay, because in any given meeting, am I doing 25, am I not? Am I doing a bit more, am I doing a bit less? So you also need incremental inspection of different possibilities. And again, what you see here, in terms of the path, you can see noticeable differences in inflation output behaviour across these different paths. And again, each individual governing council members will draw his or her conclusions from that about what they deem acceptable or not. So at some level that is true, but I think it also helps for the staff to run it through a model with a loss function. So again, this is the staff picking a loss function. It is not supposed to represent the collective judgment of the governing council or the ECB. And again, coming back to what the staff can do versus, without replacing the judgments of the ECB. So what I want to show here is basically, if I take let's take the baseline compared to a persistent inflation scenario. So that's the top two rows here. So the 4 cells there. So if the baseline policy, if the baseline is correct, that's normalized as a loss of 0. So basically, you pick the right policy. However, let's imagine inflation turns out to be more persistent. You can see here by the loss functions, the loss is lower if we had picked a policy that placed its bet on persistent inflation. So the loss is 81 if you pick a more hawkish policy if it turns out the inflation process is more persistent. So you might say, well, if I compare the baseline to that scenario, then maybe I should edge towards a more hawkish policy than the baseline. And that's if you focus on, if that is your alternative scenario, is inflation going to be more persistent? However, going back to the strength of monetary policy, we also looked at another scenario, which is basically what happens if monetary policy is more powerful than you think, or basically equivalently, what happens if risk aversion goes up in the financial system? So on top of the policy rate, there are risk premia emerging so that the financial conditions tighten more quickly than you think. And so what you see here is if that turns out to be the relevant risk, picking the hawkish policy gives you the biggest loss. So a hawkish policy to cater to persistent inflation makes sense. A hawkish policy in relation to financial application presents the worst downside. So in terms of, you might say, okay, where does this get me in terms of scenario analysis? Because in one scenario, going a bit more hawkish makes sense. In the other scenario, going more hawkish is the worst thing to do. And this goes back to the individual judgments of governing council members about which of those scenarios you want to look at. Or of course, you can say, well, I'm going to be very disciplined, I'm going to minimize my maximum regret, and I go with the baseline, which of course is what we, you might say, we often do. So let me say in the speech, but I'm not going to go through it, I go through some other examples in our recent decision making about how we handle uncertainty. Let me come to maybe something that came up today, which is basically gradualism. And so what I would say is there's a lot to be said for gradualism. It's very important to recognize that in many cases gradualism makes a lot of sense, and I won't go through the full technical sentences here, you can read them. But it's very important to say also it's not a universal principle. Because in certain circumstances, actually, the right thing to do is to move quickly and forcefully. I won't go over the case of being forceful from mid-22 onwards, which we definitely were, along with the other central banks. But I would say more generally, working out under what circumstances gradualism makes sense, under what circumstances forceful makes sense, is very important. And this is, again, very much connected to the modelling work of the staff to help us do that. Okay, so I know it's late in the day, but let me talk about communication and simplicity. So let me say is that you can look at this picture and say we have become more simple. So the green dots are the kind of recent statements, but you might say it's still pretty advanced. So on the vertical axis is kind of reading age kind of issues, how many years of schooling. So I think this is not yet a settled debate about where you get to in terms of nuance versus a bit of kind of interpretation. So having, I don't think, I agree with Jan actually, in terms of the basics, you need to be crystal clear about what is the role of this central bank. You don't need nuance for that. We will get inflation back to 2% in a timely manner. Then sequentially, later on in the statement, explaining what's driving underlying inflation, monetary transmission, maybe a bit of nuance helps there. But I think this remains an evolving issue. Let me say in our communication, we have a risk assessment. Chris Giles earlier on was kind of speculating, is this kind of just kind of making sure you mention everything so you won't be accused of not having thought about it. But I do think it's also important to say that we do list out various risk factors, but we don't pretend to be able to attach likelihoods to everything. And I think for me, the message from the risk assessment is, here's what we're thinking about, maybe you should too. And so in terms of all the risks in there, we will be analysing. So maybe I will finish there. I will say what I've done today is I've tried to race through how we handle risk and uncertainty at the ECB. I've already mentioned in other speeches. We will be coming back to this topic in our 2025 update of our strategy. So the set of issues that Claire laid out this morning, of course, we also are thinking about it. But maybe the last point I want to make is let's also not forget that not only is there uncertainty about the cycle, there's also uncertainty about the trend. So while I've talked a lot about cyclical uncertainty today, the trend also matters for monetary policy. I think I'm on safe ground in saying the euro area economy could better withstand cyclical shocks if it grew more quickly on a trend basis. And this is why it's so important to implement the Lett and Draghi reports, including in relation to capital markets union. So let me stop there.
Thank you very much. I'll thank you for that. Your title reminded me of one of my first experiences at the newly created European Central Bank, where there was a conference that was called Monetary Policy Uncertainty, and Otmar Issing was there, and he looked up and said, "Is there any other kind?" And so I think that this is pretty fundamental. David, you have to give me some idea of how much time we have. It's 5:25 right now. Okay, great, thank you. We don't have our timer. Okay, so let me start with I'll ask you one question, which you may or may not answer. We'll see, and then I'll turn to the audience, and I think that the core of my question is whether or not is this still on? Yes. Okay. Great. Thank you. Whether or not we've become overly focused on inflation and small deviations, what are looking like small deviations and risks, they weren't always. I mean, I do remember, I'm old enough to remember the late 1970s. And in the late 1970s, inflation was, you remember too. You remember what inflation was? And it was, in the US, I remember, it was 20%. Yeah, so 25 here. And by 1995, we had low inflation and we all had inflation targeting. I checked earlier, and according to central banking, there are 84 central banks. This ECB is one, so that's 20. 84 central banks in the world that are now inflation targeting in one way or another, and of course we've benefited quite enormously from that. But a lot of the inflation targeting environments were put into effect during periods when we had positive, things were very accommodating to that. Right, it was an opportune time to do it because there were positive supply shocks And so we kept on forecasting inflation that was too high and growth that was too low, and we were all very happy. And inflation kept coming down. So, but my question now, if I look out there today, I see a world that, frankly, from my perspective, looks more like the one, the sort of formative one where I grew up with Charlie, and that was in the mid to late 70s, because you look out there and you see supply shocks, you see geopolitical tensions. And so my question for you is, how should I think about the monetary policy framework in a world where we have not such a accommodating environment, where we risk actually having lots of positive price shocks, lots of negative growth shocks, and then the problems that the central bank faces both internally with their decision making and in their relationship to their political masters and their citizens that they serve.
Sure. So what I would say is, if you look at the whole history of the euro area, supply shocks have been very important throughout. So we had major fluctuations in the price of oil throughout. The financial crisis was a massive supply shock in terms of breaking the supply of intermediated finance. So this is essentially been throughout the biggest issue for the euro area. But I don't disagree that the set of risks now are different. So what we said in our 21 strategy is essentially we focus on the medium term for inflation. And the monetary policy response depends on the origin of the shock, the duration of the shock, and the size of the shock. So, and I think essentially lots of people are writing about supply shocks and monetary policy, but essentially it's not so easy, but we have to get to a place where clearly above a certain threshold of supply shock, monetary policy has to respond to that. How you worked out the relevant threshold is going to be data dependent. It's going to depend on, and it's probably going to depend on the kind of constellation. So going back to 2022, in the exact same 6 months as we had the 6 months after the Russians' invasion of Ukraine, we also had the reopening of the European economy after the pandemic, after Omicron. So at the exact same 6 months where you had the supply shock from energy and oil, you had this mismatch between constrained supply and a recovery in demand in contact-intensive services. So if in other words, if you're taking the Russian invasion of Ukraine at a different time, when, let's imagine, either monetary policy had been more restrictive in the run-up for other reasons, or there was no pressure on demand from the kind of dynamics would look different. So I think you're not going to get a universal answer. The Norges Bank, I think, had finished their strategy review already. And in May, when they published their review, more or less, they essentially said, when a lot of time you should continue to look through small supply shocks. But if the shock threatens to turn from being a relative price shock to general inflation, and if it threatens the anchor of monetary policy, then you have to respond. So I would agree that in terms of the kind of reaction function, the big question about has the last 2 years left a legacy, a hysteresis legacy about more sensitive expectations, for example. Let's see. But I think you need to kind of really make sure that we don't veer in either direction, either overreacting to the lessons from this period, but also fully incorporating what's happened.
Well, I guess I find that very reassuring. But for those of you that didn't notice, the Federal Reserve announced that they're doing their policy review. They announced on Friday, and so maybe I hope they listen to at least that part of the answer to the questions when they do their policy review. Okay, let's start. I have two people over here, one there and one there, please, and also behind. There's a. Please, and as before, identify yourself. It also helps if you stand up, because then other people in the room can tell who it actually is. I think. Please.
Thank you, Marco Stringa, Element Capital. Maybe I'm wrong, but looking at all the scenario that you show, there is still a tendency, if not a bias, to focus on the upside from supply shock, from inflation. And in a way, also in the minutes, you have downside risk for growth. So I should say that counts. Downside risk to growth, but there is a resistance to translate that downside risk to growth to inflation. So should we interpret that the Governing Council is still scarred by the recent upside in inflation, and we are a bit forgetting the decade of chronic undershooting of inflation?
Thank you. Behind, there was a hand up further back, please. Thank you.
Thank you. Vicky Price from CBR. The presentation you gave us was very much sort of in aggregate in terms of the impact of shocks on inflation in the Eurozone, I presume. But you talked about the monetary transmission mechanism and how you were looking at that quite carefully. But surely it varies so hugely from country to country, and the impact of the shocks varies so hugely and has varied so hugely from country to country. When you make your decisions, do you just focus on one country, Germany, or do you look really much wider than that?
That was the question I wasn't going to ask. It was going to be framed a little bit differently. It was about the inherent pro-cyclicality of the Irish boom and the German stagnation. But anyway, why don't you take whatever parts of those you?
No, I'm very happy because I mean this is a very important question, and so I think maybe what's interesting is we do the forecast two ways. One is you take the euro area as just an economy. You look at euro area variables and you think of it like that. You can also do it just adding the countries, do country by country. And what's interesting is one doesn't dominate the other. And that's something to think about. I mean, if you think about the US economy or maybe even the UK economy, if you try to model London versus the north of England, I think they'd have different macro dynamics. And it's the same for us. So there's only one monetary policy. I think there's a whole set of ancillary questions, like macroprudential policy, about executing counter-cyclical fiscal policy at the national level. And this is why actually it's very important that we also have the national central banks, not just the ECB. This is especially true in relation to the energy shocks. The energy systems are so different, not just in terms of how to produce energy, a lot of nuclear in France, but also how customer contracts are set. Some it's indexed to wholesale price, others there's multi-year contracts. And also there's some discussion today about fiscal responses to inflation. There were over 500 fiscal measures in the area in response to inflation. It would have been a bit difficult for the ECB staff in Frankfurt to keep track, but we were able to do it via the national central banks. So actually, it was an interesting issue at the start of the year. How does this work? Actually, it's been working, I think, quite well, and it goes, I think, in terms of how monetary policy, either to do it as a mix of those two. Let me say, I mean, the probability distributions I showed, and I focus on 2025, which is not, the only year we look at, but it's like more or less 45-55. There's a lot of downside risk compared to the forecast. So I would say, and the value of looking at the whole distribution is to have that basic memory. The fan charts in terms of forecast errors, there's a lot of distribution. It's very helpful to macro models. If you look at the base model, which you can download, I think, or at least you can read the very detailed documentation. All the macro relevant. So the idea that anyone in the Governing Council or the ECB think there's no connection between slack and inflation is just, not there. So, I think throughout there's been essentially, two-sided risk. But when inflation is I had an interview this morning which was published. I said, look, even in 23, inflation averaged 5% in 23. At that point, when inflation is 5, risks compared to 5 are still, a lot of it is going to be above 2, the target. Now when inflation's close to 2%, risks to the forecast are also risks to the target. So there's a big difference between what we would think about a year ago or 2 years ago compared to now. And now when inflation's near to the target, because it's very important that policy is driven by the target. And that, I think, really covers it. And I would say maybe, I invite you all to keep on, I hope you have it printed out and beside you at all times, not just at your desk, but to carry around our monetary policy strategy statement, which tells you everything. And it tells you we have a symmetric commitment to 2%. And that is, I think, very important.
I probably have all the background documents too. It's quite a lot. Let's take a couple more over here. There's one in the back and one right here, please.
Hi there, Tomasz Bialek from T. Rowe Price. So yeah, super interesting presentation about monetary policy under uncertainty. If you just look at the latest data, for example, I mean, we have lots of trade policy uncertainty, lots of economic policy uncertainty right now, both the election in the US as well as the announcement of the snap election in Germany. And if you look at the PMIs on Friday, I mean, especially in services, yeah, they came much lower than people expected. Now, this could be just one of confidence effect, or it could be something more persistent. And I guess my question is, how do you interpret whether it's one case or the other, and how would you incorporate this in your framework of monetary policy under uncertainty? How would you react to it?
Thank you. And
yes, Mario Pietrunti, BNP Paribas Asset Management. Thank you, Philip, for the speech. I was thinking that after 2022, running forecasts at the central bank and publishing them is quite a challenge, because if you take into account the inflation episode and you publish like fun charts or scenarios, then the fun charts themselves become uninformative because they're going to be very large. On the other hand, if you don't take into account that episode, your forecasts become kind of uninformative because people may wonder, but what would happen if we have a repeat of? So the question is, are we putting too much weight on forecasts now in a world in which we have so many supply shocks and so on? And echoing what Jan said, shouldn't we attach to every forecast and scenario and fun chart also a reaction function? How the ECB would react in every scenario that they run? Thank you.
So first of all, let me say is the shocks in 21, 22, I've said were not so easy to predict, to put it mildly. Also, again, given the scale of shock, I do think, and my speech a week ago about macro models went into this, I do think there's a lot of kind of non-linear responses in, especially in 22, which kind of amplified, possibly accelerated the whole thing because of the speed of price adjustment. So getting to an inflation rate of 10.6 in October 22, there were big forecast errors. Jan also, I think, made this point. At that point onwards, the forecasting process has been pretty good. So in our December 22 forecast had inflation falling from 10 in Q4 22 to 3.3 in Q4 23. In fact, it went more quickly than that. So the macro models have actually been very impressive in the last couple of years. Understanding that we're going to have a couple of years in a European context because labour market moves slowly. As I've emphasised in various speeches this year, there's a lot of 3-year wage contracts in Europe. This year, you've seen a spike in wages in some countries because they did not get a pay increase, an unscheduled pay increase since 2021. So, and what we said is next year, that's not going to be in the data. We're going to have a big deceleration. So actually, I've been very impressed by the macro models in saying conditional on the shock occurring, what happens next in terms of the second round and the return to target. So I would say the models have been very helpful. The forecast has been very helpful in order to make sure we calibrate policy correctly, but also for the readership in saying, here's why actually this is going to be an extended phase above target, but where actually it should come down fairly quickly. What I showed you here behind this, the staff can do as many policy paths as they like. So if you want to understand what are we seeing in terms of optimal policy in the model responding to the shocks, you can either look at the staff work which describes it, you can replicate it yourself, and then the question is, okay, compared to the optimal model-based optimal policy, under what circumstances will the governing council deviate from that? That's where I think you're going to have to recognise that the governing council is going to be reluctant to offer too much more insight. But this is going back to what Charlie said earlier on, the narcissism of small differences, I think. If the optimal policy basically says, there's a fair amount of rate normalization needed, I don't think we're going to go in a hiking cycle. So the exact kind of speed and so on, there will be judgment calls and so on. So, I wouldn't ask for too much.
I'd also add, I would challenge you to do policy without forecasts. That seems like a pretty tough thing to do. I think we can have two more questions. Let's see, I have one in the back here in the middle and one over here. How's that? I think some people have had right there.
Did you mean me?
David got it. It was actually this person.
Somebody gave me a microphone. So
all right, we're going to have three questions. Go ahead, David.
Yeah, thank you. David Marsh of ONFIF. I was much more interested in your charts than I thought I would be. And the 8 and 9 I thought were really fascinating. And you've just published this for the first time, it seems. Could you tell us whether it's a mixture of the staff and the Markets Committee? Because it wasn't quite clear. And will there be some back numbers of these charts that you will produce in some years, maybe in 30 years' time, so we'll know a little bit about what they said a few years ago? And then I was even more interested by chart number 14, which seems to be about the language. And that's, if I interpret that rightly, it was a bit difficult to tell whether it was a chart or a fashion statement with all the different colours there, but it seems to indicate that Christine Lagarde, you only need 10 years of training to understand what she's saying, whereas you needed 14 years of training to understand what Mr. Dijsselbloem was saying. That was a really interesting statement. I just wondered if you could elaborate on that a bit.
Could you give the microphone to this gentleman in front here, and then we'll come over to you. Thank you.
Hi, good afternoon. Michael Michaelis, Bluecrest. Thank you very much. A very interesting presentation. Two very brief questions. So the first one, since we're going on the charts, is on chart 13. You had a very interesting slide explaining the alternative policy paths based on the information available in June 2024 and how it would be different depending on the strategy. I wonder if you had a comment on what that looked like in September 2024. And secondly, since you mentioned symmetry, I wonder if you could comment on how the symmetry principle differs in a forward-looking basis if you're coming at inflation from above the target or below the target. Thank you.
And now the last question.
Thank you. Theo Morris-Clark, Rocos Capital. Thanks very much for the speech, and I really enjoyed the, I could call it, worked example on a robust control approach to policy. And I think if I've understood it right, under a robust control approach, relatively modest changes in the likelihood of tail scenarios can have quite large and quite rapid impacts on your preferred path of policy. With that in mind, and seeing the quite rapid deterioration in business confidence we've seen over recent weeks even, what's the ECB looking at to consider recession risk?
Okay, thank you. So, but in relation to that, and then I think Thomas's initial question, I think I'll delay my answer until December 12. So the answer will be in the communication when we actually decide. On the communication, there's a whole industry, including people who've been here today, about measuring complexity in communication. So there's basically standard techniques to do that. I think, again, one of the questions to ask is, and by the way, the ECB, we roll out, on top of the monetary policy statement, we do roll out infographics and other things to communicate in a different way. But I think, honestly, for a lot of people, they're going to see a headline. They may not be paying massive attention, but they see a headline somewhere that President Lagarde says, something, one-liners. So a lot of time you can summarize the decision in a one-liner. But I think it's not, for the professional audience, you have to balance simplicity, the clarity that Jan was talking about what, upfront, what the mandate with ECB is and our determination, with basically the nuance of how we are looking at the recent inflation and economic data. In terms of the different charts I showed about risk distributions, the ECB staff and the Eurosystem staff, for that matter, are always innovating. The techniques they use, I think what are here are relatively novel techniques. Now, of course, it's not a radical departure to the past. So, David, I'm not sure if you go back 30 years or the first time you see it, what you're going to see. But this is to demonstrate basically how they're, and again, it's difficult to overstate. It's not the case the ECB staff live in a bubble. They're very closely interacting with the academic literature. They're looking at what the Fed is doing, the Bank of England is doing. Of course, the staff are all talking to each other in different international committees and so on. So I would say it's an attempt to capture, the latest techniques. Now, all of these techniques essentially either rely on historical data or financial market data. And there's pros and cons to both. And let me say, going back to chart 13 on the different sensitivities, and again, these are, what I show is the average across different models. Another type of robustness is, don't overly focus on one model. And that's why we have a DSG, we have different DSGs, and then we have the semi-structural model. And it's helpful. In other elements, and I'll just come back to OR*, at the start of this year, the ECB staff published a range of estimates. And it was not just a different range of techniques, it was also Eurosystems. Some of it was coming from the Bundesbank, some of it was coming from other central banks, some of it coming from the ECB. So I think it's very important to really not zero in on any one way to either do a macro model or to do a calculation such as OR*.
Thank you very much, and thank all of you for coming and staying all day. Thanks to the organizers, thanks to the wonderful staff that made sure that we all got into the building and got fed, and that you can actually hear me some of the time. So thank you.